Solana Accelerate will begin shortly. Please silence your devices.
All right, let's go. Hello, 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 and welcome. Oh, applause before we even get going. That's great. Welcome, everybody, to the first ever Ship or Die conference right here in New York City. My name is Kash Donda. I'm a core contributor over at Jupiter, but today I will be your MC for this morning segment. Before we get into all that, I want to get a sense of everyone here in the audience. Make some noise if this is your first Solana event. Just do a little clapping. All right. Some newbies who are not so shy. That's what we like to see. How many people have been to a Solana event before? Make some noise. All right. Any OGs here who have been to like more than 10? Make some noise. A few folks. All right, there we go, Kaiser and everyone else. One of my favorite things about the Solana ecosystem is how welcoming and friendly it is. So if it is your first time, feel free to just run up on people, ask them what they're building. There's going to be a ton of partnerships and hopefully some friendships that come out of this conference. And oh my goodness, what a conference we have in front of us here. 3,000 attendees, more than 200 speakers. 2 days of just jam-packed insights into the future of finance. Honestly, John and Pedro and Ellie have really outdone themselves. This is a star-studded agenda. Yeah, make some noise for John and Pedro and Ellie. Let's go. Yeah. These folks, this lineup would have been unthinkable as recently as like 12 months ago, honestly. But you don't have to take it from me. It is my deep honor to be introducing two folks to the stage right now. The first one, the executive director of the Solana Foundation and the Viking leader that this ecosystem is lucky to have, Mr. Dan Albert, and the head of ecosystem engineering, Mr. John Wong. Make some noise for them as they come up on stage, folks. There we go.
Good morning. I'm Dan Albert. I'm Executive Director of the Solana Foundation.
And I'm John, and I am the Head of Engineering at the Solana Foundation.
Welcome to Accelerate. All right. We are so excited to have all of you here. This is the biggest event we've ever thrown in the US, and we are so excited to be doing it right here in New York City. This week, Accelerate Week, was actually so big we had to break it up into two completely separate conferences. Earlier this week, we had Scale or Die a couple days ago, just across town. This was a deep technical conference for all of the developers, the engineers, the folks that are really pushing the boundaries on Solana technology. And I just wanted to give a shout out and say thank you to everybody who joined us earlier this week for Scale or Die. We had over 1,000 people show up, core contributors to the Solana blockchain, presentations on the future of the network, the future of all of the deep tech and cryptography and the things that power all of the incredible products and innovations that you guys are going to hear about over the next couple days. So thank you to everybody who joined us earlier this week for Scale or Die. Now, here we are. Second of two conferences on Accelerate Week. This is Ship or Die. This event, we have 3,000 people showing up, more people coming in, hiding from the rain. This is a celebration of everything that Solana and our industry has produced and a forward look into all of the things that are yet to come. So we have leaders from business, from policy, from technology, all over coming here to collaborate and build the next chapter of blockchain in America. So feel free, talk to people, explore, check out the products, and I hope you all have an incredible time here at Ship or Die as part of Accelerate Week. John is going to talk us through what the next couple days are going to look like.
I'm so excited for this. GM, everyone here. I'm here to talk about Accelerate and how to best enjoy it. So even though my day job is as an engineer, my other day job is the unofficial CEO of this conference. So if you have a great time, it's because of the production team, Ellie, and everyone else, and all the speakers. If you have a bad time, it's my fault, so just let me know. Some logistical notes. The doors open at 9 a.m. You're already in your seats. The show starts at 10 a.m. every day. Tomorrow we start a little bit earlier at 9:50. This venue is massive and awesome, and it is open until 7 p.m. So while the content will end around 5:30 or so, you can hang out in the space, take a look at all the sponsor booths, all that sort of stuff. But I want to give you a director's notes on how to best accelerate. So in the process of creating this conference, I wanted to make sure that we were creating an event that everyone could enjoy. And there's a lot of things that I don't enjoy about conferences. You will see none of that here at Accelerate. You will only see enjoyable content like myself and other people speaking from across the Solana ecosystem and the broader crypto ecosystem. There are 2 stages. You are currently at the East Coast stage, East Coast on the left, West Coast on the right, as it should be. And each has a different set of content. So the East Coast stage is focused on institutional finance and policy. So this morning, you're going to hear about internet capital markets. You're going to hear about TradFi. Tomorrow morning, you're going to hear about payments, policy, and stablecoin. On the West Coast stage, you're going to hear about how to build a business, how to build great consumer crypto products, and you're going to hear about some fun mobile things happening in the world. So definitely check out both stages. There's plenty of great content across the 2 days. So the other thing to remember is that this venue is awesome, and in fact, it looks like a map of the United States. We are here. We just walked in through some skyscrapers here on the New York side of the house. In the middle, you'll see Chicago. You'll see a little bit of DC, right? There's a Statue of Liberty in the middle over there. And on the far west coast, you'll see San Francisco. You'll walk in through the Golden Gate Bridge. There's plenty of coffee places. Check out Seek and Sip. Check out the Robot Barista. You can see some live art over by the West Coast stage. And there's plenty of sponsor booths. We made a really concerted effort to make sure that there's interactive product demos at every single one of these kiosks. And there's a couple more things. There's some photo booths. Check out the Checkpoint photo booths that are around the venue. The Sonic venue also has a photo booth as well. And the last but not least, we have the Exchange Art NFT gallery. So check out all of these things throughout the venue, and I hope you enjoy yourselves.
All right. Thank you, John. All right, we are going to get started. And again, I just want to say, if this is your first Solana event or your 100th, if you've been in crypto for a long time, or if you're just entering the ecosystem and the community, thank you for being here. Welcome. We're going to kick it off with 2 leaders of 2 of the Solana validators, the FireDancer team and the Anza team. And they're going to give kind of a deep dive on what's coming next in pushing the Solana blockchain forward. And for now, let's accelerate.
All right, good morning, Solana. I'm Brennan Watt, VP of Core Engineering at Anza. I'm joined today by Kevin Bowers, the architect behind FireDancer. And today, we're talking IBRL. That's the increased bandwidth, reduced latency mantra that aligns all Solana developers toward a common goal. Solana built a brand out of being the high-performance chain with low fees. Being decentralized and permissionless are mere table stakes. They are not an excuse to be slow or expensive. And users and developers have been coming to Solana and staying because of the user experience this high-performance blockchain architecture delivers. Today, we'll peek into the engineering taking place on Solana, powering that core base upon which everything else is built. Anza is the company behind Agave, the successor to the original Solana Labs client and the dominant validator client since inception. Building efficient, resilient, performant clients is what we do best and an integral part of the Solana success story. But there's a new validator client in town that's making waves. And this is probably a good time to hand things off to Kevin to say more about that.
Thanks, Brennan. Since Brennan already introduced me and gave a brief overview of Agave, I'll jump right into a brief overview of FireDancer. FireDancer is a new Solana validator in development in the open at the above link. Early hybrid versions of FireDancer, we call FrankenDancer, have been running on testnet since late 23 and on mainnet since mid 24. These have grown to represent about a third of testnet stake and a little bit over 6% of stake on mainnet as of last night. When I was first asked to work on FireDancer, my initial role was to organize various wish lists into a practical development plan with measurable deliverables. To better understand the goals of FireDancer, let's look at some oversimplified versions of these wish lists. First, while Foundation wanted everything in a pony, their top priorities were to foster development of an open, independent second validator and to make the chain operations enterprise grade. Though Anza had not yet spun off at that time, the second wish list I characterized as theirs. They've been the most vocal with us about supporting a worldwide community with a 50 billion account capacity stretch goal. The next wish list I characterize as the operators' communities, but it is universal. If one of our production systems goes down, the revenue it generates stops, but its associated costs continue. We care deeply that our systems stay up and our costs stay down. This exact dynamic applies to the operator community. They care deeply that the chain stays up and their costs stay down. The last wish list I characterize as ours, but it is implied by the other wish lists. Consider a hypothetical chain tracking 50 billion accounts that requires validators to verify accounts sequentially at startup. Further, suppose the best off-the-shelf software on the best commodity hardware verifies accounts at a seemingly fast 100,000 accounts per second per core. Restarting the chain would take almost a week. Looks like we need high-speed parallel cryptography for high reliability. Consider if that same chain had a 100 transactions per second capacity. Just touching each account once would take over 15 years. Looks like we need high-speed transaction execution for high scalability. The community needs to be thinking in terms of millions of transactions per second if it wants to be competitive with traditional applications. It's a good bet that in the weeks to decades waiting for this hypothetical chain to start and then touch an account, an enterprising developer would realize all the performance doesn't matter magical thinking they've been taught is a lie, and would whip up a new chain designed from the outset with real-world performance in mind, and be able to do so in less than a decade. In fact, we don't have to take that bet. It's already happened. One of the reasons for our interest is Foundation deeply grokked this. They cared about performance from day one, and it showed in the data. Solana was the fastest chain by a wide margin when we started. Our technical specialty is distributed computing at speeds most people don't think is possible, much less needed. Contrary to conventional wisdom, though, this is not a weird affectation. Price-time exchange order matching rules create an economic dynamic where we need to make ultra-high performance distributed systems to survive in ultra-competitive traditional financial markets. We've always thought our role here is to push the protocol to the limits of the laws of physics and information theory to make it a viable platform for real-world applications. This graph of commits versus time shows that since then we've been doing the work and at an accelerating pace. Now, high speed is all about optimizing data flow. Data flow is the very first thing frozen in an application implementation. If it isn't optimized up front, the only way to significantly improve performance later is to throw everything away and start from scratch. Unsurprisingly, then, the first thing we did was streamline a validator's data flow. This shows the high-level data flow through FireDancer when it is the leader. The large box represents a commodity server. The smaller boxes are CPU cores and network interfaces on that server. The top half receives raw transactions, filters out duplicate transactions and transactions with bad signatures, and packs valid transactions together for execution. The bottom half schedules valid transactions, executes them as parallel as possible, and distributes the resulting blocks to other validators to verify execution was done correctly. We've been running along this data flow, incrementally replacing Agave components with in-house developed ones. We call these early hybrids Frankendancer. Given our limited time, here's a few milestones relevant to increasing bandwidth and reducing latency. At breakpoint 22, we live demoed a software transaction receive pipeline with a 1.2 million transactions per second receive capacity and a 0.6 million signature verifications per second capacity on an old stock GCP host. Shortly afterwards, we stitched our software pipeline into Agave to make the first Frankendancer. Mid-23, we live demoed to Anza and Foundation a hardware-accelerated 1 million signature verifications per second capacity at lower cost and lower power than CPUs and GPUs on an old stock AWS F1 FPGA. We also live demoed using 8 of these FPGAs to scale signature verification capacity to roughly 8 million verifications per second per host. We've made this technology available to 00. Not too long after, external partners started experimenting with Frankendancer on testnet. At breakpoint 23, we showed methods to dramatically improve the efficiency of many common cryptographic encoding operations and how to enhance validator security without sacrificing performance. Mid-24, we live demoed to Foundation and Anza roughly 100 modified Frankendancers running on commodity hosts distributed over a 25 gigabits per second data center local area network and a 100 gigabits per second intercontinental wide area network, a proto-00, processing just over 1 million simple uncontended transactions per second. By this time, Frankendancer was very close to the full FireDancer, much more so than the community realizes even today. It was already using our own kernel bypass networking, core-to-core communications, quick implementation, signature verification, block packing, parallel transaction execution, accounts database, proof of history, Reed-Solomon encoding, turbine block distribution, and so forth. The main remaining Agave components were the Solana runtime and consensus. This demo showed that we can configure FireDancer to make the most out of whatever hardware and network is available, and we can scale it beyond the limits of the protocol and user demand for foreseeable future. Just as important, the demo showed that with minor modifications, Agave can do so too. Ongoing work is not about tuning performance further. It is about replacing the last remaining Agave components to realize the Foundation's primary goal of having a second completely independent validator implementation, and testing and auditing and testing and fuzzing and testing and testing and testing. Given how close Frankendancer and FireDancer are already, we expect the transition to FireDancer to be seamless. There's no reason for operators to wait to try it out, and we encourage them to kick the tires. The TLDR is that we are the hipsters of IBRL. We were increasing bandwidth and reducing latency before it was cool. Now, there's been a lot of worry in the community about what will happen if there are multiple validators with different performance characteristics. One reason for open sourcing FireDancer was to educate the community about how to optimize a validator. Shortly after this demo, we did deep dives with Anza and Foundation about the protocol, Agave runtime, and Agave consensus modifications that we made. Suffice to say, we're not worried, and this is a good place to hand the reins back to Brennan to see why.
At Anza, we're taking the performance messages that Kevin just covered to heart. And in case you haven't noticed, the network is looking really nice right now from an engineering perspective. This chart shows over 3 years of historical slot latency data. And slot times are under 400 milliseconds. I'm guessing most people didn't even know that was a thing until the Agave v2.1 release. And this is essentially a measure of how efficiently our block and transaction pipelines are operating. We need to get transactions into blocks and blocks out to the validator network as seamlessly as possible. Any stalls getting transactions into blocks, streaming microblocks across the network, or verifying state can interrupt these pipelines and cause delays. And that's the ugly truth of the left side of this picture here. I much prefer the glorious right side that we're operating in today. And this is one of the only charts that we like to see down and to the right. Skip rates are under 0.5%. A skip is any time we had a chance to build a block, but didn't for whatever reason. And this might be due to things like offline hardware, slow leader node transitions, or network partitions. And we can think of this like yield loss in a factory. Yield loss hurts user experience, it hurts IBRL, and it hurts validator economics. The closer we can drive yields to 100%, the better it is for everyone. And this trend is absolutely phenomenal. I mean, look at that chart. It's just chef's kiss. Transaction confirmation latencies are way down, with many transactions achieving single slot latency. And this is a measure from the time when you send a transaction on the client side to when the block that it gets included in is confirmed by the network. In this chart, each point represents one transaction. And as you can see, the majority of them are well under 1 second. This is light years ahead of where we've been in the past. And this is absolutely crucial for user experience. This is what is really driving how snappy the applications can be. And we want to drive this even lower and unlock new use cases. I'm not going to go into this more now, but trust me when I tell you that the Onza devs are absolutely cooking. And finally, we're consistently filling blocks to capacity. This chart shows when we modestly increase maximum transaction capacity, and even after this increase, we're constantly bumping up against that limit. We often have more transactions than we have capacity in blocks to include them. And this is the type of problem that we absolutely love to have. There is real demand for inclusion on Solana. And so obviously, all of these metrics look great. We're really excited about them, but the job is not finished. Solana is fast, and we love that it's fast, but other people see that it's fast, and they see how much we're winning, and they want to experience that too, so they're coming after us, and we cannot get complacent. But it is in our DNA as Solana builders to be aggressive. And so at Onza and Firedancer, we're committing to keeping the pedal to the metal and making it rain block space this year. I'll say it again. We are going to make it rain block space this year. And these are not sleight of hand promises that can only be delivered in some test environment. There are no caveats, there are no asterisks, and this message will not be watered down by the time it hits real users on mainnet. We are increasing capacity where it matters for the complex types of transactions that users are actually performing on mainnet today. These are things like complex program invocations, contended state updates, and of course, token swaps. So how are we going to do it? This brings me to the more technical part of my presentation. I know we've got like a bit of a left curve audience here. Left curve is kind of nerd speak for anyone that doesn't wear tech hoodies 5 days out of the week. But I promise I'm not going to get too crazy. I just want to cover a few of the very most important things happening on Agave this year. So the first of which is aggressively reducing memory allocations. Old Agave is that traffic jam on the left-hand side, just drowning under a sea of extraneous memory allocations, page faults, and mAdvice storms galore. Not great. But we've been exercising the allocation demons that have ailed us, and we're in a much better place now. But there's a ton more work to do. Thousands of micro improvements that each on their own might not turn the needle much, but collectively add up to giant gains. And that's really been the story of the last 2 Agave releases, and we expect that trend to continue. The second one I'll mention, sticking with this theme of micro improvements, is just tightening up latency on the hop path. The hop path is that critical piece of code that gets exercised for every transaction or every shred in a block. And sometimes we like to think of working on performance kind of like Neo in the Matrix, and we're bending the fabric of space and time, or that it's all this sexy whiteboard algorithm redesign. But in reality, it's a lot of blood, sweat, and tears. It's a little more boring, and honestly, it's a bit of a grind. And at Onza, we've had to get back to basics and reevaluate things like how efficient are our hashing algorithms? How often are we serializing data into and out of these complex types? And I know this is super boring stuff, but it's the stuff that actually makes a big difference when you talk about performance in production. And at Onza, that's what we're all about, working to improve real performance in production every single day. The third thing that I'll mention is Turbine. Turbine is the name of the Solana block propagation protocol. And this is how we get block data from the leader node out to the validator network. And we use a little tree that looks something like this. But there are a couple important distinctions between this toy example and real mainnet. The first one is the number of nodes, or the rectangles in the picture, which in this toy diagram is 9, but in reality on mainnet is around 6,000. And the second thing is the level of fan out, which is the number of arrows coming out of each rectangle, which is only 2 in this picture, but on mainnet is 200. And oh, by the way, that fancy new consensus algorithm that we're rolling out, Alpenglow, with that, we want to dramatically increase the amount of fan out to reduce the number of network hops. More fan out, fewer layers, lower latency. But the upshot of all this is that poor relayer node at the top of the tree is getting stressed extremely hard. On mainnet today, we're asking 150K network IOPS out of our high-stake validators. That's 150,000 packets per second just for Turbine every second of the day. And we've had to overhaul the Agave network design to be able to make this happen. And finally, let's talk about the scheduler. The scheduler is the brain that decides which transactions make it into the block. And it's overgone several iterations over the years. We've had to change it to do things like make sure local fee markets actually work, improve efficiency and performance, and highly optimize for the real workload that we see on mainnet. We need to keep those execution cores humming and those block rewards flowing. That's the name of the game. And we expect this critical component to continue to evolve. At Onza, we're paving the way for innovation here by allowing operators to compete in the marketplace with well-aligned incentives. And so we're extremely pumped for all these changes and upcoming improvements to Agave. But let's zoom back out here, because there are a lot of things happening in the broader development community to get excited about as well.
Thank you. Thanks, Brennan. Though widely available commodity hardware can support millions of transactions per second scale capacity on a host, the surrounding ecosystem needs work to expose it. About a year ago, I was asked to present lessons we learned in FireDancer development at an offsite with Onza and Foundation. I collected these lessons into the amazing stories of Frankendancer. One story was pure IBRL. A gigabits per second attack is a you problem, but a terabits per second attack is a we problem. A validator doesn't exist in isolation. There are many validators, and they communicate with users and with each other via wide area networks. A public schedule advertises when each validator is the leader. When a validator is not the leader, it verifies votes and blocks produced by recent leaders. We effectively have a ring of transaction filtering resources and a ring of transaction execution resources. The connectivity between these rings is currently limited. Filtering resources on a validator can only be used to feed execution resources on that validator. For the reliability and scale wishes, then, each validator needs enough resources by itself for whatever user capacity and denial of service attack resilience is desired for the entire chain. This spikes hardware and network requirements towards high-end hosts and high-end data centers with high-end network connectivity, ignoring the efficiency wishes of the operator community. Even though we have more filtering resources than we need in aggregate, they aren't in the right place at the right time. The rings aren't connected flexibly enough. It's not hard for a malicious user to send enough junk from multiple sources to the current leader to overwhelm its filtering resources. The leader's high-end network provider will not care, because their high-end fiber optic connections are capable of handling terabits. 10 gig or 25 gig knocking over just one of their many hosts does not impact their many other customers. That is, a gigabits per second attack is not their problem, it's your problem. If we pull apart the rings and connect them more flexibly, the current leader could make use of the entire chain's filtering resources. We no longer need to provision each validator for the whole chain's filtering needs. 00 recently started up to foster the development of network acceleration technologies and community wide area networks optimized for decentralized protocols like Solana. We are eager adopters, contributing network bandwidth and filtering hardware technologies. By using optimized, multicast, wide area enabled networks, transactions and blocks can be distributed faster and more reliably. By using the network and hardware more efficiently, operators can support more users and give them a better experience with their infrastructure. By using distributed hardware filtering, denial of service attacks require many terabits per second, hitting many geographically sites simultaneously. This is not an attack against you. This is an attack against everybody everywhere. That is, a terabits per second attack is a you problem, is not a you problem, it's a we problem. From our perspective, this is not a new idea. The internet is not well optimized for big tech or traditional finance. They use their own internal custom wide area networks optimized to their needs. It is great to see things like 00 start to level the playing field for decentralized applications. A second independent validator has many benefits beyond performance, but performance is a prerequisite for increasing bandwidth and reducing latency. Optimizing connectivity is just one of the areas we are working with the community to improve the whole ecosystem. Brennan touched on several others in which Anza is doing the same, and it's great to see the recent proposals for consensus, multiple leaders, and so forth, many discussed this week, push even more aggressively to streamline and decentralize validator functionality. Since we don't have more time, I'll conclude by noting my background is high-performance scientific computing and traditional computational finance, not crypto. As a newbie assembling the wish list at the start of FireDancer, it was clear to me the community wanted to grow and maximize people's agency. It wasn't clear the necessary performance was possible, and it wasn't clear the community was ready to make the necessary changes if so. It's now clear to me that this is not just possible, but happening. With that, I'll hand the reins back to Brennan.
This tech is here today, and it has real legs. Transaction volume and speed are accelerating. New use cases and possibilities are coming online every day. A shared, unified state spanning DePIN, gaming, real-world assets, stablecoins. We implore you not to take it lightly. Solana is ready to compete with big tech and traditional finance, and we can't stop, won't stop IBRLing. As you can imagine, there's a ton going on behind the scenes at both Anza and FireDancer that we couldn't get into today. In classic IBRL fashion, we'll keep the latency of this presentation short and get back to shipping and iterating. We don't do roadmaps, we do releases. It truly is ship or die. All right, thanks for listening. Tune into, follow us on X to keep up on all things Agave and FireDancer. Tune into the blogs. And as always, the real alpha exists in plain sight on GitHub. All right, thanks everyone. Thanks.
Excellent. Great stuff. Great stuff. That was a bar over there. We don't do roadmaps, we do releases. Not too bad. So one of my favorite things about the Solana ecosystem is that as difficult and complicated as the technology can be, the clarity of vision is very simple. This increase bandwidth, reduce latency. But we do this not just for fun or to nerd-stipe great minds like Brennan and Kevin. We do it because it makes the network better. It makes it more usable and more useful. And the best way to understand how useful Solana is right now is with one metric called network revenue, or REV. And our friend Dan from Blockworks has made a great little video to explain this concept in just 2 minutes, which we will show right now.
Real economic value, or REV, is a standardized metric that tracks blockchain value accrual generated on user activity. So ultimately, it measures the monetary demand to transact on a chain, which makes it a strong signal of where the users are and where economic activity is happening. The metric itself consists of both in-protocol transaction fees and out-of-protocol tips that users are paying for execution. And today, we see about 90% of REV is generated by priority fees and JITO tips. Both of these rails allow users with a time-sensitive demand to express that preference using a larger fee. And in practice, this means that contentious transactions, like trading a new token launch, let's say, will cost more while preserving sub-cent fees on USDC transfers. Now, the value generated by the product, which is ultimately block space, is programmatically distributed to the key stakeholders of the network. So through this, REV ensures sustainability. Last year, Solana generated about 1.4 billion in total REV, and about 40% of that was distributed back to the validators, who secure the network and ensure that it functions at its highest capacity. The other 60% was distributed to token holders, either by burn transaction fees or staking rewards. And in 2024, Solana token holders earned over $700 million in income. And this year, it's on pace to double that amount as Solana continues to solidify itself as the leading blockchain to build businesses on top of.
Yeah, pretty incredible stats over here. Clearly, the people, they want to use Solana. This demand is only going to go up from here as well as the internet capital markets thesis gets built out. And I'm deeply honored to bring on a dear friend of mine. He's the co-creator of Super Team, the reason that I'm in Solana, and many thousands of other people are on Solana as well. The NCMO of the Solana Foundation, and one of the boldest thinkers we have in crypto. Please make some noise for my dear friend, Akshay BD, everybody. Sweet, right?
All right, good morning, everyone. It's lovely to be here. Can we hear the size of the crowd through the auditory response here? Awesome, thank you. Thank you for being an amazing audience. I'd ask that the folks at the back come and take a seat. This will be worth your while. This segment has been curated over months of really hard work from the folks on the BD team, from the folks in the ecosystem, and I think you're going to get a glimpse into the future of what this space was meant to do for the last 15 years. And so with that, I'm going to kick it off with a talk about how we think about internet capital markets and what they are in the first place. You know, if you think about capital markets, today's capital markets don't work for everyone, right? Like everybody has a visceral sense of it, and people may reason into it from different places. But you can see, like, folks like Larry Fink talking to investment managers saying it's the most nervous their clients have been since you have these low bond yields, you have asset price bubbles, and people don't really know how the traditional asset allocation model works anymore because the 60-40 portfolio hasn't paid off for a long time. And we all get a visceral sense of this, right? And so it shows up in surveys as well. Like, 27% of folks believe that the American dream isn't, is still accessible to them compared to, say, over 50% 10 years ago. And we've seen this manifest in sort of like our politics, culture, and so the question becomes, if today's capital markets are not working for people, can we build a new capital markets on the internet that works for everyone? Right? And so here's one way to think about this. This is, in 1971, you would have to work 25 hours of median wages to buy 1 unit of the S&P 500. Right? Today, you have to work 195 hours to buy the same unit. And why do we invest? We invest so we can buy freedom, right, of your future. Like, you can buy your future back to do whatever you want to do with your life. And one way of thinking about this is your freedom is hyperinflating. Here's another chart, right? Median or average hourly wages have not kept up with the growth of capital. So if you were part of the people that owned capital or owned assets, then you have a disproportionate return on your asset allocation versus if you are just earning a salary. Okay, so what is the solution, right? And you sort of end up in a world where, hourly wages as a percentage of GDP has trended down, and the net worth of the top 1% as a percentage of GDP has gone up, right? And so this is an opportunity for us because this is not by design, it's by accident. It's because you have a massive public debt bubble because of which you need to keep bond yields low so you can borrow cheap and refinance debt. And that creates an accidental, asset price bubble. And so the question is, can we solve this? Because on a long enough time scale, especially as AI is accelerating, you're going to end up in one of two worlds. Vinod Khosla says AI will be able to handle 80% of jobs. And so increasingly, those wages will matter less. And so the question is, which way do we go? Is it universal basic ownership or universal basic income, where we're essentially creating a welfare economy to take care of those who aren't able to keep jobs or own assets? Or it's what we propose, which is universal basic ownership, where everybody with a mobile phone can own assets. And today, the only technological stack where that is possible, we think, is in crypto, and more specifically Solana, given the sort of the products front-run the promises in our ecosystem. And so an example of this is if you lived in Alaska, you get an airdrop of $1,700 last year. You got an airdrop last year from the profits generated from the Alaska Permanent Fund Corporation, from all of the natural gas and businesses there, right? That's an example of sharing the profits of the enterprise with the people who are part of building it out. And so that's what internet capital market means. It means we can solve this problem because we have an urgent need to put assets in the hands of people, or we end up in a world where the labor class and the capital class have massive tensions between them, which is all the symptoms you see in today's politics and culture. And so how do we put assets in the hands of anyone who has a mobile phone? You need to be able to reduce barriers for investors to own assets. You need to be able to reduce barriers for issuers of those assets. So let's walk through them really quickly. One of the things that has happened over the last 15 years is a lot of the gains have been in private markets because you have investors who are accredited investors, already wealthy investors, get access to these opportunities because there's not a lot of alpha in public markets. And therefore, they've crowded out retail investors, and their companies are going public later and later in their life cycle, right? With SpaceX and Databricks and all these companies. And you don't have the chance you once had to buy Amazon stock when Amazon went public and get 100x in public markets anymore. So private markets are private. Public markets are saturated. You're all investing in some version of an index fund. They're all overheated compared to valuation now. You either believe that they will continue to be because this time it's different, or we're all crowding into a smaller and smaller part of the public markets, raising valuations beyond what we think is reasonable. And you'll hear from speakers later today about why the passive investing trend could be a bubble. And 30 cents of every dollar you invest in the S&P 500 today, as if you're buying an index fund, goes into the Mag 7, so you're super concentrated, right? So all the retail investors are exposed to a small set of assets. The number of public companies has gone down by 50% over the last 20 years. So we have lesser and lesser things to invest into as retail investors. Not all public markets, though, right? What you see here is the number of token launches on Solana and the capital formation. And this is funny, but remember that this same infrastructure can be switched out to launch assets that are productive, that are by issuers of credit, debt, private credit, debt, equity, and a whole long tail of assets that don't exist today in capital markets, right? And the reason you need to do this is because we are hurtling towards a world where if you don't solve the labor capital gap that exists, you have violence on the streets. This is kind of why revolutions are sort of fostered. And we should take wisdom from history, right? And this is part of what we're working on. On one end, it feels inane, and it's all these meme coins. On another end, it's bootstrapping all this infrastructure where you can get companies to start going public directly on Solana, right? Like Uber wanted to pay its drivers in equity when they went public. They could not because of SEC regulation. Similarly, crypto has solved this problem. The way we have is, if you wanted US dollars outside the US, you either had to get cash, or you fill one of these long forms and get access to an offshore bank account. But today, you download a browser extension or a mobile app with a picture of a ghost on it, and you get access to US dollars unfettered, right? We've massively collapsed the ability or the barriers to own assets. But bearer assets are new. This is bringing back a practice we always had, where whoever held those bearer certificates, historians of finance here and enthusiasts will know that used to exist. Whoever held them owned the shares to the company. And so we're bringing back bearer assets, but digitally. And so the next part of the transformation on the financial side will be one where we can bring all these private assets that are in private markets and bring them onto Solana. All right, so that's on the investor side, where anybody with a mobile phone can own assets. This is on the issuer side. Today, it takes about $10 to $30 million to go public, which means a lot of the smaller companies who are super profitable don't have any incentive to go public because it's too expensive for them, and they have this high compliance burden, right? But we think in 5 years from now, you should be able to walk into a coffee shop, and you're like, I love this coffee shop. I want to support them. There's a QR code on the wall. You scan the QR code, and you buy a few tokens that entitles you to some ownership in the coffee shop, and you get streamed dividends every year. And that is an inspired vision for what capital markets should be doing for small businesses and businesses on Main Street, right? And so it is not Main Street versus Wall Street. It's rather getting Main Street access to the new internet Wall Street. All right, let's keep rolling. And today you have, of course, you have alternatives. You have regional exchanges. Those regional exchanges don't have a lot of liquidity and they're burgeoning, but guess what? They can get distribution by, you can go public on a regional exchange, which lowers the cost of compliance, and then tokenize on Solana, get access to a global bunch of investors. And of course, you also have like these exceptions that have always been there in law. We stand on the shoulders of giants where you could technically go mini IPO. The Jobs Act helped us get this regulation, but a technology stack was not available until today. We can cue the video real quick so you get a sense for what this world looks like.
When you have a model that heavily incentivizes private equity groups to basically be building these cookie cutter development complexes, dropping in a Whole Foods, dropping in a papyrus store, you're creating an economic development on paper that doesn't actually feel like economic development when you're walking down the streets of these communities themselves. My name is Nick Matthews, and I'm the CEO and co-founder of Mainvest. Small businesses are the foundation of the American economy, and access to capital is the #1 challenge that small businesses across America face. Mainvest gives communities, not corporations, the ability to build the main streets they want to see. Mainvest isn't crowdfunding, Mainvest is investing. People are coming on not just to support local businesses, but also as a means of diversifying their portfolio into a new asset class.
It was very difficult to get funding for a
All right, we can turn that down.
This is a great starting point. The reason why
we can turn the video down. Thank you very much. So what this gives you is entrepreneurs have tried this in the past. There was a company called Mainvest that unfortunately got shut down during COVID, where they tried to allow people to invest in their community businesses that were cash flow positive. And guess what? They didn't have the technology stack that was global that we do now today. And so we're very excited, as you'll hear from the rest of this session, to take advantage of some of those prior efforts that have happened. Of course, you have direct listings, and you'll see later in the day folks talk about why that's going to save you money. I want to get to the end state here and invite on the amazing speakers that are going to follow. The end state, I thought, was captured by this tweet that's kind of funny, but also true, which is sort of the way crypto tends to be. It starts with the inane and very quickly becomes profound. And it is this idea that, like, oh, tech finance is kind of vanilla. Jim Simmons gave us quant-driven trading. Milken gave us junk bonds. But what did Silicon Valley give us? YC safe notes with a discount, boring. Right? Wake me up when I can buy defense tech junk bonds collateralized by annual secondaries. I want to see Stripe employee option pools securitized and sold with triple leveraged exotic swaps. Right? That's a joke, but what gives you is the ability for you to financialize all of the productive assets in an economy so you can have anybody who participates in that economy be an owner of that economy. And that's part of what you're going to hear for the next 3 hours, and I hope you enjoy this. We're incredibly excited to think of what this dream about what this end state looks like. It probably is one where capital markets are a feature. They're seen as a good thing, just like you're now, as an Instagram user, it made everyone a photographer. So Solana will make everyone an investor or a trader over time as these productive assets in our economy trapped in private markets come onto the blockchains. So we hope you enjoy the programming for the next 3 hours. Thank you very much for having me.
Good stuff, buddy. Good stuff. All right. Was anyone surprised by how tall Akshay was? I thought he'd be much shorter after seeing him on my screen all the time. In any case, a great talk. We've gone through a few different segments so far today. We talked about the technological importance of ensuring that there's enough bandwidth and reduced latency for Solana to be able to provide the tech platform for the future of internet capital markets. We just got to hear about some of the philosophy and the strategic backing behind it. Now what we want to do is hear from some real teams that are building in this space. So it's my pleasure to bring on one of the largest exchanges in the world. We have Mark Greenberg, the head of the consumer business for Kraken, along with David Henderson, head of growth over at Bakkt. Make some noise for him, folks. Good stuff.
Hey everybody, I'm Mark Greenberg. I'm the head of consumer business here at Kraken. And like all of you, I'm mostly a crypto trader. And every time I go to trade equities, it sucks. Pretty archaic. And I always wonder, why can't I self-custody stocks? Why can't I trade them at 2 a.m. or on the weekend? Why can't I use stocks as collateral on-chain? And I'm not American. Why is it so hard to trade US equities from other folks in the world. And here at Kraken, our goal is to bring the best of crypto to all asset classes. We want every asset class to be permissionless, on-chain, 24/7, and built for everyone. And that's why I'm so excited to be here with my friend and our partner, David, from Bakkt. They're a Swiss-based startup who shares that mission with us to bring on-chain access to real-world assets. And when we met their team, we knew we had the same goal in mind. And so today, we're announcing something really, really cool. Permissionless, self-custodied, on-chain, built for everyone, stocks. And it's called X Stocks. I'm going to let a video play, and then David's going to share a little bit more details.
So, X Stocks is Bakkt's new brand for delivering tokenized equities to the world. Regulated, accessible, and built for DeFi. Designed to be developer-friendly and neutral, to work in your favorite protocols, apps, wallets, and exchanges. No need for new specific RWA chains. Don't worry, we're not going to do that to you. We're starting by tokenizing over 50 of the most popular US stocks and ETFs. And that's just for launch, that's just the beginning. With day one distribution, an extremely important thing. That's why I'm on stage with this lovely man here. This is going to be a game changer for tokenized assets, specifically how people access them. We've been having RWAs issued for a very long time, but still access to them is very difficult. And I'm hoping that this is going to really change that. Permissionless, self-custody, and built for everyone. And obviously, we're on this stage at Solana Accelerate in front of all you lovely people. We're proud to share that Solana will be an official launch partner for X Stocks. It's been excellent to work very closely with the Solana team to make sure that we have a full DeFi stack ready for these tokens at launch. What do I mean when I say a DeFi stack? I mean DEX liquidity, collateralized lending, and real on-chain usability. It's not enough to just tokenize something. It needs to be usable. Otherwise, what's the point?
Pretty damn exciting, if you ask me, David. And X Stocks, again, permissionless, self-custodied, on-chain, built for everyone, and launching on Kraken in the coming weeks. Really, really excited about this partnership, and we're looking forward to working with Bakkt and Solana to bring it to all of your apps and all of your experiences.
To have X Stocks have day one distribution by Kraken is, as I said, it's a game changer. I can't wait for this to be live. And obviously, we're very, very excited to have Solana and Kraken as our day one launch partners. But it's important to note that X Stocks are neutral. And to make this a true public good, we want to work with more exchanges, more DeFi apps, more protocols, on-chain decentralized exchanges, and chains to make sure we actually manage to completely transform how people trade, invest, and manage their wealth. So if you want to integrate X Stocks, and you're watching this or you're in the audience, please get in touch with us. We want to work with you. This is what the future investing looks like when it's designed and built for everyone.
Thanks, everybody. Looking forward to working with y'all.
Good stuff, buddy. Good stuff. All right, a massive announcement there. This is my favorite thing about crypto in general, where we are able to create real value for real people in the real world. Through Super Team and other efforts, we've seen many folks all around the world who are dying to get exposure to these kind of assets from everywhere. And having Kraken as a distribution partner and Bakkt to kind of build that out, I think is going to be a very big deal. I can tell you Jupiter will be working with them as well. Next up, though, we're going to go deeper down into this rabbit hole of everything that's happening with internet capital markets with two fantastic speakers. We have Arjun Sethi, who's the co-CEO of Kraken, and we have Raj Gokul, who is best known as a professional deadlifter, but also happens to be the co-founder of Solana. Make some noise to bring him on stage, folks.
How's it going? It's good. How about yourself?
Good, good.
Thanks everybody for coming out, and thank you, Arjun, for coming out. It really means a lot that you came, and congratulations on the announcement.
Yeah, thank you very much. I didn't know you were a professional deadlifter.
I am not professional by any means. Mert actually was professional, and he deadlifts a lot more than me. So yeah, let's get into it. We just had a huge announcement. Wall Street Journal, I think, broke the news less than an hour ago. You guys are launching tokenized equities on Solana. Tell me more about it, and what does it mean to you?
I think crypto's been pretty interesting over the last 10 years, where we started thinking about from Bitcoin to Ethereum, then we had altcoins. I think one thing that people kind of miss is we've also started getting into this aspect where we're creating walled gardens. And then when you create walled gardens, then the types of products that you can build or the types of products you can innovate on top of it just become harder and harder. And one of the things that we wanted to think about was, great, well, you have this 24/7 on-chain innovation period, but how do you starting to think about what another set of foundational trust layer could be? And obviously you think about collateral, right? You think about real-world assets, but as a part of real-world assets, you think about equities. And we had launched equities in the US a couple of weeks ago, but 6 months prior, or post-inauguration of President Trump, we wanted to really push and starting to think about what does tokenized equities look like? How do you think about collateral? How do you actually think about forward mobility for folks that are all over the world, not just in the United States?
Yeah, we've seen some attempts at tokenized equities in the past on chain. Can you tell me a little bit more about why now, and maybe how this initiative came about at Kraken?
I think in the past you just had fragmented liquidity, you had fragmented communities, and everyone was trying to again focus on building a product that was walled, which is, it's my experience, you got to come to me, I got to bring the incentives, et cetera, et cetera. And we see this again and again. And we were thinking, okay, well, what's the reverse process? How do we incentivize everyone to participate? And how do we make sure that we can bring liquidity, not just from a place that's one chain or one community, but global liquidity as quickly as possible?
Yeah, I know you've been talking a lot recently about kind of the meteoric rise of stablecoins and how the market cap has exploded. What do you think it's going to take to get tokenized equities to have that same trajectory?
I think, look, it may or may not work today. Our hope is that we can start the movement to have it work. But I think what's more important is that, what does it look like for someone to have access to collateral, capital, tokenized equities in Brazil? How do we get in India? How do we get in Indonesia? How do we get in Vietnam? How do we get in Turkey? And I think most of the conversations has been mostly around yield or sort of speculation, and sort of putting those two together and getting to a place where you can memorialize. Again, I go back to a foundational trust layer on top of a trust layer that we already have. I think it could be a game changer. And so, in the past, things haven't worked. In the internet ecosystem or the fintech ecosystem, it didn't work 15 years ago or 20 years ago, but we keep trying, we keep pushing. And I think between us, for what Solana is doing and what's Kraken doing, and what Bakkt is going to be able to help us sort of push through as an issuer, I think we can at least make the first step towards getting this out there in a way that's enablement for everybody, but not just for one company.
Yeah. So let's fast forward and say that the product really takes off. You see a ton of traction, a ton of liquidity, and that X stocks really kind of become the standard. How does this fit into Kraken's strategic roadmap longer term?
Look, at Kraken, we started off as an exchange, and in order to be able to promote Bitcoin, Ethereum, altcoins, stablecoins, we just continue to build out infrastructure. And so similar to how you think about Amazon, built Amazon Web Services for their retail, or what you've seen other companies start to build out, web microservices in order to be able to facilitate their core. We're doing the same thing. And I think last year I was talking through this to a set of investors, even to the other ecosystem, and they kind of just laughed and they said, well, that's not how fintech works, but it does. And it's not how financial innovation works, but it does. The whole point of crypto is that we're able to see things very transparently. It's decentralized. It is open source. You can innovate as quickly as possible. And there's no reason why companies like us can't morph to do that, where we're building a set of microservices, building a set of micro products that can continue to scale out because we're wanting to build the best products, not create walled gardens.
Can you tell me more about what the user experience is going to look like? What's different this time around with tokenized equities in Kraken? What people will be able to do on day one with these assets?
Yeah, I think take Kraken out for a second. What you want to be able to do is take your collateral, whatever it is, anywhere you want. So no borders. It's 24 hours. You don't have to ask anyone for permission. And you can take that collateral, and ideally, you can do something with it. So if you are looking to go get credit, you're looking to go get loans, if you're looking to pledge that collateral, I think that's how we foresee what the world can look like. And we just want to have Kraken help enable that more than anything else. And it doesn't have to happen on our platform. It can happen on any platform. It can happen on Coinbase. It can happen on Binance. It can happen on any other competitive landscape. It can happen on a DEX. It can happen on Radium on Solana. It just doesn't matter to us. We could just list out every protocol that's out there. Ideally, it should be free and accessible to anyone, and that's what we want to be able to help enable. And I think it's kind of funny, we just made the announcement a couple minutes ago, but we've already got the Xdocs meme coin going. So I think part of it is setting the movement up for success.
Nice. Yeah, it's been great working with you guys. I think the appreciation for actual open source ethos and commitment to open finance versus building a permission walled off garden to start with is what really set Kraken apart. So that's why we're excited to work with you.
Yeah, same here.
Nice. Can you tell me more about kind of how you see the internet capital markets trend playing out? What sort of equity assets you expect to see on chain, maybe besides the obvious ones?
Look, I think I'm forgetting the gentleman's name prior who talked about internet capital markets, just capital markets, how many companies there were 20 years ago versus what we see today. I think, look, in every market there's a power law. In every liquidity market there's a power law. And so, but what you want to be able to have is that the long tail can continue to build, continue to innovate, so that they can be a part of that power law, right? We talk about the Mag 7s, who knows, might be the Mag 20, might be the Mag 3. Doesn't really matter. I think it's more about what can we help enable to promote innovation at the end of the day. And so the way I foresee what the future is going to look like is we shouldn't be thinking and talking about thousands or millions. We should be thinking and talking about what innovation looks like on the billions. Like there should be billions of tokens. There should be billions of ways in which we can innovate on top of that. There's no reason why collateral should be defined as one aspect of how we see the world. And I think a lot of people make fun of meme coins and altcoins, but it's a form of expression. We're trying again and again, and we're getting into a way where it's becoming more standard to talk about it, where it is permissionless. I can just walk around with it. And so when I think about the traditional apps that are out here in the US, we think about Square or Robinhood, Wealthfront, et cetera. But everything is just very specific to those applications. And so I want to be able to send or move around with a token, whatever it might be. And so I know we use these terms, digital tokens, digital commodities, digital securities. But I think what's more important is that there's a foundation. I can take that foundation. It's secure. It's mine. And I should be able to take that anywhere I want, at any given time. And I should be able to use that as a secure way for me to transact in whatever way that transaction is going to be. So if I want to buy a house, that'd be great. If I want to lend it, that'd be great. If I want to pledge it, that'd be great. If I just want to loan it to you right after this, I should be able to do it.
Nice. I totally agree. I think, I remember back in 2021, before there were NFTs on Solana, and I remember our doors getting knocked down, and it was mostly traditional artists. And there was a question of, is there going to be a market for all of the art in the world to come on chain? And what we found pretty quickly was there were millions of other artists that came on chain that didn't know they were artists until there was a global marketplace for their art.
Right. Yeah.
And then we saw the same thing with meme coins. It wasn't just internet memes. There became internet capital market native memes that explore the design space, and there's tens of thousands of new launches. So this is the first time since that 2021 period where our doors are getting knocked down in the same way by people that just want to launch things on chain. And I kind of expect to see the same thing. There's going to be, probably 100x the number of assets that people are expecting to come on chain. What do you guys think about at Kraken as far as what Kraken's role is in that long tail of assets? Where are you going to position yourself strategically?
Look, there was a promise a long time ago around what it meant to be an anything exchange, which basically means that you could provide anything liquidity. I think we want to help provide that. We want to help enable it. And it doesn't have to happen in the way in which people see traditional markets, traditional exchanges. We think NYSE, NASDAQ, but we should be thinking about global liquidity and access for everybody. So I take a step back. You said NFTs. NFTs in the industries is thought about as a negative Nancy, like it's like a no-no word. And we're starting to use other forms of expression to talk about the same thing. But the point was that we tried. Some of it worked, some of it didn't. We took a step back, and now how do we take 10 steps forward? There's no reason why NFTs can't work. Again, like we use the word NFT, but like non-fungible token. What does that mean? It just means that we can tokenize something, and we can move it with us. And do we want to be able to provide liquidity for it? Do we want to be able to provide security for it? Do we want it to be yours? That's more important than anything else. So, like, I'm excited about a day where the house that I live in, well, I don't own a house, but in a house that I could live in the future, that I can own and I can walk around with it. There's an asset somewhere. It could be art, it could be jewelry, whatever it is that it's mine, no matter where I take it. And I think that's a promise of what crypto was, and it could still be. But like, how do we start from a place where it's more natural for us to think about it? We think about real estate, we think about equities. And so when we think about the ways in which equities are broken today, as my colleague put it, what are ways in which we can fix that aspect? And we can think about what real-time settlement looks like, real-time security looks like, and real-time non-permissionless looks like.
Awesome. There's a ton of consumer product builders here, people that have built apps that have gone viral before. They've been standing on the sidelines of crypto. They're now looking at crypto as ready for prime time. There are policymakers here that are looking to enable those founders to build new products. What advice do you have for maybe a small garage team that is looking at X stocks being issued by Kraken and wondering what they can build now?
Look, I think the way we should be thinking about any of this is similar to how we think about open source. Keep pushing us, to be honest, with what we're trying to do on behalf of the community. Same for you guys at Solana. And what are ways in which we can help vertically integrate some of their innovation, but at the same time help enable them to be successful. It doesn't have to be just us. So I think everyone has a tendency to think, hey, the big guys or the bigger chains or the centralized exchanges are zero-sum. We're not. Like, if the garage door developers can be successful, it makes us more successful. And I think what you see for a lot of the chains that are out there, they are, or at least from the centralized exchanges, and we've taken a different approach, is that you got to build with us, you can't build anywhere else. That's not how we think. One of the reasons why we're partnering with you guys is to be able to show that it's not about being zero-sum. We have our own, we're contributing to the Ink Layer 2 ecosystem. We're working with other folks. We want them to be just as successful, and we don't have to launch our innovative products only on our chains. We can launch it with you guys. We can launch it with a bunch of other folks as well. So the more we can do that, the more we can promote that a developer can be successful with us, I think we all win.
All right. Well, that's our time, but I just wanted to thank you again for coming out, and thanks for the announcement, and really, really excited about the product launch. And thank you all for coming. Thanks for listening.
Thanks for having us. Thanks, man.
See you guys in a bit. All right, a major announcement over here, and a very exciting one indeed. Internet capital markets continuing to get built out in a bunch of fun different ways. Tokenizing equities is one of those ways, but the beauty of being on chain is the type of innovation that it's going to release. And up next, we have a speaker who's going to be talking about a novel way to approach the asset issuance on chain that is actually even better than traditional rails, not just from a liquidity perspective, but also from a regulatory perspective as well. Please make some noise for the chief strategist over at Simplify Asset Managers, Michael Green. Where is he? There we go. That's fine.
Thank you.
Okay, well, it's great to see everybody. I'm dressed in my TradFi terrorist outfit, so you can identify where I'm coming from. I want to actually spend some time talking about what I think the future of token is, like Bitcoin, and the thought process behind what I would largely argue is a bunch of speculation. I do think that tokenization is the future, that digital securities are really important, and that actually is really critical because the simple answer is that TradFi is actually dead. It just doesn't know it yet. Mutual funds are now in decline despite asset appreciation. ETFs have taken their place for now, but as an ETF provider, Simplify, which has grown from about $200 million to about $7.5 billion in assets, I will tell you the asset class is lacking in true innovation. All we're doing is adding leverage. We are taking existing products and recasting them. So the point that I would make is that mutual funds are dead. ETFs are dead and don't know it yet. They're the classic grandma in the attic, dead, not yet buried. Tokenization is in its infancy, and it is the future. Digital tokens are really the key. The most important thing to understand about what's actually going on is that while TradFi appears incredibly robust, it's largely a mirage that is being driven by how we are investing. So the simple answer is passive investing, buying the S&P 500, participating in a 401k program where you're pushed into a target date fund is not passive. Passive means you never transact. Every single time you put money to work in your 401k plan, buying stocks, you are pushing them higher. We have removed the discretion about how to value assets. This is causing prices to rise, even as the companies themselves are increasingly forced into competition they didn't anticipate and forced into conditions that ultimately are causing them to invest unproductively. Right? This is not the focus of my presentation. I encourage you to look up my work. Simply Google my name and passive investing. You will find all sorts of stuff on it. It's worth understanding that we are dying even as we appear to be growing. When passive strategies become too large, all we're basically doing is we're giving systematic algorithms control of the process. When they get too large, they create their own endogenous volatility, the market thins out, and you create a crash. When I first discovered this, I saw it around the world for the markets that were most penetrated by passive. I realized there was something called the inverse VIX ETF complex. I placed significant trades against it, highlighted the opportunity. Nobody believed me, which of course you can understand, and predicted that the XIV ETF would go to zero on a 4% decline in the S&P. On February 5th, 2018, I'm not sure why it says 3018, that's a little bit aggressive, it went to zero on a 3.9% decline in the S&P 500. Right? Was never supposed to happen, but this is what happens when you outsource to algorithms that are not actually thinking about what they're supposed to do. Now, ironically, we have always had cryptographic tokens. A dollar bill is a cryptographic token. It carries a serial number, it carries significant anti-counterfeiting components. A stock certificate, Enron, for example, is also a cryptographic token. As has been pointed out, it gives you ownership in shares in an enterprise that ultimately was lying about what it was doing. Does that sound familiar to tokenization advocates? We are doing X when you're actually doing Y. The current process of securitization is basically you come up with a product idea, you then have to conform it to regulators, and then in the classic Richard Feynman sense, it's just lawyers all the way down. Right? Enforcement is focused on after the fact. I can actually raise a fund, I can say it does X, it can do Y, and if nobody complains, nobody finds out until the product either implodes or I'm celebrated afterwards for having done something that nobody thought I was actually doing and I made a whole bunch of money. Right? That's a terrible strategy. What we need to do is actually recognize that tokens are securities. But because of the way we're approaching regulation, because we're trying to go around regulation, our design constraints are that we have to stay below the Howey line. That means in order to avoid being labeled a security, we have to avoid profit-sharing mechanisms, managerial promises, governance rights, and enforceable obligations. In other words, everything that makes an investment interesting. These are not investments. These are collectibles. And just like collectibles in the .com era, what we're doing is we're trading them on glorified eBays. Right? That's really what is going on so far. If we're going to change this, we have to move from where we are right now, where we're talking about wrapping TradFi products and tokens. And to be very, very clear, my firm is in the process of doing this. We will be introducing our first tokenized ETF, in other words, wrapped TradFi. They'll be coming from Simplify this year with partners like Alpha Ledger and Plume. Our partners are working with the Solana Foundation. This will begin the process of offering US citizens diverse ways of investing in TradFi assets without going off-chain. But that's not the exciting part. The exciting part is the digitally native securities, right? Creating products in which we've embedded fiduciary capability for truly unique products. This can mean a mortgage that is originated on-chain, but it can also mean that you're taking traditional claims against companies, putting them on-chain. Akshay gave the example of a coffee shop that has a QR code that allows you to instantaneously buy a share of that. My observation, Akshay, is what you've actually done is create an incentive for me to subsidize a coffee shop, spend $100,000, fit it out, hire a bunch of fake customers, so that everybody thinks it's an absolutely fantastic opportunity, and then have a QR code on the wall that allows you to buy shares at $1 billion valuation. Right? Nothing in there actually stops that unless I actually turn the token into a fiduciary asset that discloses in advance everything that you're actually buying. And we now actually have the technology stack that allows that to happen. We have AI that can function as our own individual fiduciary litigator that says, hey, guess what? This token that says it gives you ownership at a $1 billion valuation of a local coffee shop. Does that seem sensible? No, it makes no sense whatsoever. Therefore, you probably shouldn't buy this thing, right? We change regulations from an environment in which we're thinking about, am I conforming to the letter of the law in my filing application, to one in which the regulator is simply able to say, does this do what it says it does? In other words, truth in labeling, more like a functional FDA than a securities regulator. You should be able to promise almost anything you want, but if you're going to promise it, you should be required to deliver. And that is the whole point, right? We are a social species. Trustless does not exist. It's a marketing scam for collectibles. Trust me, bro. Right? The philosophy of trustless and censorship resistance and a governance that is informal and plutocratic and a use case in which we're just trying to do value storage or speculation, that's not actually allocating capital. Code is law is not correct. What is correct is that we should be engaging in a trust-enhancing and a stewardship-oriented token. We should be focusing on how do we actually prevent companies from doing what they shouldn't be doing with your money. That can be done in a digital token era. Effectively, each individual token becomes its own sentient bank account that says, are you using this in the manner in which you described it? And if you aren't, it should automatically send an alert to the investor that says, hey, that Mike Green is a kind of not trustworthy guy. And if Mike Green wants to do something that's not on there, I should be required to reach out to my investors and ask them to vote. Should we change the mandate? All of this can be accomplished today, right? What we want to move to is an environment in which the law itself is encoded. The law is code. We want to be in a position in which we are capable of doing enforcement, of preventing bad actions before they happen, simply by virtue of entering into a contractual relationship in which you are limited as the end user from being able to do whatever you want with the money once you have it. The money ceases becoming totally fungible. It actually becomes directed. When we do a corporate share issuing, we often talk about use of proceeds. Imagine if use of proceeds that said this money can only be used for AI investments. Or this use of proceeds can only be used to build a factory in the United States. There's no reason we can't do that today, right? But we have to embrace it and approach regulators from the standpoint of we can do this better in cryptographic and in digital tokens than we can in TradFi, in which I fill out all the right forms and I use all the right language and I conform to the 40 Act or I conform to the Jobs Act in terms of the issuance of securities, but then I go off and do something totally different with the money. That's absurd. We're past that point. When we think about being a social species, trustless does not exist. It's a marketing scam. I don't know why that didn't play. Let's see if we can go back and do it. No, well, I'm not going to do it. That's the scene Vinny from the movie Good Will Hunting, in which he says, trust is life, right? Okay, trust is not life, but trust is an integral part of being a social species. If I want to invest in your product, I have to trust you. We should be using tokens to enhance trust, not simply saying, oh, you should have done your work on that, man. Okay, so what is a fiduciary token? A fiduciary token is a programmable digital assets designed to embed the fiduciary obligations and legal accountability directly into the token architecture, rather than relying on external institutions, i.e. SEC, or discretionary enforcement from the Department of Justice. Right? Those are overburdened institutions. If we want to introduce innovative products, we need to make their job easier, not harder. Don't spend our time trying to run away from them. Embrace what they're actually trying to accomplish and show how we can do it better. The objective here is to reintroduce trust, stewardship, and legal logic into a financial system that's currently dominated by regulatory standards focused on what you can say and then ignore what you actually do, until, of course, problems occur. Post-event enforcement is overloaded by a regulatory system and a court system that candidly won't see any clarity for years. Why has it taken so long to work through the FTX bankruptcy? Right? Shouldn't be happening that way. Right? Regulatory arbitrage. We actually just had Kraken up here on stage talking about tokenizing equities. Where will they be tokenizing and offering them? Offshore. Because really what the rest of the world needs is a greater opportunity to invest in US stocks that currently make up 55 to 60% of global market cap. That's absurd. Right? It's a novel and it's an innovative approach, but it's designed to skirt regulation rather than work with regulators to enhance the system. And then the last part is technocratic abstractions, right? What is a security? Well, this is not a security. This is a security. This is not a security. This is, like, that's absurd. The objective of investments is to position yourself for an ownership share and a stream of profits and cash flows from those. Pretending anything else is just not make any sense whatsoever. So as we talk about a feature set that's matched to purpose, and I want to be very clear, I am not a developer. I am not a programmer. I cannot do this. I'm asking you to help me, right? And if you're willing to help, I'm happy to work with you, and I'm happy to promote your work. But the simple reality is we need to embed the governance logic. The token enforces rules. If I tell you I'm launching an ETF in tokenized form that invests in large cap technology stocks, and I suddenly try to start buying government bonds, it should tell you, hey, this guy's drifting. He's doing something that is not right. And I should then have to approach you and say, I'd like to change the strategy because I don't think the opportunity set is there, and you can vote to get your money back, or you can vote to actually allow me to do it. It's up to you. But that's the entire point of agency and ownership, is you should have a vote other than simply the exit vote. AI-readable legal standards. All the documents should be translated into AI, and it should immediately identify that it conforms to everything. We can use zero-knowledge proofs, by the way, to do all sorts of stuff without exposing things in a HIPAA-compliant type manner, which is how you should approach your financial future. All I care about is, do you have enough money to pay the bill when I check your credit? I don't actually care what you did with all your money. Right? The same underlying component should be associated with a company that claims it's a blockchain specialist but is actually a Subway shop in New Jersey. Right? Regulatory mirrors, tokens mirroring existing legal frameworks to make them legible and enforceable by code. Again, I shouldn't be able to do things that are illegal with it. Built-in recourse mechanisms, automatic triggers for dispute resolution. He tried to do something, that triggers a vote. I can get my money back, or I can continue to allow him to hold it, not doing what he wanted to do, sticking with the original plan, or I choose to vote and allow him to do it. Programmable use of funds. This is a really astonishing one. Again, if you think about this concept of the use of proceeds, imagine municipal debt that is issued that says this is going to be used for school construction. Right? In a tokenized framework, it can only be used for school construction. You can identify the vendors that are actually in that process. You can audit it on a real-time basis. Right? All of a sudden, the slush funds are gone. You're actually enforcing the behaviors. And so with only 7 minutes of time, that's where I'm going to wrap up. I encourage you all to think about embracing the regulation, approach regulators from the standpoint of they were trying to do the right thing. They are simply overwhelmed. So stop asking them to chase you like Keystone cops and instead show them you can do it even better. Thank you very much.
Very good, my guy. There we go. All right, an early contender for one of the most banger talks of the conference. I think that was a lot of fun and a new way to think about things. I see some heads nodding in the audience as well. Quick programming note. I see a lot of folks standing all along the back. I'm pointing at you all right now. There are tons of empty seats. Well, maybe not tons, but there's a few empty seats, at least up front. Those are the most comfortable chairs, so feel free to make your way forward and get close because you're going to want to be up close and personal for our next panel here. We've talked about kind of tokenized equities, potentially fiduciary tokens, and new ways of organizing how capital is formed on chain. Our next group is pushing the boundary even further than anyone else. Superstate has been working on native asset issuance on chain for a little while now. And here to talk about a very exciting announcement and where they're going next, we have Robert, the CEO of Superstate. We have Michael, the chief strategist at Sol Strategies. And we have Jason, the head of trading over at Galaxy. Big announcement coming here. Put your hands together. Let's make some noise.
All right. I'm pleased to be sitting alongside two legends. Why don't you quickly introduce yourselves and what your company is in the business of?
Hi, everyone. Marco Hubbard, Chief Strategy Officer at Superstate. Sorry.
I'm at Superstate. You're at Sol Strategies.
At Sol Strategies. Oh, forgot where I work. Sol Strategies, we're one of the first public companies offering exposure to the Solana ecosystem on traditional exchanges. I'm very excited to be exploring how we can bring our stock to trade on the blockchain.
And I'm Jason Urban, the global head of trading at Galaxy Digital.
How much Sol do you each own in your companies, respectively?
Ooh,
it's a lot, right?
Oh, we can say because it is public. I think we have about 395,000 Sol at the moment. Yeah.
On our books, we disclose it publicly, so you can look that up, and we obviously manage large positions for our clients as well.
So big Solana ecosystem members. We're here today to talk about equities and financial assets moving on chain. And very recently at Superstate, we announced that Sol Strategies was going to be one of the first companies that we're working with to take your company's equity, which currently trades in Canada and one day soon in America as well, and allow it to trade on Solana as well as a publicly registered equity. First question, what's your motivation to be a company that trades in multiple different venues, especially one that trades on Solana?
So Sol Strategies, last year we pivoted to a full-on Solana-focused strategy as a company. We're very big Solana bulls. We love this ecosystem. We run validators. We stack Sol as much as we can. And it doesn't make sense that our stock doesn't trade on Solana because that's the best venue for it. So for us, we think that it makes a lot of sense that our stock should be tradable 24/7 at a low cost on the blockchain, settle instantly. There's just so many pros to that that it's the obvious next step.
And Jason, if we start to see stocks like Sol Strategies trading on Solana, how do you think as an asset management firm that has so many different functions, how do you think that your firm could interact with tokenized Sol Strategies?
So when you think about what we do, we kind of touch, like our strength and our weakness as a firm is that we do everything in the ecosystem. And so as we think about more and more equities moving on chain, securities moving on chain, I think there's a role for us to play at the base level of validation and things of that, all the way through to what I'll say are more TradFi lookalikes, where it's simply market making and holding the peg, so to speak, because I think that we can't undermine what we all believe is the right thing on chain by having two separate prices, right? I think it's important to have parity across all venues.
Right. If something is trading on the NASDAQ and on Solana simultaneously, the invisible hand needs to keep those assets, both liquid and trading in line.
Exactly. I think that because it undermines, the trust, the belief that this is the same, if all of a sudden one is disparate from the other. And that takes capital, that takes an infrastructure, that takes multiple players. It isn't just one person's job or one company's job, it's many. And I think the good thing is that, the groups of people are starting, you guys have done an excellent job of bringing people together in that regard to allow for that to happen.
Yep. One of the things that is being talked about a lot here at the conference is the idea of internet capital markets and new capital markets. So from the perspective of the issuer and the perspective of a trading firm, what does it mean for there to be a new capital market, right? Is capital going into companies directly? Is it just creating liquidity for existing investors? How do you think about the role of a new growing capital market for public equity?
I think it's so interesting how we would potentially be able to raise equity on-chain, settle directly on-chain, potentially in Sol, not just in USDC or USDT, but also being able to explore other financing methods such as on-chain bonds or special share classes, and being able to pay out dividends on-chain as well in future. So internet capital markets is more than just a analogy or a placeholder. It's something that truly can replace some of the traditional rails in raising funds and interacting with the shareholders.
I think as you think about the capital formation that everyone goes through, you want to get into as many pools as possible. I think as you start to look at what traditional finance companies are doing, they're going to embrace the blockchain. They have to. And so it just makes sense that you're going to see capital formation move to those places because it's better, it's easier. As soon as they get comfortable with it, that's where this will go. Yep. And so it's just a natural extension.
And just to add, another very important factor is that traditional exchanges are very much focused on a single country or a location. And on the blockchain, we are acting on a global scale. So it unlocks a whole new region and area of capital formation and capital raising.
Both of your companies went public starting in Canada. Why?
Well, for us, we have a background. Cypherpunk Holdings previously went public in Canada in 2018 and was a kind of a broad-based blockchain-focused company. And then last year pivoted to Solana. So our roots are in Canada from the ground up. That's where we are. Yeah.
Our journey, started a long time ago in a different regulatory regime, and so I think water kind of finds its crack. And so some of the things that we did at the time were because where we could go, and now that we're seeing a change or a thaw in what is happening here in the States, it's just natural for us to make that progression.
Yeah, my hope as somebody that is looking to bring a lot of equities to Solana is that, in the same way that companies might have, found Canada a welcome venue to start trading because of lower, exchange requirements and an easier regulatory landscape, that eventually Solana becomes the platform where companies first go public, before they're ready to reach the New York Stock Exchange. When Galaxy went public, originally, it probably wasn't ready for the New York Stock Exchange yet, even though it is today, and it's ready for the NASDAQ today, right? Yeah. And that things can start to go public earlier in their life cycle, as opposed to what typically exists, where companies are going public when they're tens of billions of dollars, and they're ready for major exchanges. There's a middle ground, and the middle ground is on-chain.
Yeah, I mean, I think if you think about the on-chain component, that's very comfortable for all of us, right? I think that a handful of us are going to be the gateway that brings this to everyone, right? So where it becomes more usable, more comfortable, and not something that, we're seeing it now. There's 500 million people in the world that own crypto. They're comfortable with that. It's a network effect that's just going to spread and multiply in time. And so it's just a natural thing for this to move onto the blockchain. And then which blockchain, it's a function of throughput and some of the things that I think a lot of people here understand the value proposition that Solana brings to the table.
Yeah, I mean, I agree. There's definitely a network effect that can form, which is when there's more issuers and there's more DeFi integrations and there's more users and they all start building together, it's going to snowball.
I mean, just imagining a world in which you can trade stocks on Jupiter is incredible. And if we can get to that point, I think we're going to unlock so much more value for all the users on the blockchain and all our shareholders and all issuers that eventually come and trade on chain.
Yeah, I agree. So what do you think are the hurdles right now from the perspective of an issuer, from the perspective of an asset management and trading firm? What are some of the more difficult pieces in the journey to bring stocks on chain?
I mean, dealing with the traditional regulators is definitely a big part of it. And the good thing is that regulators, for us as a Canadian company, also currently working on uplisting to the NASDAQ, so we're dealing with regulators both in Canada and in the US. The good thing is that we've found regulators to be very responsive and supportive of our efforts on both sides of the border. And the big question is essentially, how do traditional structures of filings and submissions and all the different actors that a pubco has between transfer agents, trust companies, and the regulators, the OSC or the SEC respectively, how do those interact with a listing on-chain, and which rules transfer and which don't, and what gaps exist?
I mean, I think your point about traditional structures is one that we should think about, more focused. Where are the pools of capital? We are a $3 trillion, $4 trillion asset class today. Where is that going to be in the future, and where does the capital currently reside, and how do we access this? It is definitely going to be a movement up the technological chain as we pull those assets here, and that's why this is so important. And it's something that everyone understands. You see it leads the news cycles when the markets are down or when the markets are up. It's on everybody's mind on a regular basis. This is just going to naturally funnel more and more of that, into our ecosystem, and we need to embrace it and find ways to work not only with the people who control that capital, but also the regulators so that they're comfortable and allow us to create systems that bring technological innovation into these capital markets.
Yeah. Jason, do you think your job gets harder as a trading firm when stocks are trading in more venues and at more hours and across the globe?
I think that people always want more options in the sense of, we would look at it in the markets, why is crypto selling off on a Sunday, perhaps? Well, it's because all the other markets are closed and some negative geopolitical event happened, and so you go to where there's lit markets, where there's things that you can trade, because it's a risk-off moment or it's a risk-on moment. And so having more venues, having a way for us to continue the democratization of finance, I think is very important in terms of where we go as a community, as an ecosystem, and what that will do in the years to come.
When stocks are trading on Solana, what do you think is going to be the most mind-blowing aspect of it from the perspective of an issuer or a trading firm?
Sorry, could you...
What's going to be the most surprising aspect of your stock trading on chain?
I think it's going to be really interesting to see how the stock behaves on chain outside of regular trading hours on the traditional exchanges, what Jason was mentioning as well. How the traditional exchanges are going to respond to price action that occurs over the weekend or overnight on chain. But I think a big thing that excites us, aside from the 24/7 trading, is the ability to access the global market. and expand our shareholder base, where someone in Malaysia or Indonesia or Peru or Bolivia or wherever can really easily own our stock or own any stock on Solana, which would be very difficult to do in traditional brokerages.
The one thing that I'll be curious to see how it plays out is you have different, today you'll have different investor bases in those places, and their behaviors are different. And how does that, as we bring those two things together, eventually it's going to be homogeneous. But the first of us that are doing this are going to be, there is a bit of an experimental nature to it, which I think is natural and is good. I mean, that's how innovation happens. And so the behaviors of the buyers, the sellers, the traders in each of those respective places, I think will be interesting. And the fact that there isn't a lot of bridges today. So a TradFi firm that's providing liquidity in a TradFi venue is going to be different. Now there are players, the Jumps, the Janes, and so on and so forth that are in both, but there are a lot that aren't. And so how that evolves, what opportunities that creates for many of the people in this room, I think it's going to be a fascinating journey.
Yeah, I mean, right now what I'm most interested in is the fact that stocks, the way they're traded today, they basically sit in a brokerage account, and that's the beginning of the story and the end of the story. And by coming on chain, suddenly they're composable with DeFi applications, and they're programmable, and you can create radical new experiences. And so, I'm really curious to see, in addition to trading 24/7 and trading, around the world with much broader capital access, the new things that haven't even been built yet to take advantage of equities.
100%. The new things that haven't been built are going to be, what do you do when you tokenize your Apple stock and you take it and you now drop it into a DeFi or an AMM or something else, and then what happens? And that's a little bit when I talk about the behaviors of the different systems, because that's never been contemplated in a TradFi setting. Like, they don't have that. Like, yes, you can take it and you can put it into a custodian and it becomes a collateral object that you look at, but it actually doesn't do anything. We're talking about a marriage of technology and capital formation, putting that together and then allowing it to do something. That's exciting.
Yeah, I agree. So, Michael, as a company that is going to be traded on Solana one day, what do you think of, in terms of the ability to raise capital? Like, do you think it's going to be similar to the way it works today, where a company files a shelf statement and they sell equity into a market? Do you think it'll do the same thing with DEXs? Do you think that you would come up with new ways to engage an investor audience? Like, what do you hope for?
So it's interesting. There's basically two ways to think about it. One is, how do we see in the current framework what we could do on chain? And that would require a shelf statement, a Reg D issuance, or a private placement. That's something we could do on chain pretty much right now. And that's something that would be very interesting and something you could settle in Sol or in any token. So it doesn't necessarily be USD denominated, which is really exciting. But going forward, and the second way of thinking about it, in the future, how can we potentially do kind of a token sale? It's exciting to think about other ways that you could deploy or issue stock on chain and allow kind of democratized access where people can come and bid or participate in a future raise. So I think that's definitely something that's in the future, and how we get there is going to be very exciting.
Assuming there's the proper disclosures and information, do you think you could airdrop stock to users on a blockchain?
Well, that's why this will really depend on where we see things with regulators going and what they ultimately feel comfortable with.
I think one point there's the regulatory element, right? But then there's also channel confusion that you don't want to create, because the offerings need to be uniform in both venues. And so I know that you're doing an excellent job of thinking through those elements as you guys, as we all make our journey here, to be careful what I say. And so as you start to think through that, how are you going to not advantage or disadvantage a particular constituency? And that's challenging. Like that's why the smartest minds in the space are working on this, because it is so important.
Yeah, I mean, we've talked a lot about regulators in this short panel so far. this is, obvious that, at least in the US, the regulatory landscape is one that's much more innovation focused as opposed to, limiting in its actions. Do you think that the same applies across the globe right now? Like when you think about, how you see this evolving for equities, not just based out of Canada or the US, do you think the global landscape from regulatory perspective is improving? Do you think it's staying the same? Do you think that US becomes the hub of crypto innovation again? Like, how do you think this plays out, Jason?
I mean, the U.S., like we've pushed our best and brightest away for so long, right? Like, look at the people in this room. There are many of my friends in crypto that said I won't even come to the States. And I think that as we start to think about bringing innovation back and creating, it makes sense, and it's a national security thing for the United States, because this is where a lot of capital is formed. This is where people bring their companies, they start companies, and so we have to make a landscape and a rule set that makes it easier and makes it more thoughtful as we start to think through what this is going to look like for the next generation of builders, innovators, thought leaders, and so that we can continue to be a shining light on the hill as opposed to a capital markets backwater, which we don't want to become.
What do you each think is missing right now from the ecosystem that's necessary to make equities on a blockchain like Solana work? What do you think is still like the missing piece, if there is one? Or do you think now is the time and everything is ready and I
think it's really just clarity on where do we stand with the regulators, with compliance. And I mean, to the previous question as well, I think the US is undoubtedly leading the way. And it's really important because if the US sets the tone, I think other countries are going to follow eventually. And the key piece that's really missing at this point is just clarity on, like, are we actually allowed to do this? We think we can, and we're pretty certain that some of the things we can. But I think that we're on a good path where we hope to get that clarity very soon, and all systems go.
No, I mean, was having a little trouble hearing your question on that one. So,
is there anything missing from the ecosystem
missing
right now? Or are we just ready?
I don't think anything's missing. I think we need to get it. We need to scale things appropriately to be able to handle the volumes that are going to come. The sheer amount of transactions, the amount of money, all of those things. Like we have to take these great ideas that we have and just kind of. And that comes with time. That's muscle memory. That's all of us trying things, finding out what works, what doesn't, and then that will scale.
Great. Well, I'm looking forward to seeing both of your stocks one day trading on Solana. The future is going to be extremely bright.
More to come on that front. I have.
Yeah. Thank you.
All right. Good stuff, guys. Good stuff. Let's see it. Cheers, cheers. All right, folks, we got another few talks before we head off into lunch here. As you just heard, the opportunities when you're able to bring some of these traditional assets on chain are pretty massive. There's all sorts of benefits from composability and remixability that you can do in DeFi. And so there's a massive opportunity for builders across the space to kind of fill in this gap. And our next fireside chat here is all about that. This is exactly for the builders in DeFi and those of you in TradFi who want to understand how to bridge the gap. So we're going to have a little bit of a navigation session between these two different worlds, and hopefully everyone will leave with a better understanding of how to make that happen. To do so, we have two just incredible speakers. We have David, the co-founder of Drift and president of the Drift Foundation. They've been doing incredible work on the institutional side. We also have Cynthia, the head of the digital asset management practice over at Fidelity, from the other side of the table. Please give them a little round of applause as they come on stage right now. Let's go.
Thank you.
Good morning. I'm delighted to share the stage with Cynthia today from Fidelity. I think today is truly a melding of worlds. I represent the DeFi side, and Cynthia more so the traditional finance. But before we get into it, maybe a quick introduction from you and what you do at Fidelity.
Sure, this is great. Thrilled to be here today and actually amazed at the amount of energy there is in the room. we at Fidelity have been working in the blockchain and digital asset space. We say this for probably over 10 years now. We started doing early research in the blockchain space back in the 2014-2015 timeframe, and that early research ultimately led to the launch of our custody business, which was several years after that. And the digital asset management business, which sits in the asset management side of Fidelity, we launched formally within asset management about 2.5 years ago. And the intention of what we're looking to build is very much, I think, in line with this conversation today, and why it is that we've had conversations with quite a few builders in this space, in the DeFi space, as we are looking at ways to be able to bring not just digital assets and digital asset exposures to our investors, but also being able to leverage on-chain capital markets. And I think we heard the phrase internet-based capital markets earlier today. We think that there are so many opportunities to be able to conduct financial activities on-chain that would ultimately lead to more assets being tradable across the portfolios that we manage for our clients, and engaging in financial applications on-chain to generate yield in new ways, and finding those new sources for yield is also incredibly interesting as we think about how it is that we are constructing financial solutions. So really excited about this conversation today as well.
Fantastic. I want to set the scene. Crypto today, obviously after BTC's all-time high, sits at approximately $3.5 trillion, but TradFi is closer to 40. And obviously, this is an imbalance. These pots are not the same.
Yeah.
Maybe we can start by setting the scene for even something like settlement. On Solana, I'm expecting settlement to be under a second. When Coinbase takes 30 minutes to deposit my Solana, I get really cranky. But then when I speak to traditional allocators, that's very different. I mean, even 1985, the settlement time was T plus 5 days. Whereas if you put a trade in on Monday, you would fill it the following Monday, which is insane to all of us here, but was very much the norm.
Yeah, it is incredible. If you go back and your point about in 1975, the standard settlement time frame from the moment in which you executed your transaction to the point at which you paid for your transaction and it cleared was 5 days. And today, as of last spring, our markets have now in the US moved to a T plus 1 settlement cycle. And that is over the course of 50 years, we've been able to compress that settlement cycle. What I think this actually says, though, is about the ability for traditional financial markets to be able to leverage technology, and leverage technology in ways that will help to improve the efficiency by which we're able to move capital and to settle transactions, the way in which we are going to be able to construct portfolios and be able to manage personalized investment portfolios at scale. All of this is enabled by technology. And so when we see that moving assets on-chain is going to continue that progression of improving the efficiency and allocating capital and being able to create new product structures that allow us to pool capital and create more personalized investment experiences, this is the innovation that continues to take place throughout asset management and throughout capital markets. And so, as we continue to think internally about what blockchain-based capital markets might mean for the future of financial services, this is a conversation that is taking place across many asset managers, banks, and broker-dealers. And I think now with the regulatory environment here in the US, specifically addressing this potential for innovation and now wanting to nurture that, this is an amazing time to be having conversations. And so I think a little bit of what we talked a lot about was how do we have these conversations where we can bring traditional financial institutions into the on-chain capital markets, and what do we need to do in on-chain capital markets to bring more institutional engagement and participation?
So it sounds like three key things to distill. One is speed, the second is cost, and obviously the costs go down. I think the most important thing is the reduction of counterparty risk when things are faster, going from T+5 to T+1 days, but then to everything on-chain, which is T+1 second maybe. What does that look like for you when you think about moving assets on-chain? Because I do think there's more functionality that you see on-chain that you otherwise wouldn't get. So there's this world of what I think is financial transformation that can take place.
I think one of the things that is important to keep in mind about this technology is it provides great flexibility and optionality. So just because you can settle a transaction in T+1 second or T+5 minutes or whatever the block time is, there's a diversity of transactions and asset types across our capital markets. And it isn't necessary that we need to move everything at the same exact speed. I think that's also something that has been helpful as we continue to think about market integrity and counterparty risk, is calibrating the technology and the ability to move capital alongside of what are we trying to achieve. Fast and velocity is good for payments. Because those are instantaneous in terms of being able to settle that particular transaction. For some of these other asset movements, moving more of the processes that historically have been a big part of the impediment and why it takes so long to settle certain transactions, improving that efficiency in processing is going to be tremendously beneficial. Is it going to get us to immediate settlement for every asset type? Perhaps someday that will work, but I do think that this is also going to be incremental as we are bringing more assets on chain and wanting to ensure that at the same time that we are going to benefit from the efficiency, we're also going to continue to maintain market integrity.
So on market integrity, this is like a fantastic segue onto trust, which I think underpins a lot of our financial system today, to DeFi, which is very trustless at times. And with trustlessness, it's not free. It comes with over-collateralization. So how do you think about that? Because whilst you have a trustless element, it's somewhat inefficient.
There is, I think, a lot to unpack in how it is that capital markets work today. It is very much based on trust. In order to engage in a transaction and in order to be able to transfer an asset from one holder to another, there's a set of terms. It is a contract that is effectively being created and executed in order to transfer that asset. And in the way in which this technology will facilitate trustless transactions is you now understand and you've seen in the code what the terms of that transaction are, and that is what you know as you are engaging in that transaction. And so hence, you know what the terms are, you know what the price and the conditions are. You can see that being done instantaneously. DeFi markets have both the over-collateralized type as well as the under-collateralized type. The over-collateralized type is where you are posting more collateral than the value of the transaction, and that is a way to facilitate trust. And then I think that is what you were getting at, where there is an inefficiency of capital. If in order for you to be able to engage in a permissionless transaction and to be able to rely on the counterparty being able to settle that transaction instantaneously, you need to post additional collateral in order to demonstrate that trust. Is there a way to get to a point where you can see more efficiency in the way that transactions can work in the DeFi ecosystem without having pre-funding or overfunding of your collateral positions?
So when we get to building trust, if obviously a bank on the other side or Fidelity is my counterparty, I feel a lot better than a pseudonymous address on the web. But when we think about even identity standards, KYC standards, for instance, that's very, very tricky because by nature, the ethos of crypto to date is trustless, you don't need it. But as we come almost full circle, we see more institutional engagement. It almost feels like there is either a hybrid or some type of standard that has to exist. Maybe not in a walled garden environment, but within perhaps, say, a wallet infrastructure.
Yeah. You're asking some really interesting questions about how we can bring more registered assets, registered securities into the on-chain financial markets. And what we think is incredibly exciting about the continuing development in this technology is the ability to find a way to automate the verification of your counterparty such that you can transfer that registered security to a verified counterparty in an automated way that is secure and is not going to require that you are sending your individualized personal information across every single transaction. And so how do you build a more automated system where we can see identity tokens that have the ability to demonstrate the provenance of the owner of that asset and that wallet address, and to allow for a more trustless way to be able to automatically affect that transaction. And that is where we're not quite there yet, but we are very encouraged by being able to see not just the technology, but global regulators becoming more aware of these assets being cross-border and now wanting to find ways to be able to allow for the effect of cross-border transactions.
Absolutely. And as Solana embraces this internet capital markets thesis, a lot of it's going to come down to asset issuance, issuing new assets on chain, doing IPOs on chain even, as we heard from earlier today. Is that a reality that's going to come around, or will it take a lot longer?
For assets to
do asset issuance, IPOs on chain, away from what we've been used to for the history of how public offerings have been historically done.
Yeah. I think the idea of native issuance of tokens on chain is not as far off as we might think it might be. I think that is a reality. I think where we've seen guidance come out from the SEC in just the last week, recognizing the ability for transfer agents to be able to maintain records on chain, that is tremendous in being able to move us forward and being able to leverage new structures for capital formation on chain, which then will lead to more efficient native issuance on chain. The clarity coming from the regulatory environment is also going to help the institutional participants to build that infrastructure necessary to be able to bring those assets into their back offices and be able to process those assets, digital assets, and the traditional assets side by side. I think that is part of the next phase of this integration as we move more and more assets and transactions on chain.
Absolutely. And the final thing I want to end on, and I want this to be a relevant takeaway for everyone in the audience. I mean, selfishly as a builder, I've also struggled to speak with institutions, and sometimes it's too far up in the air, too far abstracted, sometimes it's too low in the weeds. What is the best way for these two different worlds to just get better at communicating with one another?
Yeah. That's such an amazing place to start from the question of how do we bring the two worlds, traditional financial institutions and DeFi founders together. I think ultimately we have a shared vision and a shared goal in wanting to see improved and broader access and availability of capital and of assets and financial services to more users. And how do we then have the conversations around what are not just the benefits of what a what a user will be able to get on chain, but how do we adapt to what the financial institutions are also very mindful of from a governance and a regulatory standpoint? And I think having that as alongside of all of the benefits is a great place to start.
I think that's a fantastic piece of advice, and I think as we start to slowly migrate that 40 trillion assets over to what is our very fast-growing pie that can't be ignored, I think there's a lot that needs to happen, and I think conversations like this really kickstart that. So, Cynthia, thank you so much for taking the time, joining me on stage, and sharing your insights with everyone in the audience today.
Thank you so much.
Mike goes this way? Mike, this way?
That way, yeah. All right. Excellent conversation with a bunch of insights. I think it's easy in crypto sometimes to get lost in the small technical details, but here, great conversation about where the growth is going to come from going forward. We're going to switch gears a little bit right now when we talk about the value of crypto. Oftentimes, number one on the list is the value of self-custody. The first self-custody wallet I ever had was a Ledger, which gives me... Anyone here own a Ledger? Can I just say? Yeah, all right, a bunch of folks. Well, you're going to love this next conversation between Dan Albert, Executive Director at the Solana Foundation, and Ian Rogers, the CXO over at Ledger, and they have an announcement to make. So don't go anywhere. Make some noise to welcome them up on stage, folks.
What's up, man?
All right. Good to see you. Good to see everybody.
Hey, everybody.
So, you're at Ledger. Ledger has been the longest-standing hardware wallet to ever support Solana. I've been around the Solana project for a very long time, and Ledger has supported through your hardware wallet for self-custody of Sol users actually longer than the entire Solana network has been around. You guys had Solana support before the mainnet launched. Curious if you could kind of share a little bit about where you see Ledger's role, and always, of course, appreciating all your support for Solana throughout all this time.
Yeah, I mean, we are super proud to support Solana, and we always have been. The way that Ledger works is it's an operating system and an open development environment on top of secure hardware. And so that's how we can get to this great support early, like we did with Solana. We're a very early supporter of Solana, early in staking. It took us longer to get SPL and token support, but it's there. Not only is it there in the retail product, but it's there on the enterprise side. So we really want to support the entire Solana ecosystem, both retail and enterprise, and security all the way through, right? So that when you make a transaction, you are approving on a secure screen. We know that self-custody is important. There have been multiple incidents in our world where we've really felt the importance of security and self-custody, and that's what we try to do, is to just make it super easy to use, but keep you secure.
Right, and I think something that always want to make sure is understood, right? Like self-custody is, I think, the cornerstone ability of crypto, right? If you don't have self-custody, why do we have blockchains at all?
Yeah.
Right, and obviously there's all sorts of solutions that people are finding in the middle ground, but this is, from my perspective, like it's the absolute cornerstone of individual ownership for internet capital markets, for digital property, to protect property rights, that one must have the ability to self-custody, to hold your assets directly. And that's why it's so important when we talk about security and with hardware products like Ledger, that people are able to do this in a way that is safe and convenient and apparent to them what they're doing. So one of the things we've been talking about, as you mentioned, is clear signing, making sure that users understand, well, I've got my private keys on my Ledger. What can I actually, what is the transaction that I'm signing, right? What can I do? So maybe can you speak a little bit about sort of what that's looking like these days in Solana or perhaps other ecosystems, just to make sure that everybody knows.
Yeah, so I mean, what we always like to make people get their head around is, if not self-custody, why crypto, right? I mean, we're building the future of finance, and I think for everyone needs to really think about that question. If not self-custody, then what is different in what we're doing? There is a new invention here, right? The new invention is digital private property. The internet was this revolution of information, and we have a revolution of value that's going on, this once in humanity digitization of all value that everyone here is building on and is at the heart of. But if that's the case, then, then security is paramount. If you have digital private property that you could lose, and lose pretty easily, lose in a snap, then security is really paramount. And what do you need to be secure? Well, you have to have your private key generated by and stored in a secure element. The cryptographic transaction that you're making has to happen in that secure element, not in some insecure piece of hardware. And you need to be able to visualize that transaction on the secure screen. So this is a Ledger Flex. These are Ledger Stacks. And what the magic trick is that this screen, this touch screen, is actually powered by basically the same chip that's in your credit card. So when you're touching this screen, you are interacting with a secure chip, not a chip that was built for performance, but a chip that was built for security. And then comes clear signing, because you need to be able to, you can't just be looking at hexadecimal. The last step in the transaction can't be YOLO, I think I know what I'm doing. It's got to be, no, I know what I'm doing. I can visualize it on a secure screen. So that's why everything you do inside of Ledger Live with Solana, whether that's sending or staking or the swap, we have you can swap SPL or tokens inside of Ledger Live from self-custody to self-custody 100% securely with clear signing all the way through, and that is crucial.
Awesome. Yeah, that security all the way down the stack and clear signing is just it's existentially important to the technology that we're building, the ecosystem that we're building, and the community that supports it. So speaking of community, I know you had something that you wanted to share with our Solana community here.
Yeah, are you guys ready? We have a little something to share with you first. First time we'll share with anybody.
Let's make some noise.
All right, we set up a little video. Well, let's show it that way. Could you please run the video? There you go, guys. This is the Solana edition Ledger Flex. So Ledger Flex is the device that we introduced last summer. It's our newest touchscreen device. So this is the secure touchscreen that I was talking about a moment ago. And we did what is basically a Solana colorway for you, but it comes with a soulbound token. And it's really meant for the community. So we have 3 windows of buying that are for Solana holders only. We're starting with Saga, Seeker, and Super Team members are going to get the first crack at it with $70 in Solana as a rebate. And then we have a window coming with other partners. Then we'll go to the whole Solana community before we go to the general public. I think for us, what we love about Solana is, the community is extraordinary. I went to Breakpoint last year and was just blown away by the focus on user experience and the focus on community. And for us at Ledger, that's what we focus on as well. Like, our job is to bring security and self-custody to people with user experience. We're always just trying to make it easier to use without ever compromising on security and self-custody. There are lots of people that are willing to compromise on security, self-custody, or both. They usually say onboarding the masses somewhere in that, but we know where it leads every time. So we try to do it without doing that. So we have these at the Ledger booth over here, and this will be the first time anyone will be able to have them. And also with the best price and the best bundle, they come with a really cool folio that you'll be able to get. So we hope you enjoy it. It's for the community. Thank you very much. And help us give back to the people who have the Soulbound token, please. If you have an idea of what we could be doing with the community with these Soulbound tokens, we'd love to talk to you today.
Yeah. Thank you, Ian. That's awesome. And I think maybe we can just touch a little bit more on this sort of Soulbound token thing, because it might be a newer concept for some folks. So this is a token that can be redeemed that is uniquely tied to a particular purchase or activity or device, right? So if I go and I purchase a Solana version Ledger Flex, I can get this token, airdropped or moved into my wallet, whether it's the Ledger wallet or specifically to the Ledger wallet, right? No other wallet.
When you claim it,
Yes.
it goes to the wallet that you claim it with.
Right, and that token will never move, right? It's not allowed to be moved. And so that is my permanent proof of ownership of the device, at least on the wallet. But most importantly, as I think you said, it's like proof that I'm an early supporter. I'm an early adopter. I'm a member of this community that really cares, right? And these are the kind of users that consumer products like die for, right? These are your super users, your diehards, your brand ambassadors. And we've seen with the early Solana mobile phone, the Saga that came out a year or two ago, right? The soulbound token that allowed airdrops and all sorts of really interesting on-chain behaviors that came organically from the community, not from the mobile team, right? They just said, here's your token because you're an early adopter and we love you. And people just mobilized a ton of projects around that. So,
yeah, look, I spent 20 years in the music business, and having that direct connection with customers is magic, right? And the Ledger customers are a particular group, right? We have, in the world of crypto, we've sold 7.5 million Ledger devices to probably somewhere on the order of 5 million people, and we protect about 20% of the total market cap of crypto. So these are the 5 million people that have 20% of the market cap. So if you're an application in the Solana community, and just like as you're saying with Seeker and Saga, those people are yes, it's proof of ownership, it's proof of purchase, it's also proof of early adoption.
Yes.
As you said, and those are really valuable customers, and so yeah, we're really looking forward to seeing what the overall community does. It gives us a way to be really directly, directly interact with the Solana community. We've done that a lot in the past, even hosting super team events at our headquarters. So but this gives us an on-chain way, to be tied to that community, and for us to be able to work with partners to give rewards to people who store their Solana with Ledger, and we're protect their Solana with Ledger. So yeah, we love it. We love this mechanic. I mean, first of all, I love the design.
Yeah.
But it's great to have that soulbound token to build the direct connection with the customer.
Yeah. That's incredible. And yeah, just like so many things in real world and in crypto, community is everything. And it's just so exciting to see with Ledger and soulbound tokens and so many of these type of projects that are experimenting and exploring with new ways of building community and connecting with your community around whatever thing that you find important. In this case, self-custody, probably the most important aspect in all of crypto. And so yeah, it's just really incredible to see. So
I mean, I would say congratulations to you guys and to everyone in the Solana community. It's just been incredible to watch. I mean, you guys put on a show that looks like a consumer show to me, and I just think it's incredible. You guys are focused on user experience. You're focused on real world applications of this new invention. So this is our way of participating and showing our appreciation. So
amazing.
Congratulations.
Yeah, well, congratulations on the launch. Go check out the Ledger team at their product booth.
I'll see you at the Ledger booth, guys.
And thank you all very much.
Thanks, Sam.
Cheers.
It's great. I can't wait to get my hands on that myself. Looks super cool. All right, folks, we're rounding in. Lunch is going to be happening in just a bit. But before you go anywhere, we got one last talk that I think everyone's going to be super excited about. Doesn't need much of an introduction, but I'll give it to him anyway. Austin is a lover of many things, a lover of cats, of photography, and of building a faster, more performant internet for high-speed blockchains to be able to utilize all over. So please put your hands together for Austin Federa, co-founder of 00.
Hello, I'm Austin Federa, one of the 3 co-founders of 00. Thanks for coming out today. So what we are building is a high-performance new internet optimized for distributed systems. And when we say a new physical infrastructure network, what we mean is physical fiber cables under the ocean, running on top of mountains, through valleys. We're talking about the physical lowest level infrastructure that actually powers the internet of today, as opposed to software overlay networks or other types of systems. So this is a purpose-built network for high-performance distributed systems. So we're going to get into a little bit of what that means. So new base layer infrastructure, right? This is like, I can't hit this point enough, because what we're talking about here is the core fabric of how most modern companies use the internet today. The spoiler is they don't actually use the internet. They use something alongside the internet. So this is an alternative physical pathway for things like consensus, state propagation, transaction fulfillment, RPCs, validators. This is not an L1. This is not an L2. We're calling this thing an N1. It is a network layer that is a new physical underpinning for all high-performance distributed systems. You can't deploy smart contracts to it. You don't even get servers from us. This is instead of talking to the public internet, your system talks through the 00 network. And you might ask, why do we need this? So the internet was not built for high performance, and it certainly was not built for blockchain. So what you're seeing here is a simplified version of a network latency graph over time. And so the orange and the yellow represents ping times, the amount of time it takes to get a response from a server when you send a request to it over the public internet. Now, we've actually run this test, and you can find a much more detailed version of these things on our Twitter accounts and on the website. But what you see here is a lot of variability in ping times. Each one of those dots represents one measurement. And so what you see here is latency varies dramatically. This measurement is called jitter. It's the lack of determinism on the public internet. This is caused by all sorts of things. This is caused by traffic merging, different systems talking to one another. You basically back up packets in a queue. And what happens when you back up packets in a queue? They slow down. And when systems slow down, we can deal with actually a lot of latency in high-performance systems. What we can't deal with is a lot of variability. So when data comes in out of order, you have to wait for it all to come in and then assemble it in the correct order. And so this is really a network, the internet, which was built for resiliency, not performance. And this blue line on the bottom, this is actually measurements we've taken on one of the testnet components of the 00 network. What you can see from this is it's an extremely consistent performance. And so that means if you are going to send like a transaction to a leader, you will know how long it takes to get there. That is not the case today on the internet. There's a huge amount of variability in that. And we are not the only ones who thought of this idea. In fact, most high-performance networks are not actually run on the public internet today. You may look at this list and think most of these are internet companies. And that's true. These companies do operate on the internet. But the majority of the networks they run, the majority of the way they move data around the world is not on the public internet. It is on a parallel physical network to the public internet that they run. You may notice jump trading up on this list too. If you've read Flash Boys, the same dynamics that sort of powered that industry of using dedicated fiber to be faster than the public alternatives for trading stocks, that's basically taken over the entire mindset of both the financial service industry and other industries as well. Google has invested huge amounts of money in private fiber. Meta, which, again, Meta is a software company, but they're one of the largest investors in private fiber infrastructure nowadays, not out of the goodness of their hearts, but because they want to sell ads to people. And in order to sell ads to people, you need to serve them fast Instagram videos. But it's not just these companies. Thousands of organizations around the world either own and manage or utilize private networks for their content delivery. And it's time we bring the same to blockchain. But the answer is why, right? So for years, the biggest limiting factor in blockchains was the software packages. Back in 2017, 2018, if you downloaded a software client, even like Geth from Ethereum, and you ran it locally, you could not get over a few hundred transactions per second. Today, we have FireDancer and Agave, which can both hit over 1 million transactions per second in testing environments. Now, testing environments are never indicative of real-world performance entirely, but a huge reason that we see this massive delta between what's theoretically possible and the sort of 7,000 transactions per second we see on Solana today is that the public internet is the limiting factor in how fast you can run these systems. So what do? Do we try and make the public internet better? Do we go around to all these internet service companies that started in the 60s and 70s and 80s and ask them to please optimize their systems for blockchain? Well, we could do that, and some are trying to do that. But instead, we're starting from the ground up. We're starting from the principles and philosophy that have made high-performance networking the default standard in the private industry and bringing that to crypto. But we're not doing that in the traditional way. So high-performance networking at this point is not optional. It is absolutely essential if we're going to see blockchain systems compete with TradFi systems and centralized Web 2 systems. A classic example of this is every time you load an ad on a web page, there is a real-time auction to bid for that ad impression. That is an extremely high-performance system. We need the capacity on blockchain to move one of the largest financial markets no one talks about as a financial market onto crypto as well. And also, the private networks that exist today, they're not network effect institutions, right? If Jump builds a private network for trading, if Amazon builds a private network to send data around, that doesn't actually benefit anyone else. But the thing that's so interesting about 00 and our approach to this is there's too many places in the world for any one company to connect. So we have multiple independent network contributors contributing to this big network graph. This gives us characteristics that we care about in blockchain, like verifiability, censorship resistance, the ability to have these positive sum relationships of people who would normally be competitors working together to build a high-performance network for the future of blockchain. And why do we need 1 million transactions per second? Why do we need 100 gigabits of global bandwidth connectivity? Because there's nothing in the history of technology that has ever taught us that enough is enough, right? Your phone gets faster every year. Developers think of new things to do with them. Your bandwidth gets faster every year. People think of new things to do with them. And this is really because, at its core, entrepreneurship is driven by cost reduction. If you can 10x capacity and you can bring the cost down by 10x as well, you're going to have entirely new use cases that no one felt was possible before. So this is our Mars mission. Bring high-performance networking to crypto. And we need to do this. This is not optional. If we really want these systems to compete with TradFi systems, if we really want 1 million transactions per second or 10 million transactions per second on one global state machine, we need to embrace high-performance networking the way every other software company and every other software industry has done. And this really is like the superpower of capitalism, this abundance mindset. The ambition of crypto today is too small. We have Kevin Bowers on stage this morning talking about 1 million transactions per second. That's a great start. Let's 10x that. Let's get 10 networks that can operate at 500,000 TPS. That is the vision. That is the mission. That is the goal. There is never too much capacity or too much bandwidth. And when we increase bandwidth and reduce latency, we enable entirely new use cases we never thought were possible, and quite frankly, no one can envision today. So the message and the takeaway here is competition is back on the menu. If you're competing with big tech today, you're building on their servers, you're building on their rails, you're using their internet pipes. It's not a level playing field. And so if we can build an alternative physical network, other people can come on and build compute networks like Solana has done. People can build storage networks. We can rebuild the entire stack of the Web 2 enterprise in a permissionless way with verifiability, with censorship resistance, with independent network contributors. But it has to start at the base layer. We can't start with the grand vision on the software side. We have to go back to the basics and say, if the physical capacity of the physical fiber lines is not sufficient for the system can't work. Zero-knowledge proving is great. ZK compression is great. These are all band-aids on top of the systemic problem, which is the public internet is not performant enough to live up to the morals and value structure that we think blockchain needs to be built on. So this is 00. Our testnet is up and running at the moment. We are launching this fall. We are launching with full support for Solana, which is going to be very exciting to see because Solana is one of the few networks where the validator clients are able to do significantly more than the public internet allows them to do today. And we're here in New York for the first time. We're here at Accelerate. And one of the pieces that I think is really important about this is bringing crypto back to the United States, making it a competitive environment for entrepreneurs and not forcing entrepreneurs offshore. So we actually worked earlier this year with CoinList to do their first regulated token offering in the United States since 2019. And to talk a little bit more about that, we're going to have the CEO of CoinList, Raghav, come up and join us. Thank you.
All right, let's see if we can figure this out. Good afternoon, Accelerate. I'm Raghav Galati. I'm the CEO of CoinList, and we are excited to be back in the US. America is still the gold standard for capital formation. And at CoinList, we came back last month, excited to bring back vetted token launches to 330 million Americans, so they no longer had to wait by the sidelines. Still a lot of work to do there, though. We were excited to work with 00, who's a phenomenal company because they're kind of what's best in crypto in terms of a credible team building ambitious infrastructure and applications. But if we're going to scale this grand experiment, CoinList and Solana need to be a lot more than the home of the best. Sorry, that's the slides. The best in crypto. We need to enable markets everywhere. And critically, we need to bring on-chain products, companies that have product market fit on-chain. And so as Akshay's research shows, as capital becomes a feature, everyone becomes a trader, and any asset becomes a financial asset. And that's the building block that we need to be able to bring this next stage of companies on-chain. And so why Solana? I mean, we're all here because we believe it's the decentralized NASDAQ, sub-second settlement, 1 cent fees. And so, we believe in this vision. It's the place where the next set of great capital assets will happen. And why CoinList? Well, it's simple. We want to be the on-ramp. We helped launch Solana. We worked with 00 to come back to the US. And we're going to bring on-chain the next generation of revenue-generating companies that have product market fit. And we're excited about that. And so the call is simple. Founders, if you are tired of regulatory uncertainty, 10-figure IPO invoices, and bad token launches, come talk to us. Validators, if you care about revenue and performance, run 00. Investors and users, if you believe in the American dream, sign up with us today. Thanks.
Then, yeah? All right, it's so funny. All right, everybody. That is going to do it for the East Coast stage this morning. You can go grab some lunch right now. Come back over here at 1:15 for the next set of talks and a much better looking MC who is not me. I will see all of you later. Thanks so much for coming out.
Solana Accelerate will begin shortly. Please silence your devices.
Hey everybody, what an incredible morning so far. Hope you're all having fun. I'm Nick Dukoff, Head of Institutional Growth at the Solana Foundation, and I'm going to be your MC for the next few hours. I hope you left a little room after lunch because we have an incredible afternoon of content to digest. We're going to start with co-founder of Solana, Anatoly Yakovenko, founder and CEO, Jeremy Allaire of Circle, and executive director of Solana Foundation, Dan Albert, talking about the past, present, and future of Circle. It was less than 5 years ago that the first dollar of USDC was minted on Solana. Today, there is over $10 billion of USDC on Solana. An incredible journey so far, and it's just getting started. Please welcome to the stage Toly, Dan, and Jeremy.
All right. Welcome back from lunch. Hope you're digesting. Thank you both for being here. So it's 2025. Solana Network launched totally in early 2020. And later that same year, Circle launched its first USDC on Solana. I was wondering if you could both kind of take us down memory lane a little bit. Like, Anatoly, from your perspective, what was the importance of having the support of Circle and the launch of our first stablecoin to sort of Solana's early success?
Yeah, I remember talking to their team from my 800 square foot apartment. I was literally on top of the dishwasher with a laptop showing them this program we called Break, where you can smash your keys and you can show how a transaction gets confirmed in like 1.2 seconds. And the fees were like, sub 1 penny. And at that time, Ethereum fees were, in dollars, and transactions were taking, minutes to confirm, going through the mempool and everything else. So it was pretty fun. It was very humble beginnings, and I was really excited about USDC because I think having an asset that is extremely low risk in a digital platform, in a smart contract platform, is what allows developers and applications and protocols and everything else to take more risk and to actually, for finance to work and all these things to actually happen that we want to happen in digital platforms. So it's a critical component, and there's no way to build it without something like Circle.
Yeah, I mean, I remember very well, obviously, our vision was always that over time, that with a dollar digital currency on blockchains, that the kind of marginal cost of storing and moving value would go to zero. And that was like a founding vision of the company. And we were always really, trying to find the technology that would basically let a protocol for dollars on the internet work for any scale of kind of payment transaction from, literally, and I think we talked about machine-to-machine payments. Now AI agents are doing that today, but from like the smallest streaming payment that could be a fraction of a cent to multi-billion-dollar capital markets transactions that are happening where capital efficiency and speed and latency are super important. And so Solana, as a sort of next-generation blockchain at the time, was super compelling from that perspective. And I think we were watching as many of the DeFi primitives were starting to come into the ecosystem, and it was like very clear like this was going to be an extraordinary user experience, amazing for developers, and could actually fulfill what we wanted. And I think actually a lot of our early conversations were about, basically like, could you actually replicate capital markets on chain, and what were the building blocks to do that? And I mean, that's what brought us together to execute together.
Yeah, it only took 5 years to, I think, get 80% of the way there.
Getting there, totally.
Yeah, so we're 5 years in. Obviously, Solana has grown a lot. Circle has grown a lot. We're seeing like record levels of stable coins minted on Solana. We're seeing record levels of transactions and payments and remittances and DeFi. So where in your mind are we at in the mainstream adoption moment? And what else needs to get done? Is it, well,
yeah, sure. I mean, I'll take a crack. I mean, we've said for a long time we need basically infrastructure that can support like the scale that's needed for mainstream applications, and I think we're basically like we're almost there. I mean, it depends on what scale you're looking for, but we can now build mainstream applications on infrastructure like Solana that works for hundreds of millions of users for different kinds of applications. So there's that. I think the second is like the user experience. And we do live in a multi-chain world, and we do live in a world where gas fees are complicated and wallet infrastructure can be hard. But I think we're now seeing these abstractions that basically allow people to deliver UXs where you can instantiate an experience, you can have kind of sponsored gas, and you can kind of use cross-chain primitives that exist now as well to like take away a lot of that complexity for users. So the UX, I think we're almost there. I sort of think about like, will there be apps that can have like 1 billion users that support stablecoin native UX? And I think now we probably can. And then legal certainty, which was I think probably one of the biggest unlocks, right? So having this new stablecoin money as a fully reserved money, that's a new portion of what we think of as M1 money that is actually legally recognized in the global financial system, and that basically financial firms, companies, public companies, households will be able to utilize. When we have that, then I think this can scale pretty massively into the the enormous TAM of electronic money, which is over 90 trillion globally. And that, the Genius Act in the United States, is on its way to passage, and I think is going to be the federal law, and that's a huge unlock for everyone here. I think for basically on-chain money becoming the best money in the world.
And totally, same question to you. We've seen all this growth, all this adoption. We're starting to see regulatory movement, as Jeremy mentioned. What else needs to get done to continue sort of realizing the vision? When you and I talk, we often talk about the blockchain, the tech, and IBRL always making Solana the network faster, particularly with so many new entrants, both in the blockchain space and also new entrants in the stablecoin space. How do you feel like, what needs to happen for Solana to continue to lead and to differentiate itself?
I think so. I think the purpose of blockchains is, or why they're successful, is that they remove risk. They actually make finance less risky. Bitcoin provides really robust settlement guarantees everywhere in the world. Ethereum smart contracts gave you verifiability, so you can actually examine what the code is doing. You can analyze it, and how the money that you're moving through, how it's treated by the risk engine in a lending protocol or something like that. So that transparency eliminates risk. We were able to combine both of those things and also add speed and cost by expanding the bandwidth, the amount of information that the network can process and handle. That also eliminates risk for finance, because if you're a market maker or a trader and you have variability of how long transactions take or how much they cost, you now have risk when you're dealing with markets that are live, and you have positions at risk and things like that. So this is, again, like, I somehow got really lucky as an engineer that I get to work on a fundamental physics problem, and every time we get an improvement, it actually expands, makes the product better, expands how much stuff you can do on the network and the kind of finance and financial applications you can build. So it's not just it's now easy to pay for coffee with USDC. That's maybe like a low-risk transaction that a person does, and they don't really think about the risks involved of sending that $5, whether that $5 is real, is it actually in a bank. All that stuff doesn't really matter for that point-to-point coffee transaction, but those risks, if they exist, they start adding up, and then you can't have $10 billion that are flowing through finance in a single state machine. It's the elimination of that risk is what actually allows you to expand the capacity for finance. And that's really cool. This was something that when I started Solana, I just didn't understand at all. I came to it as an engineer, just looking at messages and speed and latency, and how do we get these bits across from point A to point B.
So with the remaining time, let's sort of look a little bit into the future, right? Where we've come from, where we are. We are using this phrase a lot, hearing this phrase a lot, particularly in Solana circles these days, of internet capital markets, or the on-chain economy, the financialization of everything, right? A lot of grand-sounding phrases. I'm curious, like, what does this idea of internet capital markets and on-chain economy mean to you? I'll start with you, Jeremy. And what does this look like in 5 years or 10 years? And what is the role that Circle and stablecoins have to play?
Yeah, I mean, I think about this all the time. And when we first started talking, and we did some earlier podcasts, this is all we talked about. And I think, from my perspective, I mean, what we want to do is we want to basically take the core primitives, the most base primitives, kind of the closest thing possible to government obligation money, like cash and treasuries, and basically express those as like building block layers. So we have kind of real money issuance. We want to make sure that you have kind of internet capital markets basically create a way to have kind of real-time convertibility between anything to anything, really. And so we're starting to build, effectively fungible in-kind create redeem between yield-bearing collateral and cash with USYC and USDC, and that's a really important next kind of layer. And then I think from my perspective, there's obviously like investing in ownership in things, in property, whether that's equity or other things. I'm personally extremely interested in what I'll kind of call endogenous capital markets. So capital markets that are developed that are endogenous to the on-chain economy. And so the more that stablecoin money is used for working capital, the more that stablecoin money and yield-bearing collateral is used on-chain, the more that you can form credit natively on that. And so I think about, like, what does the world look like where you have internet-scale credit markets that maybe look, feel, behave more like AdWords as a marketplace platform, but something that can deliver credit. And that's, for me, that's probably one of the most exciting things in the future for internet capital markets.
Got it. Totally. What's your vision? What are your thoughts on this?
My kind of North Star litmus test for this is, can like a founder do the Linux from scratch version of an IPO, where the public markets that they want to create for their equity are smart contracts that are immutable. It's a public permissionless chain. It is effectively like all the intermediaries that you have with an IPO are software that's immutable, that's transparent, and a founder should be able to just run it, after submitting a form or whatever disclosures that they need to, without any costs and really any friction. So I think we can get there, and that will dramatically reduce process fees. Like all the stuff that kind of gunks up the works of innovation is like, it takes 18 months to do this, and you gotta have all of this paperwork, and then all these intermediaries that are now legally have to be in all these spots can then take a fee, and the fees grow and grow and grow, and it's like, what, $25 million to do an IPO, which means fewer companies go public, there's less public actually participating in where value creation is happening. And that overall creates a worse economy, I think, has really long-term detrimental effects. So where we can really be very disruptive is just giving founders the tools to do this on their own.
Amazing. Well, thank you both so much for your time, for your insights. Really appreciate it. And thank you, everybody else.
Thank you.
Thank you.
Wow, incredible to hear from Jeremy, Toli, and Dan. It's really incredible what Circle has built. $10 billion of stablecoins on Solana out of 13 billion total stablecoins on Solana today. There are 3 billion of stablecoins on Solana that are not Circle. And so the question is it winner take all, or has USDC already won? We've got Johan from Robinhood, Eric from Gemini, and Matt from the venture department to talk about that right now. Thank you, everybody. Please welcome them to the stage.
Thank you.
Hey everyone, excited to be here and talk about stablecoins and jump off from that last panel conversation. So I'm Matt Homer, the general partner of the venture department, early stage VC fund. We've done a lot in the stablecoin space, and I'm excited for this conversation focused on our stablecoins winner take all. And so we're going to have a fun conversation here. Let me just introduce my panelists here. So we got Johan from Robinhood. He oversees crypto there as an SVP and GM. And Eric, who is the head of all things on-chain at Gemini. And I think Gemini even had some Solana-related announcements this week, which is exciting. But all right, well, let's just dig in. Stablecoins have been maybe the dominant narrative in crypto for the last year. I mean, where I sit at early stage investing, it's definitely kind of the area that I think is captivating early stage founders the most. It's becoming a vibrant, diverse ecosystem with like all sorts of components, including issuance. And what do you guys think? Are stablecoins winner take all? Why or why not? Why don't we start with you, Johan?
Yeah, I think the most exciting thing with stable is it's a perfect example of the first tokenized real-world asset, and I think it really shows the power of tokenization and blockchain technology when it's applied to things that we are used to, like cash. I think though the complexity is the number of currency in the world, and how everything is going to connect. How do you go from cash to currency? And so I don't particularly think it's a winner-take-all. I think you will see many stable and some specialized in specific domain. Like for example, if you want to send to Singapore and you want to get back from stable to Singaporean dollar, you will use a specific one, and etc. But on our platform, we want to be powering as many stable as possible, obviously, and we are pretty excited to see how people use it.
Yeah, Eric, what do you think? Winner take all? Yes or no?
Yeah, I don't think stablecoins is a winner-take-all market. There's currently already 2 players that are dominant, so definitely more room for expansion. We've seen acquisitions like Bridge with Stripe. I think Stripe's going to onboard tons of businesses that never would have thought of stablecoins before that. We're going to see more banks get into stablecoins, and more use cases like Polymarket is one of the most dominant crypto companies out there, and if they switch to a different stablecoin, it would get adoption. So stablecoins are just a more dominant rail. They're programmable, they're interoperable, fast, instant settlement. They're just the best type of payment that you could have, and we're going to see more players want to get into that space. And more issuers that have different incentives, like Global Dollar aligns incentives with issuers, Agora aligns incentives with networks. So, we're going to see just more players get in and give them more opportunities.
Yeah. You guys are, both your organizations are obviously active in the space and see a number of different use cases. Just looking forward, I don't know, like a few years out, what do you think the stablecoin landscape looks like in terms of, if it's not winner take all, what type of use cases, what type of stablecoins do we see? Are they all sort of general purpose stablecoins that compete with each other? Are there I think you sort of talked about this a little bit, Johan, or do you see different types of stablecoins focused on different use cases? Like paint a picture of what you think the future might look like there.
Yeah, I think you will actually just not see it. I think you will see a lot more of the platform using it in the background without you necessarily realizing that there is a stable coin in the middle. Like you see a lot of application already. Like if you look at the App Store, you take the top 10, you already see a lot of these applications that are using stable to fund the account of the customer, especially during weekend, especially during night, where you cannot do an ACH or you have to take a lot of risk as a company. And that's what we do as well on our side. Like on the institution side, we do use stablecoin to settle with market maker on a daily basis, and it's really important because when the banks are asleep, crypto still is live, and people still trade and things like this. For us, we're also participant of the global dollar network. It's a stablecoin issued by Paxos, USDG. And so for us, like the interesting part of this stablecoin in particular is that there is a share of the revenue with all the participants. And so we think that thanks to that, you will be able to actually build and develop more infrastructure around it.
Eric?
Yeah, so I mean, there's a lot of people have thought that the use cases for stablecoins were mainly around settling crypto transactions. And we're just seeing a lot of growth in payments for remittances, treasury management. Circle's acquisition of Hashnote sees that there's a huge opportunity for corporations to want to manage their cash. Bridge doing the Starlink, getting capital back from all these different countries that they're selling, the terminals to. And just DeFi and all the things that are going on there. So I think we're just scratching the surface of the use cases, and more. There's a very large demand for on-chain dollars around the world. People who would rather hold USD than their normal currency since it's deflating, and now with Visa and MasterCard getting into the game to settle debit card transactions, we're just going to see more use cases around the world where people will want to get sent USD on-chain dollars and then spend at the point of sale.
Yeah. As we think about the future market structure for stablecoins, one of the biggest developments just this week is it looks like it's even more likely that we'll see federal legislation around stablecoins, right? Really setting a national standard for what it means to be a stablecoin. How do you think that impacts the industry to have kind of a national standard like that?
Yeah, I have a really strong take here that I think the US needs to be extremely proactive in not allowing global regulation to prevent on-chain dollars from, competing freely. In MiCA license, they put a cap on how much USD can be used as stablecoin. And so I think it's going to be very impactful. It's going to put a cap on how useful stablecoins could be, specifically on-chain dollars. And I think our administration needs to be proactive here and help unblock those regulations that will stifle the US dollar stablecoins.
Yeah, I think it's also going to open the door, right? A lot of institutions, a lot of bank and other platforms do not want to use stable at this point because they don't know how it's regulated, they don't know exactly what's behind it, and so I think the bill is going to open the doors for all these institutions to actually start to use it. The second aspect is also going to define a bit more like how does the US work, how are we going to interact with stablecoins that are issued elsewhere like Singapore or Europe, and so there is still, I think, some work there to do, and there is also the problem around distributing the yield to customer, which seems to be not part of the bill. So I think there are still going to be a decent amount of discussion after this bill.
So US dollar-backed stablecoins are by far like the dominant stablecoin, right? The market so far has shown a very strong preference toward US dollar stablecoins. I'm curious for your thoughts on whether, is there a role for local stablecoins? I sort of wonder, at some point, are central banks in some of these countries going to get a little bit concerned, right? If their citizens are holding like a lot of dollar-backed stablecoins, maybe there's nothing they can do about it. I'm not sure, but like, how do you think about non-US dollar fiat stablecoins?
Yeah, we actually do support already on Robinhood in Europe, for example, Euro stablecoin. It was something that was requested by our customers. They want to be able to actually use it. There is also the interesting play around like FX, but through stablecoin. And you start to see like more and more countries looking into it, like Singapore, Hong Kong, like a few of them already are announcing plans or they are about to launch it. And I think that's good, like I think, ideally, we want what's happening for the USD with stablecoin to happen for any currency so that we are able to move it more freely and faster.
Yeah, I think a lot of countries and companies will try to make alternative fiat stablecoins a thing, but I don't think it will ever be a thing. People want US dollar. America is the greatest country in the world, and the best fiat currency will win in this market as long as we make sure regulation doesn't cap it. So there will be attempts. I just don't think it will ever matter. And as just like Bitcoin's going to win, the US dollar is going to win in stablecoins.
Yeah. Another thing I think, the market, at least from what I hear, I think some people in the market want with stablecoin payments is some degree of privacy, right? Like if you're a corporate or even just a person, you start transitioning kind of the normal payments you do to stablecoin payments, paying a vendor in another country, an affiliate, or whatever. I know some people have said, look, we're never going to do that until we have some certainty around some degree of privacy in those transactions. Do you think we need greater privacy in stablecoin payments for stablecoins to scale? Like, how do you think about kind of the privacy side of stablecoin payments?
Yeah, I think the transparency around stablecoin was also by design to be able to get the regulator comfortable with. There is the technology solution here, like you can use zero-knowledge proof, you can use other system to hide the provenance and the destination. All of this, I think, just need to be incorporated with the different regulator or the administration of the different countries, and it shouldn't be a hard problem to solve for us. But I do think at some point that if we want scale adoption of stable, there will be a need to at least hide some element of the transaction, like maybe the amount or things like this, because otherwise you do display a lot of your information to your competition.
Yeah.
I'm very conflicted by this question because privacy is so important from my perspective. I don't think many people will care, unfortunately. Venmo, had it public by default, and people use Venmo. Yeah. So I think it won't stop adoption per se, but it should be really important. We should be able to have privacy if we want. We should be able to use Tornado Cash or something like that to get your transactions private. We should invest in more privacy technology. You should be able to use mixers in Bitcoin. Ultimately, I don't think it will stop adoption, but it's something that as people in the industry, we should be working towards and not penalizing customers at the exchange level or wallet level, and not blocking anyone for using privacy. Privacy is a fundamental human right, and we need to take that seriously.
Yeah. All right. One final question, which is, like, what are you excited about the most in stablecoins? Like for me, for example, I think like non-custodial neobanking is a really cool idea. Like with stablecoins, tokenized T-bills, you could now have like a Mercury or kind of a neobank experience, right, without any sort of intermediary or traditional bank as part of it. But I don't know, what do you guys, is there something in particular about stablecoins that really captivates you or gets you excited, not just for your companies, but maybe even sort of as individuals who are, been in this space and excited about innovation?
Yeah, for me, in a nutshell, it would be that it's this window into the traditional system in the future when it's on blockchain technology, on this new backbone that crypto is. And I think every advantage that we see on stable, we are going to see it on other assets pretty soon.
Yeah. I've been a payments guy for a long time, so I'm really excited about settling transactions with the payment networks like Visa and MasterCard for an on-chain card. I think that's going to be a huge benefit to people around the world who want US dollars, they want to hold it, and then they can spend it at the point of sale using Apple Pay, with typical rails that they already have. So, yeah, payments.
Yeah, awesome. Well, thank you so much for joining me for this conversation on stablecoins. Appreciate it.
Thanks.
All right, thank you, Eric, Matt, and Johan. We learned a little bit about stablecoin adoption and how we think that institutions are going to lead the growth of the stablecoin industry. I'm really excited to welcome to the stage in a minute two people who are going to talk about how institutions will help make that possible. Colleen from Brevin Howard. Brevin Howard has their flagship hedge fund on Solana via Libre Capital. And Thomas who recently joined Jito, ex-Jane Street. We're really excited for this fireside chat between Tom and Colleen, and I'd love to welcome them to the stage with a big round of applause. Thank you.
Thank you.
Well, I am so excited to be here today with my friend and colleague, Tom, who recently joined Jito as Chief Commercial Officer. Prior to joining Jito, Tom was at Jane Street for 22 years. Of course, Jane Street is one of the largest and most influential trading firms in the world. They trade trillions of dollars annually across ETFs, options, commodities, bonds, and crypto, all of which Tom traded during his time there. And as I was preparing for this presentation, what really struck me was I don't think I know anyone other than Tom who's managed to survive at a trading firm like Jane Street for 22 years.
Yeah, well.
So I talked to some of our mutual colleagues to try to understand how that happened. And all of them said three things. They said that Tom is incredibly intelligent, he gets along with everyone, and he doesn't take anything personally. So those are qualities that will be phenomenal for your second stint here in crypto. So
if you think that's nice, wait till you hear what people say about you. It's even better.
This is all about you. So let's get into the questions. So obviously, when you were at Jane Street heading up crypto, you were very involved in the industry in 2021 and 2022. And then Jane Street stepped back a little bit in 23. You started trading exotic options, is my understanding. So what led you away from that and to this decision to come to crypto full time?
Yeah, it's been quite a journey, and you never think about it while you're in the middle of it. So in retrospect, yeah, I was part of the team at Jane Street that started looking at crypto back in 2017. And we built a pretty substantial business across basically every axis of crypto. But in the second quarter of 2023, Jane Street made the decision strategically to scale back some of its operations on the back of a lot of the US regulatory enforcements. And so, I'd been there for 20 years at this point. I had a lot of loyalty to the firm. I stayed and I started helping us build out our exotic options business, which is very, very different. It's like, I went from working with like crypto founders and entrepreneurs and builders to all of a sudden negotiating ISDAs with like big banks. And so I did that for about 18 months. But I got this feeling, if you're not full-time crypto, the more time you stay away from it, the more remote you get from all of the stuff that was happening. And at some point I realized that I really, really loved and missed the space. And so, I made the decision, the hard decision to leave Jane at the beginning of this year. And my plan was actually to take some time off, but, and learn a little bit about all the stuff I'd missed. And, I'd never heard of Jito when I left. But once you start meeting the team, once you see them operate, it becomes a very easy decision.
Awesome. It's good to hear it was an easy decision.
Leaving was a hard decision. Joining Jito was very, very easy.
Well, especially when you're with someone like Rebecca Reddick, but we don't want to turn it into a Rebecca love fest.
Star. There's nobody better. Nobody better.
So, okay, what I would love to understand more about also is, you had lots of different ecosystems in crypto that you could have gone into. You chose Solana, and then you had a lot of different companies that you could have brought your talents to, and you chose Jito. I've also heard you talk about Jane Street in the context of it not being a trading firm, but it being a critical infrastructure firm for our financial markets in terms of helping to provide liquidity and efficiency and transparency in our markets. And it kind of struck me that that sounds a little bit similar to what Jito does. So there's a few questions packed in there. Why Solana? Why Jito? And then are Jito and Solana, or Jito and Jane Street may be a little more similar than meets the eye.
Yeah, that's a really interesting framing for this, because I do think fundamentally they're very similar in that the way that they approach the problem is very specific. And the way that you described it, I think, is really important. So just to put it into context, if you think of Jane Street, if Jane Street thought of itself as a trading firm, then its job is to make the best possible trades at all times. But if you think of yourself as an infrastructure firm, then what you're trying to build is a company that assists in the formation of fair, orderly, and efficient markets. Like you are a markets infrastructure firm, your job is to make the markets work better. And then you get compensated for that. And I think Jito is very similar in the sense that Jito offers a few different products. You know, its core block engine bundler product. The goal is to make the network more performant. And not only make the network more performant, but share the rewards that are generated by this activity with the validators, with the stakers. And so it's this dual function of making the system work better, but also making the users benefit from the activity that is happening on the network. There's another product that is restaking. How do you build apps on top of Solana that uses the Jito token to enhance security? And there's also the liquid staking token, which is, again, a very specific solution geared towards the users. Like, how do you make the users benefit from just holding Solana and creating additional layers of flexibility so you get this max yield, but you also do it in a way that abstracts away a lot of the operational and technical requirements of maintenance, while being able to use it as collateral on other projects and things like that. So, being very specific about the problems that you're trying to solve and understanding what it means in the entire, in the context of the entire ecosystem.
Okay, the last two panels actually were about stablecoins. And coming from a firm like Brevin, I spend a lot of time thinking about how do we grow institutional adoption in our industry. And from my perspective, one of the things I think we've been missing for the last 16 years is this concept of a public-private partnership, which our traditional financial markets have benefited from really since 1790, when Alexander Hamilton laid the framework for public support of our US capital markets. And I think the reason we have the most trusted, safe, deep liquidity markets in the United States is partly because of that public-private partnership. And now, of course, crypto is getting an invitation with this new administration to finally enjoy that public-private partnership. Yeah. So I think that's, at least in part, what may have been holding institutions back. I would love to hear your perspective. Where do you see institutions today in terms of their involvement with crypto in the future? And then I've also heard you talk about the importance of things like exit points, how important it is for institutions. It's one thing to get into a trade. It's always easier to get in than it is to get out. And just having the kind of infrastructure that allows institutions to trade efficiently and transparently and with deep liquid markets. So turn it over to you.
Yeah, so I've talked about exit points before, and just to contextualize for people who are not kind of as deeply in the weeds as firms like yours or firms like Jane Street, if you're a trading firm, if you're an institutional allocator, if you're a portfolio manager, the decision to enter a trade is only the first part of it. Trade sizing is just as important of a consideration as whether or not you have a trade signal at all. So when you think about a trade, you don't think about whether or not a binary, is this a good or bad trade? You think about it in terms of EV, the expected value. And the expected value is just like the edge times the position size. And one big cap on position size is what does an exit look like in a stress scenario. We ran this at Jane Street all the time, which is, okay, in a time of stress, what is the impact or what is the loss if you have to liquidate this portfolio in 2 days, 5 days, in 10 days? I'm guessing from a VC side, you would have much more experience in this. But how do you exit? As you said, it's a very important consideration. And so the exit liquidity is a very key component to the position size, the limit of your exposure. And building deeper markets just allows you to build. Building deeper infrastructure allows you to increase the amount of risk that you're willing to gain or the amount of exposure that you're willing to take to any specific project, ecosystem, in any sort of trade or portfolio. And so a big part of this is, and we saw the same thing when it came to some of the discussion around tariffs. If the rules of the road are uncertain, if the system is unstable. It becomes very important, becomes much more difficult to make long-term decisions about how you're going to allocate capital. So the more performant you make the network, the more stable you make the network, the more scalable you make the network, the more you build that sort of infrastructure, the easier it is for you to actually contemplate how are you going to build on this, how are you going to invest in this area, how big are you willing to go. And so I think that from the exit standpoint, that's why exit are so important. And I'm sure everybody here has had an experience where like you look at the mark to market on some of your altcoin bags and you're like, oh, this is great. But if you actually try to monetize it, it becomes a problem. But on your earlier question on the institutions, I think, institutions is like a word that comes up so much in crypto and has for years. Like I remember in 2018, people were talking about the institutions are coming. And then you had the situation where like you saw these institutions that they would make this big hire, like, oh, we've got this head of crypto or head of digital assets. But as soon as there was a market downturn, a lot of those people went away. But I think what's happening now is that institutional activity has decoupled from price action in a very material way. Every single large institution has teams of people who are, has a head of digital assets, has a team of people who are looking and are actually fundamentally building in a way that it's very hard to just pull that investment right away. And so I think that the institutional story has become much more resilient, and that's just going to help the space because there's lots of different ways that these institutions can interact with the space now. And part of the way that we're thinking about it is trying to break this kind of nebulous concept of institutions into more manageable buckets. And so we're thinking about like, at Jito, we're thinking about like buy side as like the institutional investors, the allocators, the people who actually make the decisions about how they're going to spend their money. And then we look at the sell side, and these are people who are primarily on the distribution side, who tend to service the buy side. And so these are like the banks and the prime brokers and the exchange platforms and people like that who are providing ways that make it easier for buy side to express their investment objectives. And then there are people who kind of sit between, like trading shops and clearinghouses and custodians who kind of support the architecture, the fundamental functioning of markets. But the thing to keep in mind is that each of them have different needs, and you have to be very specific about, okay, what is the need that you are trying to solve, and how, for us, how does Jito help you actually accomplish this? And so the needs of the buy side are very, very different than the needs of the sell side. And the needs of the buy side, I think, is absolutely crucial for everybody here that's in this room. Like, I think the bull case for any of us, anybody who is building anything in this space, is to grow the user base of Solana. That is it. Like, if you are building a project and you're not focused on increasing the user base, like, you're focused on the wrong thing. Like, competition is great. It improves, like, the services and things like that. But fundamentally, we're all rowing in the same direction. How do we build the investment thesis for Solana? How do we prove or demonstrate that the growth path for Solana? How do we make it as scalable as possible for people, either if you're on the investing side or if you're on the building side? How do we build this?
Awesome. OK, I think we only have time for one more question. And I have a secret that a lot of you probably don't know, but Tom was an actor before he joined Jane Street. So my final question for you is, with this next move into crypto, joining Jito, would you characterize this as clear and present danger, The Right Stuff, Back to the Future, or It's a Wonderful Life? And why?
Oh my God. Can I tell you honestly how I feel? Like, this feels a lot. What's that Robert De Niro movie where he's like a 70-year-old and he interns at like some tech company? And I mean, it's embarrassing to be in New York and talk about a Robert De Niro movie and have it be the intern. Like, there's so many that are based here. But I do feel like sometimes, I just show up and I'm like, does anybody need coffee? Can I? And then hopefully, there's a happy ending at the end of all of this stuff. But yeah, thank you.
Thank you. Thank you all.
Thank you.
We're good.
Hey, let's give it up for the institutional intern, Thomas So Thomas talked about the need of more high-quality collateral in DeFi. I'm really excited to welcome to the stage a group who's going to talk about risk-abated yield, bringing TradFi and DeFi together. I'd like to introduce Dan from Henri, Victor from Rockaway X, and my friend Mark from Camino. Please welcome them to the stage.
Thank you, man. Thanks.
All right. Hi, everyone. So, institutions are off the panel. We can now talk about crypto-native yield, but actually connecting both the crypto world and the real world. So maybe let's first start with a short round of introductions. I think many people know you, but let's do it again. Mark?
Thanks, Victor. Hi, everyone. My name's Mark. I'm from Camino. In case you don't know us, we're a DeFi protocol in Solana, of course. We've been building as a team for a few years now, and we do a few things, but the biggest and the focus for today is about credit. We have Solana's largest borrow-lend marketplace, so we're building to hopefully make the best and the biggest credit solutions for on-chain finance on Solana.
And we'll get back to your V2 in a second, which you just announced 2 hours ago, I think, maybe 3 now.
We shipped it today, so we've been working on that since last year, and very stoked to get that out. So check it out on camino.finance.
Dan?
Yeah, hi everyone. I'm Dan Roberts, CEO of Henri. I guess ship or die is relevant, given the V2 launch today. And we launched an on-chain reinsurance pool yesterday. So catching my breath from that, really bringing this giant use case to the world of DeFi, using reinsurance essentially as a liquidity layer for DeFi to interact with all cycle round. So excited to be here.
Yeah. So sounds like everybody was working right before Solana Accelerate to ship their products or die.
Yeah. It's a good title to, yeah.
And so if we look at like Ethereum versus Solana, we are all, of course, Ethereum friends, but DeFi is lagging behind in terms of activity. So, Ethereum has 70 billion TVL, Solana has 10 billion, so 7 times lower. Ethereum has, 120 billion of stablecoins. Solana has 12 billion, so 10 times lower. What do you think we need to do in Solana ecosystem to grow the DeFi traction as much as on the Ethereum side? Mark, what do you think we need?
For me, we've got the users. We need to bring in the tokens. Solana's got some amazing ecosystem tokens, of course, Sol being the flagship and the LSTs. But if I look at where the growth is coming in Camino, and what's exciting now for us and for users, both retail and institutional, it's more tokens. And we're going very hard after the broadly RWA space. And there's many assets coming which make amazing collateral. And I'd actually include Bitcoin in that. We have a big growth of the desire to trade the value of Bitcoin, but not have to mess about on the Bitcoin network. And Solana's the ideal place for that because of its thriving DeFi ecosystem. So we've got some great Bitcoin tokens coming in, like XBTC from OKX just released. And then on the other end of the scale with RWAs, we've got tokenized stocks, which are especially popular. We've had some announcement today from Kraken, and also tokenized funds. And there's a strong desire for bringing in interesting funds as collateral assets to Camino, and I think that's going to drive more stablecoin demand and help us grow to the much bigger scale of Solana DeFi.
Yeah, and I agree. So at Rockaway X, we run a 100 million private credit fund, which only provides liquidity to DeFi protocols, around 30 protocols for a 100 million fund. That's roughly 3 million on average per protocol. And what we lack within DeFi, and we are always searching for, is high quality yield. And that's how we came across names.com, which then founded. We are actually rebranding names.com to onri.finance and bringing it to Solana. So then can you tell us more about onre.finance, onre.finance? You can all check it out. What is it, and how did you get into reinsurance?
Yeah, absolutely. Names fundamentally was building digital asset infrastructure for the insurance space to come online, come on chain. And really, you mentioned what's going to bring this next wave of adoption for Solana. I think if you take something like meme coins, for example, this has been a massive use case for what is needed for high transaction, deep liquidity interactions with yielding collateral. And now we're starting to see these yielding products that are really bringing net new yield to the space. So you don't have that sort of correlation with bull or bear markets. You have a yielding asset. In our case, this is reinsurance. It's a very diversified asset class.
How much is the yield? Give us the number.
We model our reinsurance product at 12% plus the collateral asset, which is SUSDE from Athena, which is around 8% at the moment. So the thing with reinsurance is, unlike, let's say, private credit or venture, capital comes in, but then it's lent or invested out. Whereas in reinsurance, the collateral sits verifiable on-chain in its own pool.
Yeah.
And so you earn your insurance returns against that, which we model at 12%. But you also generate investment returns against that capital. That's currently with SUSD is 8%. So ON-E, which is the LP token for our pool, available as of yesterday, hence the gray hairs, is a 20+% yielding asset, uncorrelated to crypto volatility. So bull, bear market cycles is really unaffected. That can be used, composable fully across the DeFi space.
And I think that's exciting because it's not possible in TradFi, where you are actually compounding both yields. So here we are compounding reinsurance yield of 12% and Athena stablecoin yield of 8%. So high quality 20% yield. Plus currently, I think you guys on your website, onre.finance, you are saying that those who provide TVL now can generate 40% yield.
Yeah, we're incentivizing the first 30 million to get deployed. That's really where the balance sheet is diversified, ready for scale. Yeah. And the point that we have sort of seen being asked is, why haven't there been more structured financial products on chain? And one of the answers, which is a good one, is that crypto native yields are very competitive, particularly when the market's in a good space. What's exciting here is we get to combine both. You have the uncorrelated structured finance of the real world. This brings in net new returns for the crypto space to interact with. But then you get that crypto native yield as well. It's compounded together. Yeah. So we announced yesterday the partnership with Athena to bring that as a collateral asset in this.
Plus, there is another advantage, which is not possible in TradFi, is the composability with other DeFi protocols. So can you tell us, Camino, you guys are supporting ONRE Finance. You will be supporting ONE, so ONE-LP token. Why are you excited about ONRE Finance? Why have you decided to support it?
Yeah, like I said before, the growth of Solana DeFi, the growth of Camino is all about interesting assets. And this is a really interesting asset. It's a proven asset. The yield at 20% is amazing. And it's in this theme of RWAs. If we think about where Solana is now, we're no longer the poor chain. We had to buy meme coins when Sol was at $10. Yeah. Sol's now done a 10x. Meme coins made a wealth effect on Solana, as did the growth of Sol. And the ecosystem's maturing. There's actually a hunger for yield now, like we see on Ethereum, which has gone through a similar cycle in the few years preceding. So we really like this kind of asset. We have users who are looking for not only yield, but also leverage yield. So that's where we're able to come in and bring borrowers, e.g. the holders of the ON-E token, and then lenders who are looking for high quality assets against which to lend. Yeah. And what we'll be doing is creating a marketplace for borrowers and lenders to meet each other on Camino. So we'll have a collateral asset being the ONRE token, and then we'll be able to bring in stablecoin lenders to provide loans, and in essence, allow the ONRE holders to lever up their exposure. Yeah. And Yeah, so in a nutshell, that's the kind of service that Camino as a protocol
And
provides.
in addition to Camino, can you tell us then about the Orca cooperation, maybe Exponent also you are planning in the future?
Yeah. I mean, a big piece here is that the dynamics in the DeFi world don't exist in the TradFi world. So we can apply well-performing assets in the TradFi world to the dynamics of DeFi. Yesterday, there was $3.5 million of liquidity depth built on Orca. So suddenly, this sort of 6-year mission of ours to introduce reinsurance as a liquid asset class was completed yesterday. You can now come into an asset class that is usually looking at 3, 5, 20-year capital commitments, and you can trade in and out of this position 24/7, instantly using the DeFi dynamics that are available to us. Camino come in as a entire liquidity layer on top of all of that kind of activity, utilizing 24/7 liquidity. It's this sort of match made in heaven where you've brought it. We now see a much more mature DeFi market that is ready for these $750 billion reinsurance space, set to be $2 trillion over the next 10 years. This is a huge capital gap of demand where we see digital assets being the main filler of that alternative capital need.
Can you tell us briefly about the insurance, underlying insurance you are reinsuring? Some people might think it's risky. Like, how do you as an expert, and you also actually worked at Swiss Re, Mark, before.
It's a topic close to my heart, because I used to work in the world's leading reinsurer. And there's a bit of work to do, I think, in DeFi and with DeFi natives, so that there's like a knowledge gap. We're used in crypto to assets that have a very concentrated risk. And what we're introducing with tokens like this is baskets of diversified risk. And the yield's very attractive. And I think there's sometimes some skepticism with where does the yield come from. And actually getting to know about reinsurance, getting to know about the fact that the yield is very diversified, as you might be underwriting a fire or a flood in America or a health-related or car accident in Asia. So you've got that extreme level of diversification, but you've also got an asset class which scales hugely. I mean, the biggest reinsurers out there have books in the hundreds of millions and beyond. So if we're now talking 10 million, 20 million, 100 million on chain, it's really a drop in the ocean compared to the overall opportunity. So overall, a bit of work to do. We need to get
more education.
Our users comfortable, but I think very bullish for the growth, not just of interesting tokens, but the opportunities for scaling stable coins and providing interesting on-chain yields on Solana.
Dan, for you?
Yeah, the re in insurance is really insurance for insurance companies. So primary insurance build diversification by covering lots of different lines of business. And then a reinsurer is really building a diversified balance sheet of these diversified insurers. So it's diversification squared. We cover directors and officers, tech, errors and emissions, cyber, travel, property catastrophe. It's a global business by design to achieve that kind of diversification, plus the crypto native yield with SUSDE, fully composable across DeFi, secondary liquidity, 24/7. That's kind of the marriage that we're bringing here.
So check it out, onre.finance, onre.finance. You can already use it today. It was launched yesterday. Thank you so much, guys.
Thanks, everyone.
Thanks, Victor.
Thanks, guys. 20% yield, uncorrelated risk. That sounds pretty good to me. I'm going to check that out. So earlier today, we had Colleen from Brevin Howard. As I mentioned, Brevin Howard has their flagship hedge fund on Solana via Libre Capital. Our next speaker, Victor Jung from Hamilton Lane, also has a private credit fund on Solana today via Libre Capital. But there's more to come. And it's incredibly exciting that the co-CEO of Republic, Andrew Durgee, is going to have a fireside chat with Victor to talk about the future of Hamilton Lane on Solana. Thank you very much. Please welcome them to the stage.
Buddy? right. Everyone hear me all right? Good? I can. Awesome. Everyone, welcome. This is super exciting for me, and a really actually special moment for me and Victor. Victor and I have worked together for a year and a half. Every Friday for a year and a half, we've had a meeting at 9:30 a.m. The only person not at Republic that I have a weekly meeting with, and today is actually the first time I've ever met him in person. So this is like a real culmination for us.
You look better in person, by the way.
So anyway, super happy to be here. Obviously, Hamilton Lane, a big name in the space, a pariah and a stalwart. I think it'd be really great for those that maybe aren't familiar with Hamilton Lane, maybe to talk a little bit about what Hamilton Lane's background is, and we can lead that into the journey we've been on the last year and a half.
Thanks, Andrew, and once again, thanks Solana for inviting me over. This is I'm a little bit embarrassed to say, but having Solana as client and with their vision on tokenization of real assets and private markets, we've been aligned, and this has made me to come to my first ever digitally native conference in my entire career. It's very shocking. I'm based in Switzerland. I'm coming all the way over here to please the client and also explain a little bit on what we do. Now, Republic is also doing the same, but just to give you an overview of what we do, you have anything that is not publicly listed companies is private. We go by private markets. We are a NASDAQ listed private markets firm with over 900 billion of AUM and AUA. And I lead digital assets at Hamilton Lane with the mission and social mission and commercial mission to democratize private markets to an audience that has been, that had not been able to access this asset class for the past 40 years. And we're counting on the blockchain technology to facilitate this access and make everything cheaper, better, faster.
So a very traditional business, very traditional markets.
Correct.
Now, moving forward into this new digital space, how did you accomplish that? How does Victor Young at Hamilton Lane get Hamilton Lane an unmovable object to innovate?
So, yeah, thank you. That's a great question. As you know, private markets, they keep on saying institutions, institutions, institutions. And what many people don't know is that the regular people, retail, don't have access to buy or invest into a company that is not public just because it's private. It's regulated, so by law you cannot invest into such content, but it's a superior asset class with superior returns, and they have not been able to access it. It's been only solely for pension funds. Now, there was a wave of democratization where private banks and family offices learned about the unlisted stocks or companies in where the growth projection was higher because you don't have to be on a stock exchange with quarterly earnings call where the board, management, and the shareholder, they think different, right? I mean, if you have a stock and it raises 3x tomorrow, you'll sell it, right? So is that proper value creation and alignment of interest? In private equity, you have an owner that thinks a management, shareholder, and the board, we're all thinking in the same way. And hence, we thought that, and kudos to my chairman and CEOs, we are really aligned. It's not only about the money, it's the social purpose of opening up this asset class to an audience that even if they don't know, they've never had access to when the rest had, and the social and emotional attachment to a Mrs. Smith that is selling pretzels outdoors of her 10K and 1 billion of Elon Musk. Sentimentally, it has the same value, but one has access to investing in something that is higher yielding than traditional stocks, but Mrs. Smith doesn't. So that was our whole vision in where, look, Victor, we want to make money the right way. We want to do some social good. We've been doing all about this just for the money, but let's have some purpose and let's do something properly and something right, and this is how we started our journey.
And to level set this for everybody, right now in the United States, there's something called the accreditation system. And the accreditation system prevents unaccredited investors, retail investors, from participating in pre-IPO engagements, meaning you cannot own pre-IPO SpaceX unless you are an accredited investor. And in the US, there's a couple different ways. Be accredited, you have to be worth basically $1 million, make a couple $100,000 a year, or be what's known as a knowledgeable person, meaning that you're in the finance space. Other than that, you cannot touch privates. And so now we're looking at something really unique, which is you have one of the largest private equity firms in the United States that's innovating with the ability to allow retail to participate in a market they haven't participated before. So maybe you can talk, this is the product that him and I and our teams have been working on for a year and a half, but maybe you can share a little bit what that looks like.
Yeah, so it took us 18 months, and we're happy we actually wrote, we made history for the first time in the US financial market history in getting a registered private markets fund through Republic, some capital markets engineering, digitization, and all of the token elements embedded in. We fractionalized to a minimum of $500. So before, you needed to have $1 million plus to invest in the private equity. $500. You can access this offering through their app. You can do a crypto funding as well. So it has the traditional side, but also, hey, the MZ generations. I'm always confused with the alphabetical orders because it's X, Y, Z, MZ. They don't like the bank accounts and the wirehouses. They want to do a self-custodial funding of and participate in the private markets. So 18 months, co-designing, a lot of calls, lawyers, tech.
A lot of lawyers.
Yeah,
a lot of lawyers, yeah.
And 7 weeks ago, through Bloomberg, we announced the first ever private markets to retail, so non-professional retail at $500. And it's been one of the greatest journeys ever, and this is the first time in my private markets career where I can tell, my bosses, my parents, my kids, and my wife to say, hey, look, Daddy has done something great. This is not the case before. You do investments in private markets. You do it for the money. You like the social aspect here. Like we did something really great, and the uptake. I mean, you tell me, it's been fantastic, right? Your clients have been loving this.
Unbelievable. And there's a whole myriad of innovations that take place. One of the ones that personally I'm the most excited about, and obviously impacts the employees directly at Hamilton Lane, is this is actually the first time that Hamilton Lane employees can invest in their own products.
And thank you for making it equitable. I mean, it was a good deal. I mean, they also agreed, and they lived this vision together. So they allowed 100% of Hamilton Lane U.S. employees to participate. Because look, even if you work for private equity, not all of them are rich or accredited, right? But through this solution and the fractionalization of $500, everybody can save $500, right? That's a fact. And through Republic, we've had that right to participate and do wealth creation. And wealth creation is not for the rich. That's wealth expansion. For retail, I want to call it wealth creation participation. And we're very grateful for Republic in allowing us, not only their millions clients in the B2C, but also our employees to participate, and we want to do this globally at some point.
And appreciate the trust in us to be able to accomplish and get that done. To give guys you an example, there's around 900 employees at Hamilton Lane. Of those 900, only about 100 before this could participate in their own products. And that's now going to change the entire landscape of finance on a go-forward basis. But there are still a lot of hurdles.
Yes.
There's still a lot of work to be done, and we're hoping a lot of you here can help drive that innovation that we can implement and execute on our side. So maybe you can talk a little bit about the hurdles that still remain.
Yeah, it's first, it's a question that we ask ourselves every day. No matter how cool the car is, if there's no roads to drive on, the car has no use, or vice versa. I think that there needs to be an effort, just like in digital assets, to educate yourself of why private markets is such a better asset class, right? Why are private companies better, and how does that impact my financials? And also, try it out and see whether this is so good or not, and push and spread the word. Spread the word. Hey, there's a social injustice here. We want to participate more. Just like stocks, everybody. I mean, half of the stock market is retail money. Ironically, Bitcoin with a volatility of 80%, and I love it, has a retail participation. Private markets has a volatility of 5 to 7, 12% return, and the word is not out. It's like the vanilla ice cream that you've never tasted. And for you to know, you have to taste it, but like, oh, so good, I want to buy more. So that's what we need: more adoption, curiosity, education, and then you open up, just like with digital assets. Wow, this is really, I should have a 10% of my holdings parked here, and compounded returns, and it will not let you down. And this is why Republic has trusted us, and Solana has trusted us, and they will keep on trusting us. And going retail, it's hard. It's very easy to go big scale, institutions only. There's really a social mission here also, on top of just making money, to solve problems. And this is why we're equally aligned with Republic to do that. And we're grateful to Solana for being part of this as well.
People ask, you hear institutions are coming. Institutions are here. They're literally here right now on stage, and they're doing the things that we've been trying to get accomplished now.
You see me with my tie. I'm not a DJ crypto native.
No, you got like
yes, I tried a little bit
yeah.
with my shoes, but I openly embrace the efficiencies and the cheaper, better, faster elements of crypto that could be also reflected through the likes of Republic into our asset class, and it would just get so much more efficient. The lending, the trading at some point, but if you don't have the scale, there's no house to mortgage on, and there's nothing to be traded. So I would like to ask the audience as well, there's only trading and lending when the primary markets are big enough. It's all about distributions. If not, we have people asking us, hey, what about lending and liquidity? Like, you create liquidity on something that exists. That market doesn't exist yet, so we need to first start with adoption and scale. And this is the reason why we teamed up with a B2C platform like Republic.
And this could not be done without tokenization. Just simple facts. This is only possible through the efficiencies and the custodial solutions and the secondary market opportunities that tokenization creates.
Yes.
And you needed to get a token. You needed to get a partner. You needed to get an infrastructure partner. Yeah. And so here we are at Solana conference. Why Solana?
So we've been doing a lot of research, and once you do, for example, if I'm a client of Republic, Andrew, can I get a loan on one of the companies that you're crowdfunding? Can I today? As a standalone, it says crowdfunding.
Yeah.
And in private equity, it's difficult, right? But in a bank, you could get a house mortgage, or you could get a loan, or whatever you have. I'm sure that's in the works as well. But in the future, we would like to learn and apply all of those great things that you guys are doing with the Solana ecosystem, for example, and try it out, the lending, the trading, and see how it works. Companies, like if you look at the stock markets, they were never meant to be liquid. That in itself is a democratization, life. It's an example of it. We want to make it also more accessible, and we want to try out all of those benefits that the crypto and the digital assets community are executing today. Cheaper, better, faster. That's our equation.
And I think if you're going to deliver retail products, you're going to want to use a retail-oriented chain, right? And I think it's hard to argue at this point that Solana has not really won the retail space. So
exactly, Andrew. It's also Republic, which is very retail. You guys have a mission. Solana, for us, traditional finance. I was shocked to see Fidelity here just talking about it. Solana, it's also retail. They got 100 million wallets. They also have like B2C clients using Solana wallets. This is democratization for us. It's the same common denominator, and we're aligned on the vision. We want the next gen retail investors also to try us out. Benefit from the minimums, the fractionalized offerings that Republic has enabled, and make it better through lending, trading, and for now focus on the scale. And we want to prove to all of these investors that this is a good asset class to have as a financial asset for you.
Well, we love it. We appreciate all the work that you're doing, and innovating, and taking the extra steps. And I think I can speak for everyone that we can't wait to see what Hamilton Lane does next.
Yes, we hope to be able to announce perhaps not in the near term on the tokenization efforts at some point.
Amazing.
Thank you.
Thank you, Victor, and thank you, everybody. Thank you so much.
Thank you, Victor. Thank you, Andrew. Wow, you heard it first. Breaking news. Hamilton Lane on Republic, $500 minimum. Any single person in this entire Pier 36 can buy it. Unfreaking believable. RWAs to the masses. It's incredibly exciting. Next up, I'm going to be bringing to the stage another incredible RWA tokenization platform. And they're going to be talking about the incredible products that they built and how they're distributing it and what the future looks like. Securitize has brought a ton of enormous financial institutions to the blockchain and to Solana. BlackRock, Apollo, Van Eck, and there's so much more in the pipeline. I'm really excited to announce Michael and Tom from Securitize to the stage and Saeed from Wormhole. Please give them a warm round of applause. Thank you.
How's everybody doing? Everybody feeling good? Make it in here today? All right, so let's just start with some quick introductions. I'm Tom Murphy, head of communications at Securitize. I'm joined here by Saeed Badreg from Wormhole Labs, and of course, Michael Sonnenschein from Securitize. Guys, Saeed, let's start with you. Just a real quick introduction of what you do and what you do at Wormhole specifically as well.
Hey everyone, I'm Saeed. I'm CEO of Wormhole Labs. Basically, we build software, we open source it, and we let the ecosystem kind of build products and applications to take their assets and their data cross-chain.
And Michael, how about you? Obviously, a lot of action at Securitize right now.
Indeed. So I'm Michael Sonnenschein. I'm the Chief Operating Officer at Securitize. We are the largest tokenization platform in the space. We've brought about $4 billion of tokenized securities onto public blockchains like Solana and others, and very excited for this chat.
So Saeed, let's start with you real quick. Obviously, you know, there's a ton of excitement and anticipation in this building right now. What are some of the most exciting high-level things that Wormhole is looking at the moment?
I think some of the stuff that's exciting us the most is, you know, we've built a lot of the core infrastructure that has allowed for a bunch of assets and data to come into the Solana ecosystem. And a lot of that open source work, people have taken and built applications that we never thought were possible. A lot of those applications have been really smart teams that are solving very intelligent pain points that on-chain users are having. But now we're starting to see institutions come in and leverage the technology to solve major problems in TradFi that we never thought would happen at this stage. And so for us, it's like we are working with a lot of the partners that not only are they institutions trying to serve institutions, they're also institutions that you never thought would actually serve retail. So there's a lot of things that I didn't think would happen this fast, this quickly. And I think this conference is like aptly named Accelerate because we are seeing a massive acceleration in things that we thought would take 5, 10 years. And it's happening month over month at a rapid pace.
And Michael, you know, Saeed just mentioned it, right? The name of the conference is Accelerate. I'm not sure there's a space that's accelerating as fast as tokenization and what we're doing at Securitize. Why is there so much momentum and so much excitement right now?
Yeah, well, when I think about even just the last year alone in terms of the tokenized security space and RWAs in general, the space has more than doubled in size. And if you look within that, you'll see that areas like tokenized treasuries have grown probably now over 800% in the same time period. And so one of the things that I think we're really focused on at Securitize is ensuring that when we are going to bring investments on chain, we're going to unlock or find some additional benefits for both the asset issuers, like Nick mentioned, Apollo, Van Eck, BlackRock, even Hamilton Lane, as well as for the end investor itself. A lot of the investors that are coming on chain today to buy products like these are investors that for the most part are already in the digital asset ecosystem. They're already folks that may have speculated on assets like Bitcoin, Ethereum, Solana, and they're looking for diversification with top-tier asset issuers and often with cash-flowing investments. But if you compare the attributes that these products have in an on-chain environment to their traditional counterparts, we hold ourselves accountable and responsible to give them some other features. So for example, in Solana, as well as other chains, our BlackRock tokenized treasury fund, the dividends are paid out on a daily basis to investors, as opposed to, in a traditional Rails environment, those dividends get paid monthly, quarterly, et cetera. So when you think about the compounding effects that has for the end investor, when you think about their immediate access to the capital. These are objectively attributes and features that investors are now looking for and are really starting to demand out of their on-chain investments. I think when you also think about not just the investments themselves, but the other opportunities that exist for them because they're on-chain, we're starting to see a lot of interoperability, not just cross-chain working with partners like Wormhole, but also being able to bring these investments into the DeFi ecosystem. So largely, these pools of capital and these types of investments have never really had the opportunity in a traditional format to exist with lending and borrowing and all the great things that investors can do in DeFi. But now with the advent of folks like Camino and Drift in the Solana ecosystem, if you are minting these assets on chain, you're often able to now bring them into the DeFi ecosystem to either leverage the assets further or come up with other strategies that ultimately enhance the yields for investors. And a lot of that demand is really what's driving the growth of the space in general.
Saeed, how does Wormhole facilitate a lot of this growth? And then on a higher level, what's your relationship with Solana, and how do you guys really try to work together?
I think a lot of it has to do with giving the end user or the asset issuer the ability to make the trade-offs that they want to make. So you kind of want to have an extremely flexible stack that if an asset issuer wants to be native on Solana, like BlackRock, for instance, they can do that. But they don't have to sacrifice their growth. So if there are other trade-offs that users or institutions are making and they want to be on other chains, that can happen without having a complex amount of work and operational overhead to be able to manage the asset. So it can be native on both chains. It can communicate with each other. You have all of that infrastructure set. So if at any point a securitized user who has BlackRock on one chain, like the BUIDL token on one chain and wants to move it to another, they can do that in a purely native fashion. And I think that's been something that we've helped with a lot of institutions support. And it's particularly important when you start to talk about payments and you start to talk about stablecoin issuers, and intrinsic to the work that they're doing is that we want this to proliferate. We don't know where the merchants are going to be. We don't know where the asset issuers are going to be. And we don't know what the payments networks are going to allow. But what we do know is that we don't want any limitations in terms of a blockchain, in terms of the type of asset stored, in terms of the type of wrapping of that asset. All of that needs to be abstracted away, and that's a lot of the work that we've done. And I think we've had a decent amount of success attracting some of the biggest names in the world to start using those rails and start issuing their assets across multiple chains.
Michael, I think one of the real buzz phrases right now is we want to tokenize everything, and everything and their mother needs to be tokenized. But I don't think we always think that that's the case, right? So what are some of the misnomers around tokenization, or some of the myths that you're seeing out there?
Yeah, I mean, I think one of the biggest ones that we're having a battle at the moment is that there's this inherent belief that if you tokenize something, it immediately makes the asset itself more liquid. That's just simply not true. Liquidity and the ability for an asset to be bought and sold, or there to be price discovery or a marketplace, the same dynamics exist for it in a traditional rail environment or in an on-chain environment. So simply tokenizing something does not inherently make it more liquid. What I would say in terms of what we're doing at Securitize and the types of opportunities that we're seeing from asset issuers, trying to satisfy the demand that the on-chain investor is looking for really surrounds investments that are highly liquid, and more than anything are assets that again, have the most frequent ability to be bought and sold, redeemed, purchased, but also cash flowing. And so that's why I think we've seen the growth we have around both tokenized treasuries. You've seen the growth around now private credit. And what will be exciting for us as we kind of enter into the back part of this year is the demand is starting to shift both in terms of the product structure itself, like what type of product wrapper is moving into the tokenized format, as well as what the underlying exposures are. So one of the projects I know we're proud of is we tokenized Exodus, a public company traded on the New York Stock Exchange. So there's obviously a lot of buzz now around being able to tokenize equities, ETFs, et cetera. And as more investors come into the on-chain environment, you're going to see a broader spectrum of product exposures and product wrappers.
So obviously we're here in New York City. The color scheme of Accelerate is red, white, and blue. Saeed, you actually just told us backstage, I hope I'm not putting you on the spot here, that you guys just opened up an office in New York City. what is it about like the enthusiasm specifically here in America that has like the entire crypto world feeling pretty patriotic at the moment?
Yeah, I think there's a tremendous amount of talent in this city and in this country, and I think a lot of it has had to move elsewhere because of a lot of stuff that's happened in the past. I think a lot of the excitement and acceleration and why you want to continue to invest here is really around the new administrative changes and their views around stablecoins, their views around crypto, their views around regulation and bring clarity. I mean, it seems like the administration has a view that there's an insane or an immense untapped demand for digital dollars, and they think that that is core to their strategy for addressing inflation, addressing some of the major economic forces that kind of concern the government, concern the Fed, concern the Treasury. And so when you see the Treasury Secretary out there really pushing stablecoin adoption, you see the Senate passing the Genius Act, I don't think it's happening in a vacuum, and I don't think it's just because like, oh, we just decided we like stablecoins. I think there's like a very, very intelligent strategy in terms of, we've seen things like Tether, who really have a very niche market in terms of servicing like crypto traders on exchanges mainly, and a little bit of payments in certain geographical locations, become a top 10 buyer of US Treasuries in a very short amount of time with very little support. And I think that's a very, very powerful signal for regulators and lawmakers in this country and business people in this country that there is an insane untapped amount of demand for these digital dollars. And so we should just open the door wide open, set some very clear guidelines, some rules of the road. If you want to launch a stablecoin, you can do it. You can do it right here in America, and you can go and try to service that demand wherever it is around the world. And in order for you to actually do that, you need to have trustless systems that are based on decentralization. You need to have instant settlement. You need to actually provide a better product. And you need to provide transparency, and you need to open up the market to the entire world to interact with it. I think if you look at this past week, we had a treasury auction that was very interesting. A lot of eyebrows were raised. So yeah, I would say like when you see those two things coupled together, it gives you a strong sense of a trend, of a signal, and it's worth investing in. And I think there's a lot of talent in this city and in this country that sees the same thing and is starting to build products and infrastructure that can support that.
And actually, just when you talk about transparency, I think that's a really important theme because investors are looking for that transparency. One of the things that's been enabled by the rise of tokenized treasuries is these products are actually starting to make their way into being the reserve assets for a lot of the stable coins that are launching. So that's certainly true in the case of the BlackRock product that we offer, BUIDL, as well as a more recently launched product that we did with VanEck, VBIL. And so investors are looking for that on-chain transparency of what these stable coins are invested in. But I also think that the tokenized treasury space is starting to actually challenge the role that stable coins have historically played. And so over time, you're going to begin to see tokenized treasuries begin to be accepted by market makers, OTCs, and even exchanges because of the high quality collateral that they represent. And also the fact that if traders or even just investors generally want to represent their interests in any of these environments, of course they'd rather do it with a yield-bearing, cash-flowing asset than perhaps a stable asset. And so I think we're starting to see and kind of being on the precipice of some real changes in investor behavior in the on-chain environment because of the introduction of these products.
Last question for you guys. Obviously everything's accelerating. I think everybody's really excited about the space right now, but let's look ahead. What is something you're looking for? What's something that you're watching for over the next 6 months, the next year, the next 5 years that's going to be really exciting and take the space even further?
Yeah, I mean, I think for us, it's definitely the real-world assets coming on chain and then just being used in a bunch of different ways that are now only possible because of investments that are like Jump Fire Dancer for Solana. Like these ecosystems that are really putting an insane amount of investment and technical engineering to make their blockchains better and more performant and can support this world where you do have a mass proliferation of stablecoins and you do have the global payments networks starting to adopt crypto to service their users. Like, all of these things are possible. All of these things, like, the market is clearly telling you, we want this. Give us this. The question is, are we going to be able to build the right infrastructure to be able to support it? I think that's what a lot of people here are thinking about. That's what we're certainly thinking about, and what we're most excited about.
I think I'm really looking for convergence. I'm looking for what we have available to investors today in their brokerage accounts, retirement accounts, investment accounts, and what's available today in their wallets. And I'm seeing those two worlds converging over the coming months and coming years. I would venture to guess what's available in your brokerage account is going to sooner become available in your wallet than the other way around. And so that's why I think the excitement, the enthusiasm, the acceleration we're seeing around tokenization is just so exciting.
Michael Sonnenschein, Securitize, Saeed Badreg with Wormhole Labs. Thank you all for taking your time today. We really appreciate it.
Thanks, Michael. Thanks, guys.
Thank you, sir.
All right, 10-minute break. Please be back at 3 o'clock. We'll be starting promptly again at 3 with CFTC Commissioner. And don't miss it. See you soon.
Solana Accelerate will begin shortly. Please silence your devices.
Good afternoon, welcome back. Thank you all for being here. We have a bit of a teaser for tomorrow's policy-focused programming up for you right now. Right now is an absolutely critical time. Join us please, thank you. Right now is an absolutely critical time for crypto policy in the United States, and the three folks joining us on our next panel bring unique perspectives to that conversation and have been doing so for the last several years. Please welcome Rebecca Rettig, CFTC Commissioner Summer Mersinger, and Giovanni of CME Group.
Last name. I love it.
Uh-oh.
Hey.
Good luck.
Hey.
Have fun.
I love that you stayed away from the last name.
Hi, everybody. I'm Rebecca Rettig. I'm the CLO at Jito Labs, and I'm thrilled to be joined today, as Miller said, on stage by Commissioner Summer Mersinger of the U.S. Commodity Futures Trading Commission. She is also the incoming CEO of the Blockchain Association, but she's here today in her CFTC capacity. And Giovanni Vicioso, who's the global head of cryptocurrency products at the CME Group. So today is going to be focused a lot on the derivatives conversation in the crypto space, and we are tight on time, so we're going to jump right in, and we have a lot to cover. So Gio, about 2 months ago, on March 17th, Sol Futures had their first day of trading on the CME Derivatives Exchange. Yes, very exciting. Starting off strong, can you explain the significance of having Sol Futures on the CME and what it means? It's also thought to be a precursor to something like an ETF of the underlying asset. And can you talk a little bit about how that all works?
No, for sure. Thank you, Rebecca, for the question. And thank you, Solana Labs, for the opportunity, because it's really events like this that just help accelerate the cryptocurrency ecosystem, right? Because it's where institutions can come and learn, and it's really the adoption of the underlying technology, such as the Solana blockchain, that could really help uncover efficiencies, capital efficiencies and operational efficiencies for the industry. And that's really what's going to drive value to the underlying coins, such as SOL, and drive the interest in products such as the ones offered by CME Group. Now, the introduction of SOL futures in March really marked a new era for crypto for us, because I think it really marked a period where we're seeing, say, greater regulatory clarity, greater regulatory comfort, and it really marks an end, really. It's almost like a renaissance, if you will, kind of like marking the end of the dark ages, and really signaling now that there's clear rules of the road, if you will, in terms of helping this ecosystem grow. Right? When we look at what drove, it's having that regulatory clarity is important, but it's also having client demand. And with Solana, we saw it was our most requested product following Bitcoin and Ether. Right, so we were really happy with that. So having regulatory clarity, having client demand, and then also having supports from liquidity providers. I see Thomas there, and I think of Jane Street, but having the support of liquidity providers as well as clearing firms also helps drive, say, growth in the space. This was the first time that we launched both an institutional size contract as well as micro contracts. So we're really seeing interest from both institutions as well as retail participants. And it's also the first, so Solana marked, it was the third cryptocurrency on which we launched futures on. The last time we launched a futures contract was 2021, that was Ether, right? So it really marked another milestone in terms of the maturity of the space and really cementing CME's commitment to continue to drive growth in this space. In terms of ETFs, like you mentioned, I think when you look at what we've done, say, with our products at CME, we've really created very trusted products, very liquid products that really serve as the underlying bedrock, if you will, on which these ETFs can grow. Right? When you look at how these markets are integrated, where you've got spot, you've got futures, you have ETFs. The liquidity providers and the authorized participants for the ETFs really rely on the liquidity and the trust offered by our product set, and it's helped these ETFs grow tremendously. And with Solana, we now have a futures-based ETF offered by Volatility Shares, and there's also 4 spot-based ETFs in Canada already. So we're super excited with that launch.
Yeah, amazing. Commissioner, so to move on to what you've seen over your tenure in crypto at the CFTC, what do you think are the most important advancements in the crypto space that fall within the CFTC's jurisdiction since you began there in 2022?
Yeah, thank you for that question. And I do have to give a quick disclaimer that the views I express today are my own and not necessarily those of the CFTC or my fellow commissioners. We've seen a lot of exciting movement in this space since I've been a commissioner, and even before when I was at the agency. Certainly what Gio's talking about, it's exciting. We've seen a huge growth in the participation in those contracts that he mentioned. We're starting to see these perp-like products come on. They're not quite perpetuals, but certainly longer durations. And there's just a lot of excitement around these new products. We're seeing new market participants come in, that a lot of retail, a lot of interest there. So it's been a very big evolution, and certainly we welcome the innovation at the agency.
Makes sense. And I know you're exiting, but what do you think are the most important advancements the CFTC could make as it relates to crypto, in the next 4 years?
Yeah, absolutely. We need to open the door to allow perpetuals. Like I said, we've got kind of perpetual-like products that are trading, but it's time to allow those to be on our registered exchanges. And we need to make sure that we are keeping the door open for new types of market registrations and market entrants. We are already seeing new people into our space, some of them through buying existing registrations that, from an existing registrant, or they're going through the application process. We need to make sure that our principles fit this new market structure. We can do that under our existing remit. We can look at our rules and make sure that they are fit for purpose. And that's really going to open up this space. And what would hopefully happen is we have a lot more of what's been offshore trading come back into the US markets.
Yeah. And we didn't sort of talk about this in our prep session, but as you were talking about the core principles and just thinking about what the CFTC does and where the market is going, including bringing in new registrants, intermediation is such a core concept that underlies what the CFTC does, but there is such great interest in DeFi where there may not always be someone who's intermediated in the system. And how do you think about what the CFTC can do going forward to accommodate those types of new markets and participants there?
Yeah, absolutely. And actually, we're seeing more disintermediation within traditional markets as well. And I think there's a lot of efficiencies there. So, again, the markets, they move on their own, they evolve on their own, and our job is to keep up, but not somehow hold back that innovation. So I think there are some areas of our rules that we need to take a look at and make sure that the customer protections that need to be in place are in place in a more disintermediated model. We should probably do that through rulemaking versus kind of one-off orders. But at the end of the day, again, this is where the market's changing, the structure's evolving, and we need to make sure we are keeping up.
Yeah, makes sense. So to pick up on what the commissioner was saying about perps and perpetuals, perps are very popular in crypto, but obviously not traded in the US. And the CFTC just issued a request for comment on the trading of clearing in perps and how that can work in US markets. CME has long been at the forefront of digital derivatives. And how does CME think about strategy when advancing some of these new and novel products and how those could undermine or otherwise impact some of your legacy products?
Yeah, so CME has been innovating now for over 180 years, right? And I think that we're at an interesting time, right? Because we continue to see, say, new institutional participants come into the space, the real bedrock of our business. But in addition to institutions, we're also seeing new investors come in. We're seeing, say, self-directed traders come into the space. And when you look at something like perpetuals, these perpetual contracts are attractive to some of those new participants. When you start to scale back and see what's important or what's popular, say, about these products, it's their small size, it's their operational ease, it's the capital efficiencies that they offer, and liquidity, right? So when you look at those things, right, and look at what we can do, well, we announced, just last month, we announced what we're calling spot-quoted futures. Now, these spot-quoted futures products are long-dated futures contracts. In this case, it's going to be a one-year futures contract. They're going to be small in terms of size. We're looking at 1/100th of a Bitcoin, 2/10 of an Ether. So in terms of notional size, less than about 1,000 for Bitcoin, about $500 for Ether. So very small. These contracts are going to be, you don't have to roll them as often because it's a one-year contract. So you got the operational ease. These are going to be regulated contracts. So the point that you made, all these perpetual contracts exist on unregulated offshore entities by unregulated platforms. These products will be offered by CME Group, a long-standing regulated entity. And we anticipate that these products are also going to be fairly liquid, right? So we're super excited. In addition to that, and to the point that you made then in terms of will it, say, cannibalize our existing set of products, I think it will enhance because it's really bringing a different type of client. Imagine a client that expects a movement, say, in Bitcoin and Ether, and they want to best capitalize on that move. The right product may be spot quoted as opposed to a client who's looking to maybe hedge some longer term exposure where a futures contract, say, our monthly or quarterly contracts may be more appropriate for that client. So I think they're really going to bring new participants in. The other thing that I'll mention is that we're not just offering this for Bitcoin and Ether, we're also offering it for S&P, NASDAQ, Dow, and Russell. So we're also allowing market participants that ability then to diversify and not just hold all eggs in one basket, if you will.
And how do you think about attracting a new customer base wanting these types of products? What types of steps have you done or do you plan to take when things open up in the US?
Yeah, so great question. So we've been working very closely with retail platforms. So there's a lot of interest from the likes, like, for example, Robinhood recently integrated into our space. So there's interest from firms like that as well as others, Interactive Brokers, Plus 500. globally as well. So we're super excited to continue working with partners and helping to grow this new product set.
Great. So let's cap off today's discussion. I know we have a little bit of time left, but I think there's a lot to say to talk about the discussion draft of the new market structure bill that was put out by the House Financial Services Committee and the House Ag Committee a few weeks ago. The discussion draft of the bill creates brand new jurisdiction in the United States for spot crypto trading for a new asset class that they're calling digital commodities, and creates new types of entities that must register with the CFTC, so digital commodities exchanges, digital commodity brokers, and dealers. Commissioner, can you explain why you think this new category or this new jurisdiction is needed, and how do you think about opening up jurisdiction for the CFTC?
Yeah, absolutely. The CFTC actually, as it stands, we have anti-fraud and anti-manipulation oversight over cash crypto trading. But the unfortunate thing when you are going in with a new enforcement authority is that something bad has already happened. The customer's funds were lost, fraud has occurred, manipulation has occurred. So the idea is if you can create a regulated space and bring in these markets into the registration process, the oversight process, the examination process, you're going to be able to put some safeguards in place so that there's hopefully less of the situations where you're coming in where there's fraud and manipulation. I think the other piece to this, we hear a lot of people talk about crypto fraud. I think that's a bit of a misnomer because it's just fraud. Right. It's not new, it's just the crypto wrapper around fraud. I think when there's a safe place for retail participants to come and trade and be in the cash crypto market, I think that's going to help draw those interested parties away from the temptation of getting caught up in some of these fraudulent schemes that we are seeing.
Yeah, and I think help bring more crypto trading onshore, like you were both talking about. Yep. So quickly, there's an arm of the CFTC called Lab CFTC. It's actually been around since 2017, but we haven't heard a lot from it of late, and it's the arm of the CFTC that's meant to promote innovation in fintech, including in crypto, and it had done a lot back in the day. And one of the pieces of the market structure bill is it brings Lab CFTC back into the fore and makes it a really important part of opening up this spot jurisdiction. Can you talk a little bit about what Lab CFTC's role would be under this market structure bill and what you think it should be doing going forward, aside from market structure or not?
Yeah, absolutely. Lab CFTC, as you said, it's been around since 2017. It actually was renamed under the previous chairman as the Office of Technology and Innovation. I think part of the reason that there is a kind of statutory codification of this division within the market structure bill is because it is a little bit subject to the whims of the chair, and I think the House Senate or House Agriculture and Financial Services committees recognize that it's a very important division within the CFTC. It really does serve as a bridge between industry and the policy divisions at the agency. People can come in; they're much more comfortable speaking with people who understand innovation, who are kind of on the forefront of this technology, sitting down with them, talking through their business models, and then it's almost a connection service, almost like a dating service, where then they'll bring in the appropriate staff from the divisions. It can be very overwhelming when you look at our structure. Where do I go? What's the right policy division? Lab CFTC can bridge that gap, and they become the true experts at the agency as well. They're who we go to when we have questions. They help us learn and educate the commissioners and the staff about what's coming, where's the technology, where's innovation headed. And I would really love to see Lab CFTC become more of this kind of technology-based division within the agency. We have a lot of new products coming online. We have a lot of new market structures. And I think you could really use some of the expertise that we have throughout the agency, bring them into Lab CFTC, and have that kind of be the hub for a lot of the new products and new market innovations that we're seeing. So I think there's a lot of opportunity there, and I was really pleased to see the discussion draft codify that division within the agency.
I think my favorite part of this whole panel is describing Lab CFTC as like a dating service for innovation. So I guess that means we should all go in and date the CFTC a little bit. But Gio, given the shifting landscapes on regulation and legislation coming forward and how the digital asset market is moving, what do you think lies ahead and what's next for the CME?
Yeah, that's a great question, and like I mentioned at the beginning, we are in a new era of crypto. But I think for us, it's still continuing to develop our existing product set, Bitcoin, Ether, and of course our more recently launched products. We talked about Solana earlier, but just this past Sunday we also launched XRP. So we'll continue to develop those in-market products, and we're always talking to clients, always listening to where else can we help in their journey. So we really look forward to continue those conversations and working with other partners as well, and just helping to continue grow this ecosystem.
Great. So with the time we have left, and it's coming to a close, but I'm interested to hear what you're both most excited about in the let's say the next year, of what types of innovations or advancements we can make in crypto, and if it touches something in the Solana ecosystem, even better.
I could start, and I don't want to steal any of Gio's thunder, but I do think tokenized collateral within our clearinghouse system, that to me is really exciting. It's going to solve for a lot of problems that we see when you start talking about margin calls, intraday margin calls, late day margin calls. The idea that you could have tokenized collateral moving in that system, I think, is really exciting and has a lot of opportunity. I do think seeing perpetual perps come back on shore and be in the United States and regulated by the CFTC is an exciting opportunity for the agency, and I think just for the United States economy to have that trading activity here on shore. And just the new market structures we're seeing. It's a very different world, and we are seeing new and innovative ideas all the time. And it's you almost can't wait to see what comes in the door next, to see what efficiencies people can bring to the market.
Yeah, and I agree with you, Commissioner Mersinger. I feel look forward, say, to stablecoin bill finally being approved, because I think that's going to really help further propel this industry forward. And for me, like personally, CME, we've got 6 asset classes, so I'm really looking forward to that 7th asset class coming along the line pretty soon.
Amazing. Well, thank you so much for your time today and for being here.
What an incredible panel. Unbelievable glow up for the Solana ecosystem. Hopefully you all are having fun. I know we're getting to the middle of the day. You've had your coffee, hopefully some snacks. I'm back. I don't know if you missed me or not, but now I'm actually going to be a participant in a panel with my good friend Roger Baston, Head of Digital Assets from Franklin Templeton. Please give him a warm welcome to the stage. Thank you.
How you doing, buddy?
I'm good. Great to see you.
You too. Thank you.
All right. So Franklin Templeton was actually the first TradFi asset manager to bring a tokenized fund to Solana. So first of all, thank you. Thank you for bringing your incredible brand and reputation to the Solana ecosystem. So you've been at Franklin Templeton for more than a minute.
Yes.
Tell me about your journey to blockchain, and how did Franklin Templeton come to be an early innovator in this space?
So, yeah, I have been at Franklin Templeton a while. I've been at Franklin Templeton since 1991, even before it was Franklin and Templeton. I made a really good decision lots of years ago to just hire people who are much smarter than me. Smarts comes in different forms. There can be technical smarts, there can be wisdom. I like to think that I've acquired a whole bunch of wisdom over time, but that gave me the space to be thinking about other things and not just doing my task at hand on job. And one of those was paying attention to the words distributed ledger technology. Lots of time in the asset management capital markets business, full of ledgers. For sure, there was something here that was both opportunistic as well as challenging to the current business model. And so I was just encouraging my friends and mentors like our CEO, Jenny Johnson, to be, let's lean into this in a larger way and figure out what this might mean for our business and for our customers.
So I recall there being some anecdote about a video game or something, a use of digital currency.
Oh. You're wanting me to tell a story about my son, who was active many years ago in playing Call of Duty, and doing that and posting it on Twitch and being paid in Bitcoin. When he became a teenager and he had too much time on his hands, and I was encouraging him to potentially go get a job at the local Pete's Coffee like his older sister did, he showed me his digital wallet and he had like $80,000 in it. He said, "Dad, what do I need to do that for?"
Hopefully he wasn't the kid that bought the Bitcoin pizza. It's Bitcoin Pizza Day. Was he the one who bought the Bitcoin pizza?
He was not a pizza,
okay.
No.
So Benji and Biddle and these incredible tokenized money funds that have ushered in a wave of RWA on the blockchain have been watershed moments for the industry. What's been easier than you thought, and what's been harder than you thought?
Well, I don't want to go down the regulatory path because that was clearly the hardest part. Lots of money, lots of consultations, lots of education to our regulators, especially in Washington, the SEC, about that we were using blockchain technology. We were not a decentralized actor pumping out coins. We were using blockchain technology to increase the user experience for one of the most boring things on planet Earth, which is our government money funds. What were those new utilities that we were able to come forward with? Instant transferability. Literally the fact that you and I can send Benji back and forth to one another literally as fast as we can get a block on the Solana blockchain, right? And it being the source of truth, right? Not in some sort of secondary or shadow record-keeping system, but actually being the source of truth. The other great utility that we'd be able to unlock by being on-chain as the record of the source of truth for our transaction records is that we have created something for which we have a patent pending called intraday yield. So if I transfer you Benji at 9 o'clock in the morning, we've broken the 24-hour cycle into seconds. So literally at 9 o'clock and 1 second, you begin accruing the yield for the rest of the day. Now, these things might not be so interesting to individual investors, but I think in the US, there's roughly $7 trillion in money market assets. That's a big number, right? And for institutional users, especially for the thing that we're spending a lot of time on, which is collateral management, every second of every piece of interest counts. And so these are breathing new life into something that's been around a long period of time and making it far more useful because we're on chain by and large. So that's a huge benefit, quite frankly.
So you talked about big numbers. Franklin Templeton manages $1.5 trillion. It's probably higher as of today, I don't know. But if you look out a few years into the future, we're still in the absolute earliest innings of RWA on chain. How much of that $1.5 trillion do you think will be on the blockchain?
Well, if I look out in the future, what I really hope and expect for Franklin Templeton is not because current assets or the current book of business all migrates on chain. I think that's a little bit more of a heavy lift, primarily because when we talk about tokenization and you're talking about securities, it's all about a legal regulatory construct called transfer agency. Transfer agency activities are usually outsourced to other entities outside of the investment management firms. In Franklin Templeton's case, as it relates to digital assets, we've kept that transfer agency in-house. I think that's one of the reasons why we've had some of these permissions that we've gotten from global regulators, because they see the asset manager, they see the transfer agent, it's the same legal entity by and large. But what I do think, and what my hope and expectations for blockchain and digital assets is that it expands the opportunity set of assets. So rather than just think about current assets that now use a better and improved record-keeping system, it's about what is the unlock for all different and new types of assets. Because I'm always trying to solve a problem for the clients about giving them a better solution. I don't only want to just increase kind of the efficient frontier, And by the way, why don't we just wipe away the fact that we really don't live in a two-dimensional world? It's not just risk and return, but I think the promise and expectations in our journey toward digital assets is that there is a third, fourth dimension that begins to be explored for clients and their assets. Impact might be one of those, as an example. So I think there's actually a plane, that exists across multiple dimensions that you're optimizing for, rather than just tangent on a risk return. So I'm hoping to expand the opportunity sets for better outcomes for clients, large and small.
Awesome. So basically the matrix for RWA. So I think Solana is your favorite blockchain. I'm not going to put you on the spot, but it's not the only blockchain that Franklin Templeton has built on.
Yeah.
How do you think about what blockchains to build on, and why did you choose Solana?
Well, we actually, in our work with the SEC, presented a suitability criteria punch list that we would go through that gave them great comfort that we were protecting savers' assets, right? This is what the SEC is challenged for. It's just saying we are here to help protect savers' assets in the long term. And that suitability criteria has a number of different factors related to it. But by and large, from our perspective, and when we're thinking about money funds, we started this journey with money funds simply because we knew that money funds were already in the transactional economy, right? For those macroeconomists in the room, money funds sit as M2 in money supply. Check writing and debit cards have sat on top of money funds for a long period of time. And so when we started down the path on Benji, we specifically were looking at money funds because we just knew there was a higher velocity of activity. And in our first conversations with the SEC, and we started talking about the possibilities, they were saying to us, oh, you're saying that you could pay for something with Benji. We're like, yes, you could, over time if those future spaces come online. And so that is kind of where we started and all that, by and large. But that also means we need to be really fast, right? We want to have the experience when you go and you purchase your Solana swag from another participant at the meeting, that if you do that with Benji, you can make it happen just like that.
So Franklin started its on-chain tokenized RWA journey with money funds.
Yeah.
We were talking a bit backstage about what might be next. If you could maybe share a little bit about what you think the future looks like in terms of asset classes, and I'd be remiss not to ask, when ETP? When Solana ETF?
Well, I can't really talk about the Solana ETF that we have on file. That's a public filing, so I'm not allowed to talk about SOEZ, which is our ticker symbol that we've chosen for the Solana ETF. We're trying to make Solana easy to invest for those people with brokerage accounts. So easy is our product. Thank you. Thanks for that support. Literally, I think what we're really seeing, and probably because a lot of the work we're doing specifically with a lot of crypto native hedge funds currently who are using stable coins as collateral, yet they want their assets to be earning something, and so they see complementary Benji tokenized money fund offering this yield all the time, building this kind of complementary opportunities with stable coins in order to flow in and out of yield when you need it, and using those in collateral constructs. That has really come onto our radar in a large way. I think a couple of years ago, if you had asked me about tokenization, some of the kind of the fantasy land was, oh, if I tokenize a alternative asset, I'm going to create a whole bunch of new liquidity for it. Newsflash, market makers want to make markets in homogeneous commoditized products, right? So they don't want a whole bunch of idiosyncratic risk to do that. But what we do fully recognize and are looking for a future is where there's more collateral, taking private funds, tokenizing them, and allowing you to do more with that asset rather than just wait for the long-dated returns.
Yeah, I think that's really important, is utility, right? Like, how do we bring this high-quality collateral to DeFi? And so my next question would be, we've got a lot of incredible builders here in the room today. What advice would you have for builders that want to bring institutional RWA, like Franklin Templeton Benji, and other things that you have in the pipeline to the DeFi ecosystem?
Yeah, that's a really good question, because when I think of being a builder, I think you're starting something new and fresh. I mean, the best advice I have, and this is the path that I had to punch through, and our team had to punch through, specifically with Benji and the other products, is just keep at it. Just keep at it. Have persistence. If something doesn't work, don't be afraid to pivot quickly and sharply to something else, because, just as we have seen in this whole space in the past several months, things are moving, quite aggressively. And, we're in the business in the asset management of trust. A lot of times when we're building an ecosystems like Solana, we call ourselves building trustware, not software, because at the end of the day, you have to, and Solana as a brand inside of that, have to deliver a trusted experience that people want to use you again and again and again. So I think persistence is always a good strategy in any endeavor that you have, but those are kind of some of the advice I would have.
Oh, trustware, I love that. So we've got a minute left, Roger. Give us a spicy take on anything.
On anything. Given the seat that I've been into for lots of years now in kind of TradFi, traditional markets, I think what you're really going to see is those trillions of dollars of assets that sit in mutual funds are going to start adopting a lot more digital asset projects into their investment portfolios. You haven't seen a big wave of that, but one of the unlocks of the ETFs is that you're bringing crypto native assets back into TradFi ecosystem that allows trillions of dollars of capital to begin to invest in them, so that projects like Solana meet their long-term objectives and be able to permeate in a substantial way.
Love it. Thank you so much, Roger, for joining me today, and look forward to much more together.
Thanks.
All right. Next up are some of my favorite people. We've got Christine Moy from Apollo, we've got Cindy from Drift, and we have Reed from Securitize. They're going to be talking about utility for TradFi RWA in DeFi. So please welcome Christine, Cindy, and Reed to the stage.
Hey.
Woo! Let's go, Solana! What's up? Let's go.
Woo!
Thank you so much, Nick, for also being the one bringing all of us here together. It's been a pleasure working with the both of you on bringing ACRED to Solana for the first time.
Absolutely.
So today is actually a very historic moment. Today is the day that Apollo's flagship credit fund is now live and tokenized on Solana via Securitize. So it's the first time ever that an asset like private credit has been publicly available on a permissionless blockchain. And we're also very excited, as the founder of Drift, to announce that we have launched a leverage strategy that boosts private credit yield from 9% to up to 17%. So let's dig into that. Reed, tell me about the process of what ACRED looks like, why are you so excited by it, and how can users get in touch with it?
Sure. So Securitize is the issuer of ACRED. You can visit securitize.io to get signed up. Finish some KYC, make your investment, and you've got access to the tokenized version of Apollo's flagship credit fund. I think what's really exciting about having that asset on-chain is crypto people have really had to deal with interest rates on-chain being super volatile and only really being a function of kind of supply and demand in isolated markets for stablecoins. So Christine's fund is an expert in investing and generating a sustainable yield that has nothing to do with any dynamic on-chain. And what that means is you get a reliable, low volatility yield that can be relied on. So you're not trying to constantly move your assets to chase where there's a yield. And that's an asset that with Drift's help, we're able to unlock in DeFi, and crypto is able to build on top of that asset.
Very cool. Thank you so much, Reed. And very silly of me to forget introductions, but Christine, would you mind kicking us off with an introduction about yourself and what Apollo does? and then we'll kick it off to Reed after.
Yeah, sure. Really excited to be here. This is actually my first major Solana event, and I love the energy, and I'm so energized to be part of this ecosystem now. So I'm Christine Moy. I'm a partner at Apollo, looking after digital assets, data, and AI strategy. From a background perspective, I've spent over a decade focused on the tokenization of real-world assets. Previous to Apollo, I built and led JP Morgan's blockchain program. So if you've heard anything about JP Morgan tokenizing $2 trillion of treasuries and US dollars on a permissioned Ethereum blockchain, basically led that program. Apollo is a $750 billion asset manager with businesses in equities, credit, real estate, and retirement services. And at the core, Apollo is in the business of generating excess spread per unit of risk. What this means is we're in the business of generating alpha. Alpha that is differentiated from what is broadly available in the public markets. Now, we're able to generate this alpha in a couple different ways. Like the most differentiated way is that we actually have a diversified number of companies that we've either bought, invested in, or incubated that actually create credit spread. So when Reed talks about the yield, the sustainable and scalable yield, and by the way, when I'm talking about scalable, we're a $750 billion asset manager. $550 billion of that is yield, is like credit, essentially. We have this proprietary credit engine that creates all different types of credit, like aviation leases for airline companies, fleet leasing if you're need to get a bunch of Amazon delivery trucks around, lending to mid-cap companies and also large cap companies. You may have seen, for example, Apollo lent $11 billion to Intel to build AI chips in the past year, but also ranging to if you want financing on building a hot tub in your house. So the whole range, that's how we get differentiated yield that is sustainable and scalable. The other thing that's really important is that at Apollo, the way that we invest, we are fully aligned with our investors. So what that means is that for every asset that is in any of our Apollo funds, Apollo is actually invested with our own balance sheet. So for example, the fund that one of the funds that we're talking about here, we've indicated that 90% of what's in that fund, Apollo has invested in through our own balance sheet. And whilst we can't guarantee returns, we can certainly guarantee we don't like losing money and we definitely like making it. And so, basically, you will be aligned alongside Apollo. So that's a little bit about myself, my background, why this moment is so important. For those of you that I see you in the crowd, you've known me for over a decade, you know that my mission has been how do we get real-world assets on chain? That was the first thing. And then how do we actually use the amazing innovation that all of you are building through DeFi to unlock these assets. And so that's why I'm super excited about what's happening today that's live.
Incredible. And Reed, tell us a little bit about yourself and what Securitize has been doing to help push this mission of RWAs in crypto forward.
Sure. So I've been at Securitize for about 2.5 years. I sit outside of the regulated footprint that issues the tokenized securities. And we are focused on building products and solutions that allow those securities to interact with DeFi in the permissionless way it works today. And I think what's exciting about having these great quality assets on chain is also sort of is a counter, is that they're permissioned, right? And one of the great things that happens in DeFi is the speed with which you get to experiment and iterate. In TradFi, for instance, Christine's fund, you can't really get it levered. You can't really walk around with your shares and try to ask someone to lend against it because it's illiquid, it's private, and it's generally not sufficiently interesting enough in the size you would want for a bank to advance you against it. But guess what? You take the tokenized version of that, you use our technology of S-token vaults on Drift, and now you've got an asset that really anyone can experiment at the speed of crypto. right? And it doesn't require a massive balance sheet. It doesn't require some credit committee. You can just go and test things out. So that's what we've been, and also why I'm between both of these ladies is we're working together and experimenting on deploying this on Drift, where like Cindy said earlier on, natively it yields about 9%. Through Drift's technology and their platform, our target will get this up to about 17%. And that's sourced from permissionless liquidity on-chain through regulatory through approved regulatory avenues. And like everyone has said, it's available today.
Yeah, and if I might add, I think it's super interesting what you touched on, which is that when you have a DeFi engine, it actually doesn't matter if you're transacting hundreds of millions of dollars, tens of millions of dollars, single millions of dollars, or just $50,000, which is the minimum. Right? Like the technology is built and it's scaling, right? So like I think this is like a really fascinating thing, especially for those of you in the audience that have been in traditional finance and you know the cost basis of legacy systems and teams that have to support the businesses that exist today. And so, you know, I think we've moved away from blockchain for operational efficiency. That is certainly not the lead. The lead is around product innovation, meeting the next generation of crypto native investors like you. That's the main focus. But it's table stakes that it comes with a killer cost basis of near zero for incremental like business growth. And so when you think about like, and I think about it because I'll always be on the side of TradFi. Like, I love you guys, but I feel like I have my place and this is my mission. But if you think about like a TradFi institution that has that cost base, over time, as more assets move onto chain, as more assets are driven by DeFi, like Drift, who's going to win? Like, if you can scale to millions and hundreds of millions without having the same number of operational team members and processes, without the same, you know, kind of engineering cost of any incremental feature, like what's that really going to look like? And so, you know, I'm skirting the edge. Save me when the time is end. But for now, like I'm doing my part to help lead traditional institutions to the water.
Absolutely, and that is exactly the vision of early Solana. That is the vision of why we built a capital-efficient DeFi platform, because we believe that all assets are eventually going to be used on the most capital-efficient and programmable chain where they can actually coexist next to each other. We're just seeing the start of this now with a single private credit looping strategy. From DeFi terms, it's actually a very simple LST looping strategies, right? Like, how many of you guys in the room loop your SOL LSTs in DeFi? I'm sure, you know, a lot of you are familiar with this strategy. Now, imagine doing this with private credit. Imagine using your SOL LST to borrow stablecoins and invest into Christine's incredible private credit strategies. And that actually offers a differentiated source of yield that matches your crypto portfolio and gives you a fully diversified portfolio that doesn't only rely on crypto native yields. So ultimately, that's the big vision of what we're shooting for here. But Reed, on your side, I want to know why is now the right time for us to be doing this? You've been working on this problem for a long time. What has been some major unlocks, especially on the permissionless side, that has allowed this token to be actually freely floating in a permissionless chain?
Yeah. So, I mean, we've talked about the institutions are here. We've talked about kind of the sustainability of the yield, the capital efficiency of that. But also, like, yes, the yield is great as an equity investor in the fund. But also, if you think about these assets are better quality assets for crypto to lend against. And so it really is beneficial on both sides. As I talked about before, you know, one of the friction points with bringing securities on chain is that they're permissioned. And yes, there is a KYC, and yes, there is an onboarding process. But otherwise, within that kind of white list of users, those assets can move around. Unfortunately, with US securities. There's also investor qualifications and some other friction elements. And so one of the things that we've built at Securitize is really this S-token vaulting technology. And it allows this asset to compliantly exist. You retain ownership of it, but we're able to mint you what we call an S-token. So in this case, it's sacred. It's supported on Drift. And that S-token really functions as a way to demonstrate to a lending platform that that security is locked away. It can't be touched by the owner of the asset, but it's there as a collateral stand-in. And that's been able to, as we say, unlock and kind of allow this asset to get better exposure across DeFi platforms. And that's really what our focus is. We don't think everything needs to be tokenized, but we want to tokenize things if there's a way that we can add incremental utility or increase yield, and that there's value really for it to exist and be used in a tokenized form.
Amazing, thank you. And Christine, you recently entered the DeFi rabbit hole. I would say like 6 months ago now, after a decade of working in this space. What has it been like working with Solana leaders, DeFi leaders, in a world where everything is open sourced and people can kind of like integrate ACRED on their own? What has that experience been like for you?
Yeah, well, I can say that it's moving really fast. I'm getting my hair blown back by everybody over here. You know, I think if you look back in like the decade that I've been working in the space, I always said that crypto and DeFi would have the ingredients to enable the fastest, most effective innovation. Because if you think about it, like if you're at a traditional financial firm, innovation looks like one team, like one set of people with one set of ideas, taking a few months to write requirements and then figuring out how to socialize it and prioritize it. And then it takes another year to build it, right? So that's like a really long spectrum. And then on top of that, it's actually unclear whether or not there's even market demand, right? Like you haven't even been able to get the feedback loop because you haven't built it and it hasn't been kind of there. Now, in crypto and DeFi, it's turned around on its head a little bit. It's a little bit scary, but it's effective in that you have multiple teams that have independent thought, a diversity of experience and background, all trying to work together on the same operating system, right? Like we're all operating on the Solana ecosystem right here. And that exchange of ideas, that ability to just do things really accelerates progress. And then here's the other thing, as you just do things, as you build smart contract applications and you launch them with real money, that's literally that is the best testing that you can ever have. I mean, of course, there's a lot of UAT testing that goes in before you launch, right? And that's what we would hope for in audits. But there's no better way to get to the bottom of, does this thing work? And do people actually want this? Than to actually just put it out there in the world. And that's the really powerful thing about the Solana ecosystem, the fact that there is such a strong network of builders, of investors, of everyone in between, of different backgrounds, that we can just do things. We can just put it out there and see, how is the future of finance going to roll out? We don't need to guess. We don't need to hypothesize. We don't need to write thought leadership papers about it. We can just do it, and then we can iterate and adjust. That's sick.
Incredible.
I'm here for it.
We all have such high agency in the Solana ecosystem that things just happen. And very excited to again say that this product is now live, and you can just deposit in it. You can just have risk managers like Gauntlet manage the risk on behalf of you in this leverage strategy. So just to say again, ACRED is now live on Solana. And if anyone has any questions about it, feel free to look out for us after this. But before we end this, I want to do a very quick lightning round of questions. Where do you guys see DeFi TVL in the next 5 years? Reed, let's start with you.
In the next 5 years? Oh, geez.
Let's say 5 and then 50.
Okay, well, so what?
Yeah.
33 trillion of equities. 5 years, I think, let's say 15 trillion.
Wow, it's amazing. 15 trillion.
I mean, for my part, like I'm not measuring in TVL. You know, like as many of you know, I've mentioned in the past, my mission is to democratize access to excess spread per unit of risk to this alpha, right? Historically, the domain of large sovereigns and institutions and retirement systems, I want to make sure you have access to that. Why? Because Apollo is in the business of building better retirements. Y'all are really young right now, so you're like, retirement, like, wah, like, let me look at my phone. I don't really care about what you're talking about. But like, in reality, what are we all here for? Why do we invest? Why do we build? Why do we work? We do this so that we can build the livelihood for ourselves, for our families, for the generations to come. And so, whereas Apollo has the expertise to take your hard work earnings and multiply that with the excess spread that we can generate, being able to provide broader access of that to you in the way that you want it, and it sounds like y'all want it on the blockchain, and over time, especially as we get to the advancements of AI, making that even more customized to your everyday like liquidity needs, like all of your savings goals. Like basically, we have the opportunity to create customized, like personalized portfolios that help you have a better life with you and your family off of your hard work earnings. So that's what I'm here for. Leverage us to the point that you're all retiring, like in your early 30s. That's a win from my perspective. That's what I'm working towards.
Yeah, we're all here to make it together. And there has never been a better time in history for DeFi and TradFi to converge in such an optimistic way. Macro tailwinds are here, regulatory all-wins are here, and we're really here to see TradFi converge into an on-chain DeFi institution. And all of that is going to happen on Solana. So thank you very much for joining us today. This was amazing.
Thank you.
Thank you.
Democratization of alpha. I love it. Who wants that? Who wants that? Raise your hand. Do you want more alpha? A couple people? Come on, let's see some hands. Let's see some hands. All right, so equities. So hot right now. We love tokenized equities at Solana. We've been talking about it all day. I'm excited to welcome to the stage my friend Matthew Siegel from Van Eck and Parker from DeFi Dev, one of the fastest growing public equities on the planet, to talk about what's next. Give them a big round of applause.
Okay, welcome everyone to the afternoon session. I'm Matthew Siegel from Van Eck. We are a mutual fund and ETF sponsor that has expanded rapidly into crypto. We've been bullish on Solana, especially for 4 years now, written a lot of research on what value Solana can bring to the world. Our most recent product is an ETF that holds equities in the space. It's actively managed, called Node Van Eck On-Chain Economy ETF. So this topic is very relevant to me personally because I have my eyes on the equity screens every morning. And over the last 6 weeks, can't help but notice the astounding performance of one stock in particular, DFDV, DeFi Development. This stock has gone from 70 cents 6 weeks ago to $42 as we speak, roughly $600 million market cap. I'm thrilled to have Parker White, the CIO and COO of this firm. Parker, welcome.
Thanks, Matt.
Maybe you can start with the genesis story here. What is the idea that you had? What were you able to execute on? How did this capital formation happen so fast?
Yeah, so I've been in the Bitcoin space for quite a while, been a strong Bitcoin believer. Some might even say almost a Bitcoin maxi for quite a while. And seeing what MicroStrategy's done, what Saylor's done, and so kind of watching that trajectory over the last few years, and been running a Solana validator for a little while as well. And so it was 127 days ago. Joseph, our CEO, and we both worked at Kraken for quite a while. We sat down and I sent him a 2-3 page kind of proposal on just an idea. We were just kind of noodling on stuff. And it was like on a Thursday, and he was like, oh, this is great. I love this. Sunday, he called me, and he's like, hey, I've met this guy, Blake Janover, and he has a company. Do you guys want to, do you want to do something? And so from that day, it was about 83 days until we did the change of control, took over Janover Inc. at the time, renamed it to the DeFi Development Corporation. And it's been a pretty insane ride ever since.
So just can I level set, how much capital did you raise?
Sure. So initially, to kind of get us off the ground, we raised about $42 million from Pantera, Kraken, Arrington, and a number of others. The entire team is former Kraken, and so it's great to have kind of the backing of Jesse Powell and the old gang. We like to think of ourselves as the Kraken Pirates, the Kraken Breakaways. So 42 there. And then a couple weeks ago, we raised about $24 million in a PIPE, which is a private investment in public equity. And that was a common or straight equity deal from a number of investors in that round as well.
Last cycle, when investors were getting their heads around DeFi, there was a very simple question that came up on the podcast with SBF and Oddlots. The question was, where does the yield come from? So I want to ask a similar question. Many of these crypto balance sheet companies are trading anywhere between 2 to 5 times the value of the underlying coins that they hold. So the question is, where does the premium come from? Why should investors pay more than the value of the coins that you hold?
It's a great question. So the way that we think about it, and I have to give credit to our wonderful IR guy for kind of coming up with this, this viewpoint, but what you actually do is you want to take the NAV and you want to separate it. You want to do a kind of a sum of the parts analysis, if you will. So you actually just value the coins on the balance sheet as one, because a dollar is a dollar, right? But then what you want to do is you want to look at the expected, or your view of the expected future growth rates in those coins on the balance sheet. So in the same way that you might pay a PE to a company that is growing earnings, and you nowadays you pay quite a pretty large multiple there, you would ascribe some value to the accumulation component in the future. Because if I could buy one Solana today and it's just going to be one sold forever, then I would just pay $1 for that. But if I could buy something that would be one sold today and then 2 sold the next day and then 3 sold the next day, you would be willing to pay more than 1 sold today, basic finance 101, present value stuff. And so that's kind of how we think about it. We separate the NAV to its current value and then this future projection. And we think that kind of evaluation framework makes a lot of sense.
Okay, so the yield on staking Solana is 5 to 7%, something like that. So you should be able to earn kind of that base level of return. The valuation of the stock implies that you're going to grow a lot faster than just a staking yield or a validator business. So how does that work?
Sure. So there's a number of components to a treasury strategy, and I'll speak to one on Solana in particular. There's certainly the staking yield, as you highlighted there. We run validator in-house as well, and so we don't pay fees to a third-party validator. We keep that fully vertically integrated, if you will. Then on top of that, we can get third-party delegation. So we did announce a Kraken partnership a number of weeks ago. We announced a Bonk partnership last week, hence the bandana here. Shout out to those guys. But there's lots of partnerships that we can do where we can get additional delegated stake to the validator, and that all flows through to SOL per share growth, which is our key metric. On top of that, there's other things that we can do. There's discounted locked SOL out in the market. that as long-term, large buyers of Solana, we can take advantage of in a way that, the guy with $1,000 on Kraken or whatnot can't, get access to. And so there's a number of ways that we can generate this, yield. Then, of course, you've got the MicroStrategy playbook, issuing converts, issuing equity. But the business for us actually works even if you throw all that away. Because of the validator, because of the external delegation, because of some of these other things. That's how we're able to generate above the kind of median staking yield of, the globe.
Last cycle, the crypto companies that took on debt had a pretty tough time in the bear market, right? So Bitcoin and debt are kind of allergic to each other because it's this bearer asset, and many of the largest balance sheets in the world can't really touch it still. So I think there's a consensus that debt is bad. Maybe you can tell us why that might not be the case for DeFi Dev.
Sure. So I think debt in the appropriate amount is good. It can be used as a turbocharger, right? A lot of gasoline with a match is really bad, but gasoline in a race car is really good, right? And so I think it's very important to manage debt. But I think a key component here, key differentiation, is secured versus unsecured debt, right? So secured debt, you can have a margin call on it. The asset wicks down 50% in a day, and you get liquidated, and then the next day it's up 40%, but like, too bad, you're out, right? Versus with unsecured debt, it's simply an obligation of the company. It's kind of like a credit card, right? Where it's an obligation of you as the individual and your credit score. It's not like a car loan where it's secured by that car, right? And so unsecured debt, as long as you're able to make your coupon payments and you have enough cash at maturity, or you're able to refinance at maturity or at some point before, it's much less risky than, at least from a crypto volatility perspective, than secured debt or a margin loan, which you can get liquidated at any moment because these are volatile assets.
One thing that Michael Saylor has done very well is make relationships with the convertible bond managers who are running these arbitrage strategies of buying convertible debt and shorting the stock. And he's promised them that MicroStrategy will deliver a certain amount of supply at a certain amount of volatility. And then the end buyer, the convertible bond buyer, might not even care about Bitcoin. But at this point, kind of everyone knows the investment thesis for Bitcoin. So when you look to seed the garden here and educate the convertible bond buyers maybe about why DeFi Dev may be an attractive issuer, are you educating them on Solana too? Does it matter? Where are they in that adoption curve of understanding the base asset?
It is still very early. We had a kind of a non-deal roadshow, if you will, earlier today with some investors, and we spent, 75% of the discussion talking about staking and the difference between inflation rewards and block rewards, how a validator kind of serves as like a toll booth, if you will, collecting transaction fees. We spend, I would argue, the majority of our time actually talking about Solana and less about the company strategy. Thankfully, MicroStrategy is kind of laid out, at least the foundation of the company strategy. We think of ourselves as MicroStrategy Plus, but that story is actually better understood than the Solana story. And so, we end up seeing ourselves as a bit of Solana evangelists to a whole bunch of people that, shocking for this room, but a whole bunch of people that have never heard really about Solana, or maybe heard the name but don't know anything about it. So it's pretty cool to be able to do that.
Nice. What else have you learned from Saylor and MicroStrategy, or maybe something else, about how to handle the inevitable bear market?
That's a great question. I think it's obviously, as a public company, never promising anything that you can't deliver on, but ultimately making sure that people understand that, volatile assets are volatile assets, right? They can go up, they can go down, and as fast as something can go up, it can go down. And so making sure that investors, yeah, volatility is great. It's great to trade, but you always need to size your risk appropriately. And if you're concerned going into the weekend or overnight that like something's going to happen and it keeps you up at night, you should probably size down. And a volatile asset like this isn't for everybody. But for some people that want access to, over the last 7 weeks has maybe been one of the most volatile assets on the planet, it's a pretty interesting product.
OK, last question. We're sitting here 1 year from now. And don't worry, this is not financial guidance. But what would constitute success? Is there an amount of Solana that you might own? Is there a market cap? Is there a Solana yield? How should we measure success in a year?
So our North Star metric is SOL per share growth. And you can actually go on our website. It's right there on the main page. You can go to our executive comp tab, and you'll notice that all executive bonuses and non-executive bonuses are all tied to specific levels of Solana per share growth. So that's kind of our North Star metric, growing Solana per share on the balance sheet. I think beyond that, certainly things like market cap and volume, liquidity, all these things are great. Maybe beyond a year, really excited to put the days behind us where we walk into a room with investors and have to spend time talking about Solana. Our goal is for institutional investors across the capital stack, equity investors, debt investors, kind of crossover investors, they all hear the Solana story in the same way that Michael Saylor has been this evangelist for Bitcoin in these rooms that none of us crypto nerds have really been able to get into until now. So I think long-term success will be far more capital and investors knowing about Solana.
OK, crypto equities, watch this space. Give it up for Parker.
All right, great job. Thanks, Parker. Thanks, Matthew. Next up, we've got Todd Stevens, Chief Capital Officer at Figure. He's going to be talking about bringing more RWA to Solana, some that we really haven't seen before yet. HELOCs, and other incredible products. So please give a warm welcome to Todd Stevens from Figure. Love it.
Thanks, Nick. Hello, everyone. Thank you for your time, and sorry I have the late slot before a long holiday weekend, but anyway, so I'm Todd Stevens. I'm the Chief Capital Officer for Figure. Figure, we have two sides of the business. We have a lending business as well as we have a markets business. We started 8 years ago, and our North Star was always blockchain. We believe every asset will trade on a blockchain rail in the future, but 8 years ago that was a little hard. So we went down the stalking horse route of going to TradFi, but we still originate 7,000 loans a month on blockchain, but we actually sell them on traditional markets, whether it's whole loans or whether we sell them through securitization. So we have a lot of capital markets game, and what we're really excited about is pivoting our capital markets game to putting our assets into DeFi with Solana and being able to get a new audience, a better audience, and really bring new asset classes to the DeFi ecosystem. So right now, I mean, the previous speakers were talking about bringing tokenized equities, tokenized money market funds, and then there's a tokenized Apollo fund. We're talking about direct lending to our DeFi customers. And these are very stable cash flows that pay 8-9%, boring. It's middle America. It's a 750 FICO person. But this is an asset class that we believe will fly in the ecosystem. And we're looking for partners in the Solana ecosystem. And we are very excited about this. So what are we doing? And let me rewind a little bit. So our second lien origination is one of the things we do. The second thing we do, in February of this year, we had a yield-bearing stablecoin that was SEC registered and approved. It's the first SEC registered stablecoin in the US, and it's yield-bearing. Irrespective of what happens with the Genius Act and stablecoins, this will be a big unlock for the ecosystem. And we are going to bridge that through Wormhole and put it on Solana, and we're going to issue that through Camino. So I think that's going to have a ton of resonance. It is a yield-bearing stablecoin, which we're really excited about. The fast follow on Solana with us is having our loans come on to Solana. Again, we do $600 million a month in loans. And right now, we hand them over to banks to warehouse this, and we pay them 8% to warehouse for us. We would rather pay that 8% to the Solana ecosystem. And with a new product that we're rolling out called Democratized Prime, that will be available. So we are fully committed to bringing real-world assets to Solana, to the DeFi ecosystem, and in a very consistent basis. And so this is a new flavor the market hasn't seen. The market's seen tokenized money market funds, but it hasn't seen consumer lending access. I mean, you can get it in multiple different flavors via the ACRED fund that Christine was talking about, but we're very excited about that. The next thing I want to talk about is something where I think the DeFi community would really like is really democratizing access to prime brokerage. Prime brokerage is a massive business for banks. Banks make about $20 billion in revenues every year from lending to the hedge fund community. And they're limit long with all their exposure, typically, because they still look at it as a counterparty exposure. If we're working with some of the largest borrowers, some of the largest hedge funds, which is an $850 billion TAM, to come onto our platform and allow us to access that and put that into DeFi. So we're really excited about the opportunity to really democratize access to prime brokerage and allow the DeFi community to really have a space sitting next to all Wall Street's lenders. And again, we can throw this in vaults, we can lever it up, and we can get a 17% return if that's what the community wants, or we can just have a delta 1 at an 8% return for the community. So we're really excited about the amount of products that partnering with Solana that we will bring to the ecosystem. And I think on our side, we couldn't be happier with the partnership. So maybe in conclusion, we want to bring our total access to our loan collateral. We want to allow people to buy all of our production on DeFi. We want people to be able to lend, if you want to be a lender to our production, and then leverage our collateral and pledge our collateral into the DeFi ecosystem as well. So we're thankful to be invited to talk here. We're happy to be leaning into the Solana community, and we can't wait to get started. Thank you.
Jeez, that was fast. We want you to win. Thank you, Todd. So, fun fact, I joined Solana late July 2023. One of the very first ecosystem teams that I worked with as they were coming to Solana was Ondo. And backstage, we've got Nathan Allman, the founder of Ondo. So Ondo has $250 million of USDY, a yield coin on Solana. But Ondo is much more than that. And I'm excited for Nathan to share his vision for Ondo on Solana. Please give him a warm welcome. Thank you.
Great. So I'm here to talk about tokenization. What is it? Why does it matter? And what is its future? So tokenization, or real-world asset tokenization, as we are focused on at Ondo, is the representation of ownership of some asset on a blockchain, ideally a public blockchain, where that asset is not natively on that chain. Tokenization is great because tokens are transferable 24/7, globally accessible, programmable. They have a lot of features that we like. We've seen the value and the appeal of those features in the success of Bitcoin and other digitally native assets. And there is a desire in the marketplace to apply some of these features to traditional assets, particularly traditional financial assets. Historically, the focus, particularly in 2018, 2019, 2020, has been on taking the assets from traditional finance that feel the most broken from a settlement perspective. So private loans, funds, these assets that are illiquid, slow to settle. Syndicated loans take days to weeks to settle, and representing them in token form to try to make them more liquid and quick to settle. There's been a lot of money invested in these attempts, but they've generally not led to a whole lot. At Ondo, the benefit of tokenization that we're focused on is access. And we define access very broadly. So it's not just the ability to hold assets, but also to use them in DeFi wherever you want, and more broadly, to create financial products and services that can be accessed by anyone, anywhere, at any time. We've seen the benefit of this focus on accessibility through stablecoins. Stablecoins are, of course, the tokenized real-world asset that has by far the largest product market fit to date. Over $200 billion circulating on public blockchains, despite the fact that they pay holders no yield. And so at Ondo, we started our journey into tokenization by asking, how can we make stablecoins even better? And the obvious answer is by paying holders the yield from the treasuries that back the stablecoins. So we call these products yield coins, and we launched the first of our yield coins in early 2023, OUSG. It's a permissioned institutional fund that holds short-term treasuries and is transferable 24/7 and programmable, but only between institutions, qualified purchasers specifically, who are onboarded to OUSG. The market reaction to that was really positive, but people wanted something that was more globally accessible to retail investors and that functioned more like a stablecoin as a bearer, quasi-permissionless asset. And so later in 2023, we launched USDY, really the first permissionless yield coin in the marketplace. And then we brought it to Solana shortly after that. And since then, we've worked with a lot of institutional partners and a lot of DeFi protocols, many of which you'll see on this screen, to broaden the utility and distribution of both OUSG and USDY on Solana. To date, we are the largest issuer of real-world assets and tokenized securities on Solana. By count, about 99% of holders of real-world assets, I guess excluding stablecoins, are holding Ondo products, principally USDY. And there's about $250 million worth of those assets today. Just scratching the surface of the addressable market here. Stablecoin market is much, much broader, and even that we see as a floor. So really excited for future growth of tokenized cash on Solana. But what's next? I mean, tokenized cash is really just the beginning. We think the building blocks are in place for the next step in the tokenization journey. And we are really excited about building on the thesis of tokenization, really focusing on accessibility that's worked so well with stablecoins and that we've started to introduce to yield coins. These building blocks here, DeFi primitives, Solana has a robust ecosystem of trading, lending, derivatives protocols, which make tokens really useful. To date, that has been applied mostly to meme coins and DeFi infrastructure coins. And like all of DeFi, it's been a little bit of a sandbox to harden the infrastructure. And now that we have regulatory clarity on the horizon, I think it's time to start reapplying this infrastructure to the broader landscape of traditional financial assets. And so we are launching in the next few months Ondo Global Markets, which is our platform for bringing all public securities, so anything that you can invest in at Robinhood or in Interactive Brokers, on-chain. And you'll be able to buy and sell these tokens much in the same way that you can buy and sell stable coins or yield coins. So these will be bearer assets where you have to KYC and onboard if you want to mint and redeem, but they will be quasi-permissionless outside the US and outside certain jurisdictions in secondary markets. These will continue to double down on our focus on global accessibility. These tokens, really importantly, will be able to be minted and redeemed effectively instantly 24/5. We are leveraging the increasing 24/5 liquidity that's available in traditional financial systems and making that very natively accessible on-chain so that we don't have to, as an ecosystem, go through the very expensive process of trying to recreate all of this liquidity that already exists for these assets in TradFi on-chain, which has been a major hurdle of a lot of the historical attempts in this space. We are bringing sort of cheap or institutional cost margin to these products, so you'll be able to lever them up to pretty high levels, again, while you have access to liquidity and cost of capital that would traditionally be accessible only to institutional prime brokerage clients in the US. And as I touched on earlier, these will be freely transferable, and we're putting a big emphasis on integration in DeFi with leading protocols. So we're really excited to bring this to market. We think 2025 will be the year of tokenization, and we're trying to usher in what we call Wall Street 2.0. I think the Solana community calls it internet capital markets, where the best of DeFi, 24/7 access, transparency, composability, combined with the best of TradFi, institutional grade, investor protections, focus on compliance and high quality assets to build a financial future that is fair, more efficient, and more accessible to all. So stay tuned, coming soon.
Thanks so much, Nathan. Internet capital markets, we love that. So we've got a 15-minute break. Please stretch your legs, get energized. The rest of the afternoon is going to be amazing. Mike Cahill from Pith is going to get started in 15 minutes, so be back here soon. Thank you so much.
Solana Accelerate will begin shortly. Please silence your devices.
Hello! Welcome back, everybody. Did anyone have a good snack? Yeah, someone applauding? I like that. I appreciate that a lot. Thank you, thank you. Oh, wow, that worked. Let's go, that's right, LFG. All right, so for the afternoon session, this might be the end of the day, but it is also the best part of the day. And we have a really incredible speaker to kick us off. He's going to have a very pithy talk. It is Mike from Pith. I appreciate the laugh that I got over there. And he's going to talk to us all about market data. So everyone, please, let's kick us off. Let's put your hands together and give us a very warm welcome for Mike, Pithy Man, Pith.
All right, thank you. Good job. All right. Good to see everyone. All right, let's kick it off with a personal story from a few weeks ago. You may or may not have heard this, but I was at home in Portugal where I live. And out of nowhere, we lost power. All of Spain and all of Portugal lost power. Now, at first, I thought, OK, so what? The lights are out. I can't charge my phone. But then I tried to turn on the tap. No water. So, looks like I'm not showering today. I tried to leave the house, but the garage door wouldn't open. Tried to reach my phone, call an Uber, no signal. Ended up walking 2 miles to work. On the way, I stopped to buy breakfast. Don't take cards. I finally made it to the office. I had to walk up 26 flights of stairs. At that point, I realized something incredibly valuable about electricity. It powers everything. Powers all the systems I took for granted and silently working in the background. And funny enough, it made me realize something. That's the same thing for market data. Don't see it, we really don't talk about it, but you remove it, and the entire financial market collapses. My name is Mike Cahill. I'm the co-founder of the Pith Network, and I'm here to talk to you about finance's best-kept secret. Market data powers everything. But before I start, let's start with what is market data? First principles definition. Number one, it's the bids and offers where traders want to trade. And number two, it's where executions from traders have just executed. All right, the market data ecosystem looks like this. You've got traders at the top, followed by exchanges, and lastly, you've got data distributors. So traders, they send bids and offers to exchanges, and these exchanges are relevant to a specific asset class and a specific geography. Exchanges create this bundle of market data. Again, they're limited to what's traded on that exchange, and these are usually geographically constrained. And because there's a lot of them, you've got data distributors that bundle this stuff together from multiple exchanges and give a comprehensive picture of the market. Market data is financial electricity. It's critical. Without it, you have no idea what the price of anything is. You cannot operate. It's everywhere. It's not just one market. It's not just the lit markets. It's every single market, from the smallest country to the largest country, smallest asset class to largest asset class. And yes, it is highly underestimated. So if you think market data is just used for trading, think again. Market data powers every financial system. Much, much more. So how does one go about getting market data? Now imagine you want to open up a hedge fund. You know, you've got this great thesis on how to do a market data backtest. You want to get connected to everything. What you need is good fucking luck. No, actually, what you really need is access to data from mutual funds, ETFs, bonds, cryptocurrencies, equities, futures. Now, where does this all come from? So if you want to look at US equities, well, there's 13 regulated US equity exchanges, and that accounts for less than 50% of actual volume. So you actually have all these ATSs as well. There's a whole bunch of names there. Now let's go to futures. You've got different names that you have to get connected to. This is just in the US. Move over to the UK, and even different exchanges. Hong Kong equities, of course, different ones, et cetera, et cetera. And to put it all together, well, there's a couple of different data distributors that will sell you these packages. It's more vendors, more money, and more time. Now, what about the process? Okay, this is not your streamlined process. You're talking to sales teams, signing contracts, waiting months, spending millions and millions of dollars. The truth is, the market data economy is broken. It's expensive, it's incomplete, it's slow, and it's controlled by middlemen. The system was not built for access. No, the system was built for control. The cost of market data has gone up over 15-fold in the past 25 years. And this data is still incomplete. You're not seeing everything. It's maybe less than 50% of the data. It's a little bit like buying a Mona Lisa. You're paying top dollar, and at the end of the day, you're just getting something like this. Now, of course, there's still a lot of money being made by selling a broken system. So ready for some numbers? In 2024, the global market data revenue was over $30 billion. And this has grown tremendously. Split about 50-50 between data distributors and exchanges. As you'd expect, data distributors mostly make their revenue from selling data, so it's over 60%. It's been pretty consistent over time. Where we've seen a tremendous amount of growth is on the percentage of revenue from market data at exchanges. It's gone from about 15% to well over 30% today. Now let's think about that in terms of an asset class. 25 years ago, if you were to take market data as an asset class, well, you compare that to oil, Dow Jones, S&P 500, NASDAQ, and gold. It is by far the best performing asset class. Wild. The broken system has really been designed to benefit exchanges. They want the status quo. They want it to stay in place. Now, what if our hedge fund manager wanted to only have one source of data? Pith originates normalized data that's cross-asset, cross-geography. So remember this whole mess, this ball of spaghetti? We get rid of it. Replace it with Pith. Straight from the sources directly to Pith. Cross-asset. Well, thank you. Pith pays traders and exchanges to supply their proprietary data. Let me say that again. Pith pays traders and exchanges to supply their proprietary data. Market data revenues in 2024, which I already told you about, traders made exactly about $0. Exchanges made about 14.5, and data distributors made about 12.5. Here are the breakdowns of the Pith rewards from 2024. Traders made the bulk share of around $35 million in Pith rewards. Exchanges made about 15, and there's no need for data distributors. Pith is creating a singular source of truth for global market data by changing 3 fundamental things. Number 1, trust. It comes right from the source. You see the institution who's generating it, to the traders and the exchanges that have the data. You can trust that it's coming directly from there. It's disclosed. Number 2 is transparent. It actually happens on a blockchain. We're familiar with those things, right? You can see every single price and the components that make it up. Finally, it's direct. No hops, latency, or added middlemen. Number 2, the experience. You have a single integration for all the asset classes. It's real time. There's no delay. There's no added hop. And because of all this, it can be incredibly low cost. Availability, as I said, you've already got every asset class. It's available both on and off-chain, on-chain cryptographically signed secured, and 24/7. There's no middlemen, there's no aggregators, no one integration. While others are stitching the data together, we collect it from the source. Institutions, Pith, to you. That's it. Our vision is very simple. The price of everything, everywhere. And here's how far we've come. It's a $1 billion protocol, plus. 120 institutions are currently supplying their data. It supports over 1,300 price feeds. 550 applications have been built using this data across 100 different blockchains. We have partnered with the best. Firms like Revolut, systematic trading firms like Virtue and Jane Street, large crypto exchanges like Binance and Coinbase, and over 100 others. We have been leading the global crypto market in providing data for the last 4 years. But now we're going for a much bigger cake. We have over 1,300 symbols. Earlier this year, we added the S&P 500. It took us 2 weeks. Later on, we added the FTSE 100. It took us about a week. We're very proud of this number, and we're continuing to push it to grow, because where we're looking for is this. NASDAQ has got over 7,000 symbols today. But we're not stopping there. We're going to the 100 million global assets around the world. Price of everything, everywhere. Now, what if you had the price of everything? One integration, all of the markets, any application. Pith is becoming the electricity for the global financial market. By building global markets with data you can trust. We've built it. It works. The data is live. You're early. This is the beginning of a new data economy, and we're building it together. Thanks very much.
All right, all right, all right, all right. I love that electricity and market data. It feels so good. All right, well, we brought an unexpected guest to you today. We brought a member of the Illuminati, Baji Illuminati, who's the CEO of Centrifuge Systems. Baji became CEO of Centrifuge after coming to crypto 2.5 years ago. So she brings a ton of experience from startup world, from TradFi world, and she's coming here to talk a lot about RWAs and bringing RWAs to Solana. So please give a very, very warm welcome to our very own Illuminati member right here in the Solana ecosystem, Baji.
Thank you. I feel like I should just drop the mic and walk off stage now. Illuminati in the house. I don't typically lean as much into that as I am here, but thank you all for having me. Really honored to be here, and really excited to be joining the Solana ecosystem. So today I'm going to talk about real-world assets. We all have spent a lot of time talking about real-world assets. A lot has been announced today, a lot of really great projects on stage before me, so I won't spend too much time on the what. Ultimately, though, we're looking at it as not just a way to tokenize and bring these funds on chain, but a fundamental way to improve how you create, how you manage, and how you distribute assets on chain. we're creating a more efficient financial structure that can ultimately 10x financial services. Centrifuge was very early. We were founded in 2017, and we believed in this vision. So over the past many years, we've been focused on counting a number of firsts. The first stablecoin that was minted with a real-world asset, with MakerDAO. The first RWA lending market with Aave back in 2021. The first on-chain fund with Block Tower Credit. And over the years, we've created a sophistication and a legitimacy around the space that comes with token standards, comes with better legal frameworks, and comes with institutional trust and respect and readiness for the space. But that only got us so far. We've really hit a ceiling where going beyond the initial adoption of the products hasn't really been possible. So the tailwinds we faced primarily fell into what are the critical infrastructure pieces that are in place that we need? How do we create the right service providers? How do we create the interoperability providers, the oracles, the key pieces that can enable these RWAs to operate and work effectively on-chain? How do we find a supply and demand balance where a lot of the early assets that were tokenized that came on-chain, there were higher yields but higher duration, which doesn't really work in DeFi. Or there were instant redemption and lower duration but lower yields, which isn't really interested in DeFi either. And then finally, what happens after you tokenize these assets? So it's not just about tokenizing an asset and bringing it on chain, but how do you create utility and liquidity, and how do you actually make those useful and create a more novel process that isn't possible off chain? So we believe that now we're entering the era of DeFi and RWA 2.0. This time it's different. There's real demand side drivers. So a lot of the growth in RWAs recently has been correlated to the growth in stablecoins, where there's 250 billion in stablecoins, and a lot of those stablecoin providers, they don't want to manage a fund. They want to work with a tokenization platform to manage those reserve assets for them. There's 116 billion in DeFi protocols where there's potential and opportunity to bring those RWAs as collateral assets to also enable RWA yields on top of the additional utility. On the supply side, we're seeing incredible traction with folks like BlackRock entering the space and Larry Fone picking up the microphone talking about real-world assets. We're seeing Apollo and Janice Henderson and a lot of incredible asset managers who are really moving into tokenization and bringing their flagship products with them. On the regulatory side, we have tailwinds, we have innovation, we have progress that we're starting to see a lot of this clarity of what regulatory support we have for bringing this innovation back onshore. And then finally, as we start to think about DeFi utility, there's an opportunity to start to enable more creative structures on-chain where there can be more utility and liquidity for these assets. So that's what I'll spend a bit of time talking about right now. Typically, there's been two sides of the world. There's the permissionless side, which we all know and love from DeFi and crypto, and you can be anonymous and you can move quickly and it all happens in real time, and that's what our industry was built on. And then there's the permission side, and that's what's needed for these asset managers to get comfortable with tokenizing and distributing and interacting with the on-chain primitive. And often there's a conflict between them. They don't work together. So on the permissionless side, that's where we can act in real time, and that's when we can operate at the speed of crypto. On the permissioned side, you can tokenize your asset, you can have a great onboarding process, but then what? So what we're really excited to push forward as an industry and as Centrifuge is what we're calling permissioned light. So it's an in-between of these, where there is a freely transferable wrapper of these products where you're able to take RWAs and you're able to integrate them into DeFi. So you can create secondary markets and lending and use them as collateral assets, create instant redemption facilities, and bring RWA yields into the crypto environment to create a lot of great utility that we've been looking for and searching for the industry just generally. We believe that this is the perfect combination where you can have a regulated and compliant fund structure that these asset managers need, and a lot of the institutional investors we're seeing, they need as well. But then you can pair that with a freely transferable product that is broadly accessible across DeFi, where you can get all these really interesting lending markets and DeFi protocols involved. You can get retail access to these products, and you can have this perfect combination where you have the regulated structure that's required and you have the DeFi composability that's needed. Today, we're very excited to announce the launch of Centrifuge on Solana. We are bringing, woo, Solana! The Illuminati's on Solana. We're bringing our DRWA token. So this is our freely transferable security token, which enables incredible utility across the DeFi ecosystem. And we're excited that from day one, we're partnering with a lot of the key protocols that are driving the DeFi ecosystem on Solana. We're partnered with Radium for trading, Camino for borrow and lending, Lulo for saving products. We're powered by Wormhole, and we're working with Pith. So we're really focused on how do we integrate with all the key players who are driving the Solana ecosystem forward. And we're really excited to be part of this community now. So here we are. We are purpose building for Solana. We're really excited to be here, and we believe that it's not just about tokenizing assets. It's about creating an ecosystem around these assets for more institutional DeFi. Thank you.
Great job. All right. Amazing, amazing news from Baji. I am thrilled about this next chat. One, because it's from two of the most impressive people, both in the crypto ecosystem and the entire financial ecosystem, Lily Liu and David Rudder from R3. But two, they're some of the most interesting, fun people to talk to. When you talk about .fun, you can have just Lily.fun and David.fun coming and talking to you. But they're going to have a really important set of conversations about the future of R3 and the Solana ecosystem. And I think what's going to be really excellent about this chat is just, I think, some breaking news and a really good way to set the vision of what the future of the financial ecosystem looks like and how it's happening on Solana. So if you have one chat that you hang out for this afternoon, I highly recommend this be it. So everyone, please give a huge round of applause for the executive director of the Solana Foundation, Lily Liu, and the founder and CEO of R3, David Rudder. Please give it up.
Thank you.
All right. All right. What's up, David?
Hello, Lily.
So we put out some news this morning.
Yes.
And so I know we've both been in this industry for, gosh, a decade now, if not longer. Something like that.
Yeah, the only difference is I was in another industry for 3 decades before that.
I remember in the early days, there was a lot of discussion, private blockchain, public blockchain. They've been seen as being at odds with one another for many years.
Yes.
And today we're bringing that together. So I've been super excited about it. And so I'm curious, as we've been through this together for the last number of months, why now? Why bring this convergence of public and private together now?
That's a good question. Before I say anything, I just want to tell you the energy in this place has been amazing. So it's great to be part of the Solana family. I'm really excited to be here. But the question is, why now? And in business, that's one of the toughest questions to answer. You can get a lot of things right, but if you get your timing wrong, you can be dead in the water. But to me, this was a pretty easy decision. We've been at this for 10 years. We stayed on the private permission side. We chose to work with the biggest banks, the biggest FMIs, the biggest exchanges in the world, who have been in business for decades. And their technology has been developed over that period of time. And it works really well for an analog world and for their marketplace. So for some time now, we've been able to see the future, but there's been a lot of headwinds. And for example, the DeFi space needed to grow up a little bit, and certainly Solana has proven that it has all the basics we need with the throughput and finality, with the scale. So that's really exciting. And then on the other side, TradFi folks like myself were very skeptical about this DeFi world for a long time. But there's no doubt there's, millions of people, you talk about network all the time, who are looking for access to financial markets and products that we have in large quantities on R3. And then importantly, the regulatory winds have changed. Banks have to be cautious. They have to make sure they stay clear of any regulatory concerns. And there was a real unevenness globally. Most importantly, the US had one of the more conservative regimes. And even if you did business in Singapore and you're a big bank there, you had to pay attention to what was going on in the US. So the changes here in the last 6 months have made it clear that now is the time to bring all of our real world assets and our huge customers like SDX and the HSBC, HQLAX, and these other folks that have Euroclear that have built on our platform, and expose them to the wonderful world of DeFi and public chain.
And so in the past, people have talked about DeFi and TradFi. I think there's a quote at some point, DeFi is never going to be becoming a TradFi. And so how do you see that now going forward, now that we're starting to bring these closer together?
Yeah, I mean, I said that because I've been around for a long time and I've seen new technologies introduced, and it doesn't really make sense to go backwards. I watched a number of your panels today with Christine Moy and others talking about the direction of travel. So the direction of travel is certainly tokenization. No one's going to argue about that. But once you tokenize assets, you really want to make them freely available. So we have challenges like AML and KYC, but we're addressing those. And I feel really confident about the direction of travel. But to think that the DeFi folks wake up in the morning, or folks on public chain, and think, hey, how can I get on that TradFi infrastructure with markets that close at 5 on a Friday and open on Monday? How can I get really some of that slow, expensive money to send over to Singapore and hope it gets there in 3 days? That's not the direction of travel. We all know which way we're going here.
And so let's talk a little bit about how we're actually going to be architecting that and making that real. So R3, Corda, original private blockchain implementation. So how are we actually going to be bringing that together, right? So we've got a lot of questions. Does that mean everyone's going to have to move off of Corda? What are the options for existing clients?
So first off, we look at this partnership with Solana as much broader than bringing Corda and our 25 plus live networks onto your chain. Because, we believe we will be offering, or we know we'll be offering enterprise support for direct Solana deployment as well. We care deeply about our customers, and everything we do is in consultation with them. When we decided to go down this path over a year ago, we looked at almost all available layer 1s, layer 2s. We considered what would work for our customers, what would give them the greatest opportunity, and we consulted with them about this. So our Chief Technology Officer, Richard, has worked closely with your crowd, led by John, and he's writing a great blog. I recommend everyone read it. But we've come up with a way to take all of our 25 plus disparate networks that use a Corda notary and to natively implement that notary and the consensus mechanism onto Solana. So for our customers, if they choose privacy for all of their transactions or part of their transactions, they can still use the privacy features, the workflow and data flow features that are within Corda, and get all the advantages of the Solana ecosystem. And over time, as they build more comfort with the public markets, they'll make more product available. And then for all of our new customers, it depends on what they're trying to solve and whether it's appropriate to build directly onto Solana or on Solana through our product Corda. So we'll see.
Awesome. And so as you've been speaking with folks in the TradFi world, some customers, prospective customers, folks coming from that end of the spectrum, what is the reaction to R3 and Solana starting to work together?
Well, it's been unanimous excitement. One of the most frustrating things I've had to deal with over the last 5 or 6 years was there's tremendous excitement about Corda. We're very early to implement in production. The entire Italian banking system runs on Corda, for example. We have the only digital exchange, SDX, truly digital exchange that issues digital securities, tokenized bonds. And they are very excited about reaching out to the public markets. I don't think he would mind saying, I had a discussion with the World Bank, the folks that are responsible for issuing digital securities, and they're really keen to be able to issue into the public space because they have a lot of purpose-backed bonds. So if you feel strongly about a green project or one of their other initiatives, it gives you a chance to buy their securities in small amounts, with a vote of confidence, and it makes these otherwise institutional-grade products available to millions of people. So right now, what you hold in your wallet is still fairly limited, and I know separately from us, you're looking at tokenized equities and a lot of other very exciting things. The future is going to be, I'm going to control my digital assets on my wallet, and that's going to contain everything from my housing title, driver's license, my tokenized bonds and gold, which we have 5 tokenized gold platforms already built on Corda and R3, and we're excited to bring them into the Solana ecosystem.
And so what are the things that you think the public chain community still has to innovate on, do better, get right, to appeal more to institutions? I think we've come a long way, but typically there's kind of been the institutional TradFi part of the industry, and then there's the moniker of the DeFi degens, and they kind of look at each other across the way, and there isn't a lot of kind of collaboration or a lot of mutual understanding. And I think I hear a lot of the times, well, public chains lacking privacy, lacking security, lacking all sorts of things, not institutionally ready, right? How much more do you think we actually have to do to really start to bridge the gap and just make it a continuous spectrum?
Yeah, well, first off, I'm interested in your perspective on this too, because one of the reasons we're sitting here is not just the way the technology solution works for our customers and all the momentum you have, but you and your team are very aware of how TradFi works. So I made this comment earlier. When you're not constrained by history and the regulatory swim lanes that we have to stick in, you can do some really creative things. So when I look at what's been going on in the DeFi space with AI agents, things like perpetual futures that are very straightforward, that have developed, with some of the derivative products and staking and all, it's really exciting. I'm an ex-derivatives guy. A lot of this stuff applies to TradFi. But that's kind of like step 2. Step 1 is we need real-time, 24/7 money. We need to be able to move collateral around the globe instantly. And yes, we have some applications that are in production that can do that now, like HQLAX, but they can only swap collateral for collateral because they don't have the cash on. So step 1, let's deal with real pain points in TradFi. Step 2, open up TradFi's imagination to some of the really amazing stuff that the DeFi folks have built, and really start thinking about how that can move us forward. Now, as far as the DeFi guys, listen, TradFi moves slowly for a few reasons. The pace is going to change, but realize certain things like AML, KYC, and other regulatory limitations are unbendable. So don't fight them. Let's just come up with things like attested wallets and other things we can do. Thank you. Other things we can do to make those products available.
Love to hear it. Love to hear it. My perspective has always been that the most powerful thing in financial markets is liquidity. Liquidity is king, and that is the one thing that a public chain that is accessible to all assets is kind of just a starting point, not the ending point. That is the most powerful thing that we can bring to global financial markets. And that's kind of been my thesis from the beginning, and I think that is starting to, what we want Solana to be is to be that global financial infrastructure. And the permissioning should take place preferentially at the asset level and at the application level, and so you can still have unified liquidity, and then the permissioning, segregation, the filtering, the choices occur at the application and the token level, like we use the internet today. Most of the apps we use are heavily permissioned, and that still allows for the core infrastructure to be content neutral, and that's what we'd like Solana to be asset neutral at the base layer, and for all the things to be built on top of that in ways that are appropriate for the user base.
Yeah, I want to make another point, though. I've heard you talk a lot, and you talk about the network. And you can give me the number because I don't know all the folks that are in the Solana network and part of the ecosystem here. And in TradFi, we have a tendency to look at the total market value, like 3.4 trillion, kind of fine, a little bit interesting. It's not a big number. But there's hundreds of thousands of active, young, creative, energetic people that want to have a variety of assets available to them. And that is what gets our TradFi guys interested. If you're running a big bank and you don't build a product that's going to appeal to the next generation, you're going to be left in the dust.
Yeah. We also talk a lot about how crypto can add value to existing assets. So a classic example is most of us in this room can go buy $10,000 of Apple stock if we want to. But what none of us can do is go collateralize that Apple stock instantly and be able to borrow $2,000 against it, right? It's impossible. There's no market for that. There's no service provider for that. There's no button you can click where you can instantly borrow against pretty high quality collateral. And so to me, the story about tokenization has been about broadening distribution and broadening the utility of assets in ways that are 24/7, 365 available. So yeah, and range of new assets. Yeah.
One final thought. I mean, we've gone over, but I know you're the big boss, so we're probably okay. But one final thought and one final pledge to this Solana community. R3 is going to make it easy for our TradFi folks to bring you guys investable products with yield, with diversity in the asset classes that are available to all of you. I promise that. A lot more to come. Thank you for having me. This is super cool. Let's go. Let's go. Thank you, Lily.
Awesome. Thanks, David.
Cheers.
That was great. Let's go is right. That was awesome. I'm fired up. At the Solana Foundation, we have this idea called the thesis for boring. And what's kind of crazy is that thesis for boring is actually some of the most exciting stuff out there, because you see someone who's worked in years in traditional finance and is excited about bringing this all on chain and really blowing open the potential for the financial markets. And this next talk is about the DeFi end of that spectrum, the people who are degens and DeFi native coming on and telling us what it looks like to build out trillion-dollar asset classes on chain. So up next, we have Ramsey, one of my colleagues at the Solana Foundation, who leads all things DeFi, and some colleagues from across the spectrum, from Ellipses, from Galaxy, from Orca, and from MarginFi and Temporal. So they're going to talk about what they're seeing in DeFi, all the amazing things that they built, from a sandwich-resistant AMM to an IPO, a listing on the public markets that just happened last week, and how these companies and these markets are just blowing through the roof. So please give a very, very warm welcome to this amazing panel I have behind me, and welcome them to talk about the future of DeFi.
So nice, so nice. GM, good to see you all. Amazing. Hope you're all having a great first day to Ship or Die. I know I am. And I want to personally thank you all for sticking around for this panel. I can see some of you itching to get over the happy hours. Don't worry. We'll make this one short and sweet. I'm joined today by 4 incredible leaders in the space. They're truly redefining Solana DeFi in real time. I want to give them a second just to introduce themselves. Eugene, you want to kick us off?
Yeah, I'm Eugene. I'm a co-founder at Ellipsis Labs. We do a bunch of different things in Solana DeFi, ranging from asset origination and liquidity bootstrapping to providing liquidity on some of the most competitive pairs on chain today.
Hey guys, I'm Eduardo. I work at Galaxy Digital, and I manage the DeFi trading side of things, partnering with different protocols, including some of the people here, and different businesses across the space.
I'm Nathan. I'm from Orca. We're one of the leading decentralized exchanges on Solana, concentrated liquidity AMM, really focused on RWAs and expanding traditional assets and bringing them on chain.
Hey, I'm Mac Brennan Pete. I'm a co-founder at Margin, which builds generalized credit infrastructure, and also a co-founder at Temporal, which is a research and development firm native to Solana. Yeah.
Awesome. Yeah, as you guys can tell, an incredible host of people here. I want to kick things off by just, addressing the elephant in the room. We talked a lot about RWAs today, the X stocks announcement, ACRED on pretty much every platform. But I think we're still seeing some protocols struggle with market size and depth. So I'd love to get your thoughts on what we need to do to get Solana DeFi ready for institutional-sized markets, and where we can improve, where some of your projects can improve in doing that, and to achieve kind of $1 trillion market size. Do you want to start with Eugene? You want to kick things off?
Yeah, I think there's a lot of barriers today. I mean, the fact of the matter is it's more difficult to build in DeFi than it is to build in TradFi. You're building in a much more adverse environment, and so you need to build mechanisms that can work permissionlessly and still deliver efficient outcomes to the users. And so when we're talking about the asset sizes and requirement for liquidity, the efficiency of the protocols is going to matter a lot more. So this is something we focus on a lot at Ellipsis Labs. How do we have really deep liquidity on chain without needing to incentivize it or incentivize it too much? So that was the genesis of our order book, our on-chain order book called Phoenix. And today we're one of the largest liquidity providers on Sol USDC through SolFi. And then when you bring it all the way to the other side of the least mature assets that are maybe just getting their starts on chain, and how do we do liquidity bootstrapping and asset origination? I think that's like it's a totally different problem. And we're starting to work on that piece as well with our Gavel product, which just launched this week.
Yeah, congrats on the launch, by the way. It's pretty awesome to see kind of a large team like yourself try and tackle sandwich resistance. Eduardo, I'd love to get your thoughts, as kind of the representative of the institutions in the room. Where do you see the opportunities right now for Solana DeFi to grow? And kind of how do you compare us to the other ecosystems? What do we do better? What's been sort of your experience trading in both camps? Because I know you guys run strategies kind of across chain. Yeah.
Yeah, I mean, I think in terms of depth, Solana is probably number 2, right behind Ethereum, right? I think that some of the ways that Solana can improve is take advantage of its speed and its architecture to be able to pull in large players. I think on the compliance front, sometimes it can be easier on Ethereum to track wallets. And so I think it's just a matter of time before compliance service providers are able to give you even more deep analytics that rival those of EVM environments. I think building new primitives is going to help significantly. Termed out loans, as an example, leveraging the existing liquidity from protocols like Camino. But yeah, I think that Solana does have the keys to access institutional funds, and it's right there, right? I think that it's just going to be a matter of time, but all the pieces are there. So I'm not very concerned about the ability of Solana to really attract institutional players, outside of the fact that compliance may be a bit tougher to track, and there should be potentially built out some protocols that cater more to institutional players.
Yeah, I'd love to dig in there for a bit. You spoke a little bit about compliance. I think that a lot of DeFi is built from the ground up maybe not taking that into account. So I'd love to understand, maybe from the rest of the panel as well, what are your thoughts on sort of risk management, how institutions view risk versus how DeFi natives do? These are clearly two very different use cases and users. And so I'd love to get your thoughts on kind of how do we, as an ecosystem, grow to tailor our products to both camps, right? You don't want to necessarily forget the DeFi natives, but building products that institutions can underwrite and can use.
Yeah. So on the protocol side, counterparty credit risk is not really that big of an issue just because of the over-collateralizations and the liquidation mechanisms that are available in place, especially with deep liquidity in pools like Orca's. When you look at compliance, it's mostly about who you're trading against, right? And currently what we have set up is we evaluate on a pool-by-pool basis. We look at historical trading volumes on every single pool that we're going to touch, and we have thresholds on percentage of activity coming from bad actors, and that can be OFAC sanctioned, that can be hack-related funds, that can be what have you, right? And so I think to an extent that is useful. I think going forward, having something where those transactions actually get prevented at the protocol level could be something that is going to be beneficial, and not only at the front end side of things, but at the core protocol building side of things would be something that would definitely give me a bit more ease of mind. Regardless, there could be ways, for example, that services can be offered where whenever a bad transaction is coming in, you can sandwich it with removal of liquidity, deposit liquidity, things like that are extremely tough to build, but that would definitely bring a bit more ease of mind to the system.
I think today the biggest difference between DeFi and TradFi is DeFi is by default permissionless, so assets can flow unless they are blocked. And in TradFi, it's closer to the opposite, where you need to be whitelisted before you can participate. And to be compliant, I think DeFi is going to have to have some options that cater more to that crowd. I think Solana's been pretty good at anticipating this. The core Solana folks have been working on token extensions for a couple of years now, and the most basic feature there is you can enable a whitelisted set of addresses, which could be addresses that have passed some KYC AML check. Protocols, of course, could define it however they would like. But I think some of the the DeFi purists those types of ideals are going to end up clashing with mainstream institutional adoption.
Yeah, I think that's a great point about token extensions and how they've kind of really been thoughtfully, from the beginning, designed to kind of enable institutions to move and actually integrate with permissionless protocols on-chain and really enable permissions to be set at the token level and maintain whitelists, like Eugene said, that kind of give you confidence as to who your counterparties are and maintain compliance with all of the KYC, AML, other things as well. So I think that's something that was very thoughtful, very forward-looking from Solana to build that into to the core protocol. I think there's still some work there to be done to kind of arrive at more settled standards as to how different issuers actually implement token extensions and do it in a way that makes it easy for protocols like ours and MarginFi, Ellipsis, everywhere else to do it in a way that's more scalable and not have to do custom implementations for each issuer or for each transfer agent or whoever it may be. I think actually a little bit later, Taylor from Exotech is going to talk about this some in a talk following this. But I think that's a great thing that Solana's built in to the network is with the token extensions to really facilitate compliance for institutions.
Yeah, Mac, I know we spoke backstage about you looking at MarginFi and kind of the products that can be built on top of it. And I think the nature of token extensions, right, is to enable more composability for these institutional assets. I'd love to get your thoughts on kind of what products you envision being built on top of MarginFi, which ones will be tailored to some of this institutional flow that we anticipate coming in.
And then maybe tying that into like everything we talked about. So like from a risk perspective, a lot of risk modeling is done with like historical data, and we just like in Solana DeFi we haven't had a lot of it. Like in traditional markets, historical data like goes many years to sort of like define an asset. New assets pop up every day, every second on Solana. We're actually at the point now where a lot of protocols on Solana that are issuing credit, like MarginFi, like Camino, like Drift, have really solidified themselves in terms of their own risk management, really public parameters, like being able to, and from like a traditional markets POV, being able to audit and see for yourself solvency. And so at this point, I think we're at a point where we could enable like better composability across these venues. And so one of the things we're really focused on at Margin now is unifying someone's like entire DeFi portfolio, especially on the credit side, where people are using different venues for different reasons, and they're getting different benefits out of that. And they can borrow against their whole portfolio from like a single place instead of like fragments of it from one venue to the next. And so this is like, sort of like a evolutionary step on DeFi that I think we can take now that a lot of the structures have solidified, and like from a point of like risk management, like MarginFi has handled hundreds of millions of dollars of like withdrawals and deposits in like a single day. And so like we can rely on these systems now and sort of build like more complex products on top of it.
Yeah. That's awesome. Very cool. Eugene, I'd love to get your thoughts on market structure. I know we've spoken about this at length in the past, and I think as we're anticipating more institutional adoption, markets are going to have to adapt to the size that entails, right? So I'd love to understand, like, where do you see Solana's gaps in terms of addressing those market demands, and what do we need to do from both an infrastructural perspective as well as kind of market design, perhaps even from a policy perspective, to enable some of this more institutionally sized flow.
Yeah, first of all, I think it's really interesting and really great for Solana that some more assets with a non-zero terminal value are showing up to the chain. I think that's been a big problem for blockchains for quite some time, and probably the easiest way to do it is to bring, as we say in crypto, real-world assets onto the blockchain. There still needs to be a compelling product offering on the chain itself. So today, I think if we brought Apple equity onto the blockchain, there wouldn't be really a reason for any of us on stage here to trade it on Solana versus trading it from our brokerage accounts, because the liquidity is going to be worse. The margining maybe would be a little bit better, but you're going to get worse prices when you're trading. And again, some of that comes down to some fundamental limitations of the blockchain, and how expensive compute is. But there are some efforts on the infra side that the Ansa team is working on. I think probably the biggest one that is going to unlock some more mature market structure on Solana is called MCP, multiple concurrent proposers. And one way to think about the chain today is every 1.6 seconds, someone randomly selected around the world gets to run the matching engine. And it turns out it's a pretty difficult environment to build an exchange in. So I'm really looking forward to seeing that change land, and then the new market designs that people are going to build on top of Solana.
Yeah, it's incredibly exciting that we're constantly upgrading, we're addressing these concerns. I think it definitely sets us apart from the rest of the ecosystem. Nathan, I know you guys have been really focused on the RWA space as of late, with USDG markets specifically, and some of these other RWAs. I'd love to get your thoughts on that strategy, and where do you see kind of Orca fitting into this broader RWA ecosystem as we bring on both private credit, tokenized equities, some of these other assets.
Sure, yeah. So RWAs have definitely been a big part of our focus. I think we recently joined Project Open in conjunction with Superstate and the Solana Policy Institute to really engage with the SEC and develop together a framework to have a pilot program for trading equities on chain in a compliant way, and kind of build out an example of that that can be then expanded larger in the future. I think in terms of market structure, I think there's a lot of different trading primitives. And I think for us, something that's very interesting is kind of the long-tail asset market within RWAs. I think within crypto, when people hear long-tail asset, you usually think of like meme coins. But in TradFi, there's really a lot of long-tail assets that trade very liquidly or hardly at all, often at much higher spreads than a meme coin would. I think there's a lot that can be done with the concentrated liquidity model to really enhance liquidity in a bunch of these assets. I mean, things like private credit, mineral rights, emerging market debt. There's like a number of these that are individually all multi-trillion-dollar asset classes that really are highly liquid now that probably could benefit a lot from both tokenization as well as a kind of an alternative market structure.
Great. Eduardo, I'd love to get your thoughts on sort of how Galaxy is approaching DeFi right now. What venues are you guys excited about? What projects are you looking to integrate with? I guess time for you to show some of your excitement here. But yeah, would love to understand your thoughts on the landscape more broadly.
Yeah, for sure. I mean, I'm very excited about the way that crypto is going. I think that you're seeing some new, more mature designs around protocols with stuff like termed out loans. There's still a little bit of things that need to be figured out. But there's certainly like exciting ideas that are being put out there. You have like term structure, term finance. Both of them, I think, could have compelling products in the future. We'll see how they adapt to the market. I think Hyperliquid is extremely exciting as well. On Solana, I love the existing protocols there, right? Margify, Camino, Orca, all of them have excellent products, and they just keep shipping. So it's certainly exciting. I think on the stablecoin side of things and the tokenization side of things, protocols like USDG, M0, PayPal getting integrated into the blockchain, I think that is a fantastic news for the rest of the space and for the adoption of institutions into the space, right? More so for payments. And on the PayFi side of things, like protocols like Huma that process billions of dollars in transactions, it's honestly fascinating.
Yeah, no, I agree. Awesome. Well, I guess that's our time, guys. But I want to thank you all for joining me here today. And yeah, let's get you guys to the happy hours. Awesome. Thank you.
That was great. Great, yeah. All right, what a star-studded panel. I feel like I learned a lot about the future of DeFi right there, so appreciate you guys joining for that. I was having a blast talking to our next lightning speaker backstage. Taylor Johnson has been building on Solana for 5 years. He's been in blockchain for 9 years, and he has done it all. He has built for some of the biggest institutions in the world, and then built for scrappy startups, deepen projects, the rest of it. And so he's incredibly knowledgeable about developing in the space and developing on Solana. And what he's going to talk to us about today is building compliant on Solana. So as we think about the scaling of all these institutional assets, figuring out how to do it in a way that takes care of issues such as KYC and other huge compliance questions, but doing that all in a crypto-native way. So please give a very, very warm welcome to Taylor Johnson from EXO.
Thank you, Mara. All right, hey everyone, I'm Taylor Johnson, founding partner of EXO Tech, and today I'm going to give you a bit of a primer on building compliant on-chain products. But quick background on myself, I've built some fraud and compliance infrastructure for centralized exchanges. I've been building financial applications on Solana since 2020, and through my, some of the programs I've built, my team have secured hundreds of millions of dollars on-chain. So today we're going to talk about tokenization on Solana. Forgive me, I'm an engineer, so I've been promised I'm not going to try to be too technical, but before we talk about how to build on-chain compliance, we need to understand how tokenization works on Solana. On Solana, there are two existing token programs, the original token program and token 2022. What does this mean? It means that no contract deployment is necessary to actually launch your token.
You simply have to call an instruction to create your token, and that's it. But because there are two programs, you need to understand the difference between the two so you can choose which one you want to use. The original token program has full ecosystem support. This means that all DeFi protocols, Orca, Camino, MarginFi, etc., can support it. However, there is no flexibility. You cannot customize your transfer transaction. You cannot customize metadata on the token. There's no flexibility, and that's because the program is also mutable. So there is no upgradability for this program in the future. To address some of these issues, the Token 2022 program was created, which has growing support, but not full ecosystem support. But it has extensible token logic, which means you actually can add custom logic to your transfer instructions. And it is mutable and upgradable, and so new extensions are getting added. I think there's about a dozen or so. But so what are these token extensions? These are composable building blocks that allow you to use pre-existing logic that you don't have to build yourself to build whatever types of products that you want onto Solana. And then this is done in a safe manner because no transfer can actually change the amount that is being sent or who it's being sent to. There's one extension, the transfer fee, that can do this, but it's completely locked down and you cannot actually change the logic yourself. So you know that by using Token 2022, any RWA that is integrating this is going to be done in a safe way. And then you also get to be done, you get to build in a quicker way without having to rewrite all of the logic yourself. If you're coming over from another ecosystem, as you know, you have to rewrite all of your logic for the contract and deploy the contract yourself. In Solana, we're simply taking composable building blocks and just basically selecting what we want to use in our tokenization strategy. So what does on-chain compliance look like in practice? The first thing that we do when we're working with these RWA teams is that we talk about robust access control. We need to make sure that only the folks that can interact with the update KYC information are updating it. Only fund managers can move liquidity around, et cetera. And so there are ways to build very granular and flexible, robust access control into your program. And why is this important? It reduces risk. You want to make sure that there is isolated and limited exposure to all of your critical infrastructure. Now, KYC is very important when it comes to on-chain compliance. There are basically two ways to do this right now. One is through transfer hooks. The big benefit of using transfer hooks is that all of your data is on-chain. You can specify whether you want to have the user's jurisdiction on-chain, if you just want to have their KYC level on-chain, whatever information you want, it can be there. And what happens is when the transfer is created, both parties might be checked to make sure that they're KYC'd, and if they're not, the transfer will fail. So this is enforced on every single transfer. One downside with this is that it limits protocol integrations. Not every single protocol supports transfer hook functionality. So another way to do KYC is using this unfreeze freeze action, which uses a freeze authority. One downside of this is that there's no actual on-chain data. So this is kind of a decision that you need to make with your compliance team, whether that's important or not. However, it has support across the ecosystem. So what this means is that you have this off-chain process that determines which accounts have been KYC'd, and if they've been KYC'd, they're unfrozen. If they're not KYC'd, they stay frozen. Another downside with this is that you actually have to track the transfers and make sure that you're keeping track of which accounts should be frozen or unfrozen, and this is all done off-chain. Now, another important compliance is asset seizure. If you have some wallet that is now determined it is in a sanctioned country or something like that, you need to make sure that you can claw back the assets. This is done with another token extension called the permanent delegate extension. This allows an admin to control user-owned accounts. You may transfer the tokens at will. You may burn them at will. However, one downside is that this also does limit protocol integration. So this is a big consideration to make when you're deciding how are you going to build your on-chain compliant products. One quick note on something that we've worked on at Exotech is composable compliance through using the Solana attestation service. This is a generalized attestation service that could be used for multiple things. But here we show an example of KYC where you can set up custom schemas to decide what information you want to attest to. And so that way the institution, say it's a centralized exchange, could select different wallets and set their KYC data such that other DeFi protocols could use it, leaving a transparent record trail of what wallets are KYC'd and which can interact with these compliant products. So I want to highlight a couple other teams that have built compliant products on chain, Securitize being one of them. They have a very robust access control to meet their strict compliance standards. They also use a flexible token policy engine to enforce certain transfer restrictions, built to support many real-world assets and multi-levels of KYC. And they are a US-registered securities tokenization platform. Now, another one is a Singaporean-registered tokenization platform that's slightly different, that uses approvals for deposit and redemption, allowing fund managers to decide what wallets actually enter their, can redeem their RWAs and whatnot. So this is a manager-configured NAV. They support token clawbacks with permanent delegate extensions, and then use the transfer hooks for KYC validation across every transfer. I know that's fast. Thank you so much. I'm Taylor Johnson.
All right, Taylor, that was great. Love hearing about on-chain compliance, and here we're going to get even more into it. You might know that tomorrow we actually have Policy Day here. We're going to have a slew of incredible people from the policy spectrum, including folks from the new Solana Policy Institute, senators, members of Congress. It's going to be an incredibly exciting lineup, and so we're sort of teeing that up by talking about the technical side of it. So up next, I have my next speaker, Kan. Kan-san is here from Tokyo and Backpack, and he's going to be talking about how they're thinking about evolving crypto regulations and building for that spectrum. So please give a very, very warm welcome to Kan-san from Backpack.
Thank you. Thanks very much. Thank you. Hey, guys. All right. Hey, everyone. Welcome, and it was the last off of the day, so thank you guys for staying around. My name is Ken, one of the co-founders at Backpack Exchange. I'm here to talk about my favorite topic, which is crypto regulations. The question is basically, how do we regulate crypto, right? It's been 16 years since crypto came out. Regulators around the world have taken all kinds of different approaches to regulating crypto. Some are more principles-based, some are more rule-based, some are more disclosure-based, some are more merits-based. Some have tried to come up with brand new laws targeting crypto, and some have tried to just retrofit existing laws back onto crypto. In the past 2 years, I think there's been a lot of regulatory momentum internationally. So most recently, MiCA came out in Europe. Japan came out with new stablecoin legislation. Korea, Hong Kong all came up with new vast regulations. Dubai is trying to be really building itself into a crypto hub. And our own regulators here in the US, SEC, CFTC, FinCEN, et cetera, have been moving past a phase in the past few years where there's been heavily anti-crypto regulation by enforcement and really start to write real crypto laws and regulations. So the question is, I guess, how do we think about all these different laws that's coming out? If you're a founder building a new crypto startup, how do you think about all these different laws that are out there? For me, it comes down to first principles, right? And there's not a lot of them. If you look at financial regulatory laws and regulations around the world, it really sort of boils down to a small handful of these principles. Things like preventing financial crimes. Most of us here probably have set up an account on some exchange somewhere. You've had to submit your passport, your ID, and you've had to submit a selfie. That's all to prevent the use of financial institutions for money laundering and terrorist financing, stuff like that. But this is one of multiple principles. Things like investor protection, making sure that investor assets are protected. Market integrity, making sure that markets are fair, safe, reasonable, transparent. There's no pump and dump schemes. There's no insider trading. And then making sure that a fallout in one part of the system doesn't actually cause contagion more broadly in the ecosystem. So one rule that a lot of regulators sort of use when they think about applying laws or coming up with new laws for crypto is same risk, same regulations. If it walks like a duck and it quacks like a duck, it's probably a duck and you should treat it like a duck. There's fraud, scams, market manipulation. There's nothing that just because it's on a blockchain doesn't mean that it should be free from regulations. And a lot of regulators saw this firsthand with some of the events that we've seen in industry for the past few years, events like FTX, where I used to work, Luna, a bunch of other places, and it brought to the fore, for a lot of regulators that a lot of financial principles also applies to crypto. If you have fraud, embezzlement, misappropriation, all of those things, they're in traditional finance, they're also in crypto, and we should use the same laws and regulations to apply to those. But crypto is also different. I think that's why a lot of us are here today, right? We love crypto because it's new, it's different, it's got a lot of innovative principles. And so for me, the most exciting thing about crypto is it uses technological innovation to actually change some of the fundamental principles of how we think about financial regulations. Things like decentralization. Before crypto came about, there's a few exceptions, but for the most part, things like control was a binary term. You either control something or you don't. The fundamental sort of theory of legal philosophy is if you control something, you have liability for it. If you don't control it, then you can't be held liable for it. And so it was more of a binary thing. You either control something or you don't. But crypto came along and created this new dimension of control where it's now along a spectrum. If you look at all of the different governance proposals, governance infrastructures, multi-sigs have come out, it's really put control and decentralization along a spectrum. And so the question is, and what regulators have really been sort of getting more and more attuned to is that crypto is not just a label. Just because you call yourself crypto or you're decentralized or a DeFi doesn't mean that there's no control. Regulators are also digging into the details of asking very fundamental questions, looking under the hood to see if you have open source, are you custodial, are you autonomous, are you dependent on a group of third parties, are you censorship resistant, and does one or small group of people have control over what you're doing? And these are really important questions in my view. We have to look under the hood, not just call ourselves decentralized or DeFi. You really sort of have to look at the technical implementations of how our projects actually work, what we're actually deploying on the blockchain, and not just for complying with laws and regulations, but fundamentally because it's a better way of doing things. So just to give you a couple of examples, from my conversations with regulators, take a DeFi smart contract. Does a smart contract, is it immutable on the blockchain? If it's not immutable, does anyone have the upgradability keys? Is it tied to a multi-sig? And if so, who has the multi-sig keys and signatures? All of those questions are coming up by regulators. They're trying to figure out, looking at every project in and of itself to see who controls it. Liquidators, if traded on DeFi DEXs, right? A liquidator has to be able to take away your assets to liquidate your collateral, when you're underwater. So does the liquidator actually own your assets? Does it control your assets? Is there custody risks? Sequencers, if you have a layer 2 protocol, is there a centralized sequencer that's running everything? If there is a centralized sequencer, is it this only entity that's actually doing the ordering, access and execution of your orders, and does that create any market risks? I would say that for all of these scenarios, doing it with the new technologies that we have with cryptography, with crypto, is a better way of doing things. Again, not for compliance only, but because it's literally better. If you have a decentralized protocol, an immutable smart contract, it gives users the confidence that you will not be robbed. It gives them the confidence, the long-term belief that they can use your product, they can put their money into the product, and they won't be front-run, they won't be robbed. And so, in my view, decentralization done right actually strengthens regulatory principles. Let's talk about a few of these principles that we applied when we were building Backpack. So when we started building Backpack, obviously we had a product roadmap. We wanted to build a really good consumer app. But in addition to the product roadmap, we also had a compliance and regulatory roadmap where we looked at how do we actually combine the best of innovation and compliance to build something that's both good and easy to use, but also compliant. I'll give 2 quick examples. If you've used Backpack, we launched our perps trading system a few months ago. one of the things that we wanted to do when we were building our perp system is we wanted it to have seamless cross-chain capabilities, being able to work across multiple blockchains, multiple assets. We wanted it to have real-time P&L settlements. And if you haven't built an exchange, you might not appreciate this, but real-time P&L settlements is actually really important for perp systems, because if you don't actually keep track of those unsettled, unrealized P&L, you could actually have issues reconciling your customer assets and your reserves. And so we made a decision when we were designing our liquidation system that we were going to focus on the custody risks. We were going to design our system in a way it requires a ton of throughput. We're going to do it in a much more centralized manner, allowing us to do real-time P&L settlements, but at the same time that leaves a lot of other questions like market risks open that we had to solve using other ways. Another example, just our trading engine in general, when we started off building this trading system, we wanted a system that had no single point of failure, that was verifiable, that was not dependent on any single operator, that was replayable, accountable, verifiable. And if that sounds familiar, that's exactly how we've built it. We've built our trading system like a layer 2 blockchain. There's 3 independent nodes, each running in a separate instance of the exchange. And for any transaction to happen on Backpack Exchange, every deposit, withdrawal, buy, sell, trade, all 3 nodes has to agree. And this allows us to inherit a lot of the properties of a blockchain, things like verifiability. We could replay the entire history of Backpack Exchange from November 2023 when we started every single transaction and get to today. It reduces a ton of risks on investor protection, market integrity, but again, it's a centralized sequencer, and so we had to think about what other risks that generates and creates that we had to solve using other means. So for me, I think a first principles approach is about it's not about choosing between compliance and innovation. It's really about recognizing what are the risks that you are building, what are the risks that you are retaining, and coming up with ways to balance the best of both worlds. Where regulations can help mitigate the risk, and where technology innovation using cryptography can actually mitigate the risk, and then sometimes even strengthen regulatory principles. We don't have the answers, but it's something that we deal with every day, and it's super exciting. One thing that I want to just really double click on is compliance is not the be all and not all. Just by following everything you have in a book doesn't mean that you're 100% compliant. In particular, I think what's super interesting maybe for this audience is that, to me, cryptography and Web3 technologies allows us to use new innovative technologies to actually mitigate a lot of the risks that traditional financial institutions suffer from. So things like, we can use cryptography to do much better proof of reserves, integrity checks, market surveillance, audits, and transparency. We should be able to do all of these much better than traditional financial institutions, because we can use cryptography and Web3 technology to bolster these systems. And so where we ultimately want to get to is, imagine a risk system where every single parameter, every single transaction, everything that people are doing in the ecosystem is fully publicly verifiable. What we want to get to is a system where, I like to say this, where everyone in the world can be our regulator. Everyone in the world can look at what we have at Backpack Exchange, what's happening under the hood, what our risk parameters are, what our system and engine is doing, and be able to look at the data and verify for themselves that this system is fair and transparent and is doing the right things. And so we want to be trusted not just because we are regulated by governments and regulators, but also because it's fully verifiable and open. Yesterday I think a gentleman asked me where I think regulations are going. And I said I don't know. I think it's not, regulations isn't something that's just top down, where regulators just come up with something in a black box and then just sort of imposes it onto the crypto ecosystem. Regulation is really a two-way street. It's a conversation between the industry and regulators. And I think as long as we are transparent and honest about the systems that we're building, the risk that is still retained, and the risks that are still sort of that we can solve using crypto technology, I do think we can actually come up with pro-innovation laws and regulations that will help us grow in the next few decades. Thank you very much, and hope you enjoyed it.
All right. That was great. I love listening to Can. It's very special. Can flew in just for this and is flying back out tomorrow, so I feel very excited and very lucky that we got to listen to that. That was our final talk of the day, guys, so we are wrapping up. Very excited. Thank you for staying to the very, very end of the first day of Ship or Die. Couple of notes. The venue will be open at 7 o'clock, so you're welcome to come, hang, socialize, check out all the booths. If you haven't picked up your swag yet, please do. And tomorrow morning, we have a very special set of events. The West Coast is still running. Tons of really cool stuff going on the West Coast stage. The East Coast stage will be hosting Policy Day. And we are going to get started bright and early at 9:50 a.m., so a little bit earlier than we started today. And why is that? Because we have a set of multiple senators coming up from Washington, D.C. to come and talk to us about the ongoing state of crypto legislation. And then from there, we have commissioners, the CFTC, former SEC commissioners. I'll be moderating a chat with Congressman Richie Torres from right here in New York. It is going to be a bam, bam, bam onslaught of amazing, amazing content related to policy. So I am thrilled to welcome you all tomorrow. So be back here. Don't miss it, because today was amazing. Tomorrow's going to be even more amazing. So thank you for staying with me, and we'll see you tomorrow. Thank you.